A very good morning to all my professional colleagues and other delegates who have assembled here. Today's seminar is going to be on, it's a one-day seminar, it's going to be on Companies Act, Loans and Investments. We start the first session. Our first session speaker is Shri V Balasubramanian, and we have other sessions in course. After this, we have one more session, and after the lunch, we have two more sessions. So, once again, I welcome you all for this one-day seminar, and I hope you get enriched and enlightened at the end of the day. Before we start, a small request: all of you put your mobile in silent mode or switched off. Now I heartily welcome today's first session speaker, Shri V Balasubramanian, to the dais. I request you all to please rise for the ICAI motto song.
Yaesha supteshu jagrati, Yaesha supteshu jagrati, Kamam 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 sho nirvimanaha adev shukram nara brahma adevamritamuchyate asmin lokaha shataha sarve tadunatyati kashchan etadvaita
Kindly take your seats, please. It now gives me great pleasure to introduce our first speaker for the day, Shri V Balasubramanian. Basically, he does not need any specific introduction as such because he is well known in our profession. Would call, may I use the word doing? I think it's, anyway, his experience speaks for himself, both domestically and internationally. He's between a lot of listed companies, audits, and I'm speaking beyond the paper because I know him personally. Just for your information, his base qualification is BCom FCA. He is also a registered valuer, insolvency professional, and certified fraud examiner. He is a partner in PKF Sridhar & Santanam, a well-known reputed firm with global connections. He has more than 35 years of professional experience. He has been handling advisories on company law, valuations, forensic, and restructuring. He has also been involved in many audits, including large listed companies, which I said earlier, across multiple industries. So you can see the extent of experience and guidance he would be giving to his firm and the value it is adding to the firm. He is also co-author of a global annual publication by Willis, Interpretation and Application to IFRS Standards. Has been a member of Auditing and Assurance Standard Board and member of the Committee for Accounting Standards for Local Bodies, and has been a faculty resource person for sessions covering company law, valuation, insolvency, forensic, peer review, CSR, etc., etc. So, heartily welcome Shri Balasubramanian for his presentation. Sir, your mic is, the floor is all yours. go ahead in full flow. Thank you. I'm sorry, I think missed out. It's time to present the shawl and the memento. I hereby request our learned professional G. Shankar to come to the dais and honor V Balasubramanian with a shawl and memento.
Morning to you all. In the first session, actually, we are going to be covering about 185 and 186 loans to directors and then loans, investments, etc. by the company. There is a history to this whole thing. When 2013 Act came, actually it came with a very, very strong 185 section, which is over the period changed. So we are going to more focus on what is there today. But as it came, it was very restrictive, significantly restrictive. It had absolute prohibition on certain things beyond what was practically and pragmatically feasible in a corporate environment. So they had to necessarily come out with a lot of changes. So initially they came out with orders under 462 for simplifying some of the things and easing out certain requirements under that. And then from a prohibitory, it moved on to prohibition with some exceptions kind of a design. And slowly it has morphed with more and more amendments to it being made into more focused on now conflict of interest kind of scenario. So a lot of things are permitted subject to certain requirements being met, etc. So the whole thing has undergone a significant change over the period. And all this happened quite a few years back. Of course, now it has been more or less stable with the current kind of provisions. As it was brought out, it was, as I said, had blanket prohibitions, which was not pragmatic also. So, if you look at it, let's, you have a column mic? Column mic. Get to that. I think it's easier to use the collar mic to walk around. Yeah. Am I audible in this? Yeah, I think this is better. So, I'm actually taking through the whole sections in a sequential manner, and I will also go into some specifics under that. So the first is 185.1 starts, first applies to all companies, covers any advance of loan, right, including loans, book debts, which are in essence in the nature of loans. It also covers guarantee, security, etc. It extends to direct as well as indirect lending. So if I give it to B and B gives it to C, if I cannot give it to C, it is prohibited still. So that is also to be considered specifically. So what is covered is parties, any director, his partner or relative, all that is covered. Any director of the holding company, their partners or relatives, any firm in which such director or his relative is a partner. Right? So these are the criteria for application of the prohibition. Of course, this is the base section. There are some exceptions also which have been given. There are different types of exceptions which are coming. So essentially, 185 started as a section to prohibit loans being given to directors. Now, interestingly, if I am the promoter and I am not a director, this doesn't apply. This doesn't apply at all, right? So, it only focused on directors who will have voting interest or directors who may not even have voting interest. That's how it started. Then they came out with exemptions, right? Like I told you, the initial way the Act came in 2013 and then it got notified. I think this section got notified somewhere in 2014. When it got notified, there were a lot of confusions as to how certain normal business transactions will also be undertaken. So they came out with a lot of rules under 462 to give exemptions, orders. So, the first exemption is with regard to private company. Now, a private company is exempted only if it meets certain criteria. A, in that private company, there should be no body corporate having investment. That is, there should be no share capital investment by another body corporate into that. It should be held by individuals, etc. Right? B, there should be limited loans. Either it should have less than 2:1 ratio loans and not exceeding 50 crores in any manner loans. Right? That is the second thing. The third requirement, okay, you have some loans, you should also not have any defaults in those loans on principal or interest. So if it meets all these three criteria, only those private companies are exempt. Now, wherever the private company has a shareholding by another company in it or any other body corporate in it, then those private companies do not have this exemption. So in private company also we have to be very clear and careful when we apply this. So it's not a blanket exemption which is available to them. The most often missed out part is that it should not have any corporate investors into its kitty. The second is, in the case of Nidhi companies. Now, Nidhi companies, as you know, are formed for lending within the members, and directors are also generally from the members. So, what is the whole point in saying that there should be a blanket ban? So, they came out with a regulation or exemption for that also, saying that, okay, in the case of Nidhi companies, loan can be given to the director or relative so long as it is given in the normal course of him being a member. So, whatever a member is eligible for, if he is also eligible, you can give it. And additionally, such loans are to be disclosed in the financial statement. So, there is transparency to the other members. There is transparency as to what is the loan which has been given to the director. Because anyway, any loan given to the director would have come because there are so many other requirements also which requires disclosure. So, this is the exemption which were brought in for private companies and Nidhi companies, and it didn't stop there. Now, funnily, after bringing out the Act, the government found that even government companies are affected by the requirement. So, they came out with the exemption saying that government companies will be exempt so long as the transaction is approved by the concerned ministry under which it is coming administratively, whichever ministry is controlling that company. If that ministry has approved, whether it is from the central government or state government, as the case may be. So each PSU is coming under a particular ministry in either the central government or state government. That's how it is structured. So that is called the administrative in charge, ministry administratively in charge. So whichever is that ministry or department, if they approve it, then they said it is exempt from the requirements of 185. Then we have these IFSC coming in. So when IFSC came, they came out with exemptions for IFSC private and public companies, both private and public companies under IFSC. So first is in the case of loan by a private company where a director is a director. So if a loan is given to another private company where this director is a director, such directors should not have significant shareholding, direct or indirect shareholding, including through relatives. So, as long as he is only a professional director, then whether it's a private company or not, in your case, it can be exempted, and it also requires a special resolution. That is, the members should approve. So, these are the things which were brought in for IFSC companies, because IFSC companies largely are structured with directors being professional directors, and they will be directors in many other companies also. So, just because they are there in two companies, you can't put a ban which will affect normal business transaction from happening. So, these were the exemptions which were brought in to ensure that the prohibition does not become completely out of pragmatism. Now, these notifications were issued in 2015. The Act was notified in 2014. They found that there are practical issues in implementing it, so they came out with a notification under 462. So they came out with orders giving relief. All this was notified in 2015. In 2018, the 185 section itself was amended, significantly amended, right? So a lot of things were brought into the section itself in 2018 when the amendment was made, and the old section was substituted with a new section completely. So the question is, okay, whether these notifications which were made under the old requirement of 185 in 2015, whether it would subsist and continue. The legal basis is that it has been issued under 462, which means it has been issued with public interest in mind, right? And so long as they have not been specifically repealed, it would continue to have an implication. So, the exemptions are deemed to continue even today. In fact, if you go to the MCA site itself, they still report these exemptions as part of the section. So, presume that is the view even MCA is taking. But this is the view industry has also taken largely that it is a continuing validity beyond 2015 also, 2018 also. This second subsection, which is talking about lending to certain specific prohibited parties. So, how you can lend in case of certain types of parties. Now, this does not include all parties. Let's be very clear. This does not include and this does not extend to all parties, as we will see, because that is the key thing I think we should understand in 185(2), that it is only talking about certain parties. So, what is it? It talks about loans being given to a person in whom director is interested. Now, very interestingly, we would think person in whom director is interested would mean everything which a director would cover, but it specifically says for this subsection, person in whom director is interested are specified there. So, for example, in my personal view, the director himself is not covered under 185(2). If I am interested in somebody else, surely I am interested in myself first. But in my view, it is not covered here. What is covered is what is given in that explanation, which is private company in which a director is a director or member. This happens very often, right? The same director could be in two private companies or in one other private company where he is a director in your company also, or he could be a member. So typically the way in many parts the Companies Act have been drafted is, if there is a director who is a director or member in a private company, irrespective of his shareholding, that entity itself is considered as an interested entity, because in a private company, the presumption is that it will be closely held and there will be some nexus. The second category is non-private entities, body corporates included, where 25% or more of the voting is controlled by this one director or multiple directors and their relatives together. So that is the second category. Third category is the residual. Any entities whose board, managing director or manager is accustomed to act as per instructions of the director. Now, this is a difficult thing always to prove, but yeah, that is the residual which is there to cover that. So, if you really look at it, it only talks about lending under 185(2) with certain specific steps being taken only to 3 types of parties. It is not all parties in whom director might be interested. For example, a director's relative is not covered here by itself, right? Not under this, surely. So this was to ensure that if there are, for example, you take a very, very practical case, that is a private company, and let's suppose it has an associate or a subsidiary private company, right? Now, section 185(1) prohibits, bans, because there will normally be common directors in this, because both are private companies. Obviously, I am not going to get some independent directors and put them. There will be common directors. So, immediately there will be a prohibition. So, 185(2) was essentially brought in to ensure that there can be a release for this thing. There are certain conditions which are attached to it. Now, you can't just like that give a loan because 185(2) is giving a power there. It says there are 3 requirements you have to comply with. First is you get special resolution. Special resolution in your company if you are going to lend, right? So that is the first thing. So your members are approving it, and members are approving by 75% majority at least. Second is the explanatory statement for that meeting should give full details and particulars of the loan proposed to be given, etc., so that there is clarity before they actually vote and decide on it. So that is the second part of the requirement. The third is most important. The person who is going to borrow will have to use it for his principal business activities. Now, it cannot be just loan being given for any purpose. It has to be for their principal business activity, right? So, when we apply these sections, we have to be very careful. Especially this is the complexities will come where there are large number of private companies in a group, and we always think, oh, private companies, many of these don't apply. But there are a lot of other restrictions. So, for example, he cannot give the money to go and invest into something else. That is not its principal business. So, it has to be for the principal business activity. So, it has to clearly go under these 3 for you to be able to do this. Of course, wherever there are exceptions, you can use those exemptions, which is a better thing. Now, this is one of the few cases, because 185, 186 itself has probably not been tested so much. Even the ROC adjudications are not many in under 185, 186 as of now. So, in this case, what happened? The board decided in 2018, May 2018, the board decided to lend money at an interest, not free loan, at an interest to another company which had common directors. Within the group, another company which had common directors, right? So, if you go by the requirements, it should have taken a special resolution. Now, it missed to take a special resolution. However, in September 2019, they went to the members, took a ratification. The company went to the members 1 year later, took a ratification, including for what was done in the previous year. But still, the decision was that in 2018-19 you are in violation, because it says you should get prior approval, which you did not. Ratification does not set right the old problem. Of course, the court was lenient because of 2 reasons. One is they had gone and obtained the approvals later. Second, they had voluntarily come for the condemnation. This was not an investigation which brought it out or an inspection which brought it out. So the court gave a lenient this thing, but fines are, a minimum is also fixed. So even they cannot say, okay, we will waive the fine. There will be some fines which will be there, right? The court ordered in this case a fine of 5 lakhs to deter it from doing it in future. So, one of of the key things we should understand here is the principal business activities. It's not been specifically defined, right? So, as there is no specific definition available, we like to understand it in the common parlance, what it could relate to, and what it could mean. So, in that context, it is important to understand how we can determine. So, some of the indicators could be, one, which activity of the company is producing the maximum revenue for that entity. So, that could be one of the indicators. Substantial trade activity of that entity in terms of physical business activity which it's doing, which is doing that, right? Then income of the entity which is coming from on a consistent and regular basis, not a one-off. So this year probably as a one-off I have got a huge revenue coming from one particular activity, but that is not my regular activity every year. So then you will have to apply which is your principal activity, right? And what would be considered as ordinary course of business, not normal course of business, ordinary course of business for that entity. So we need to understand what is there in the objects clause of the borrower company and what is it actually doing, right? Not all objects clause are actually being put to use by the companies. So we need to look at that to ensure that the principal business activity criteria is properly understood and applied. So, interestingly, there is also another thing which we need to understand here. It only talks about loan, it does not talk about guarantee and security, right? It does not talk about guarantee and security being used for the principal business activity. But for a harmonious construction, we have to assume that even if we give security or a guarantee for a loan taken from a third party, such loan should also be for the purpose of its principal business activity. This is a more harmonious construction. Of course, if somebody takes an aggressive view, it has to be tested, right? So, but that is a point which needs to be borne in mind, whichever view is being taken, that A, it is not so specifically spelled out in the Act currently, and B, this would probably make a harmonious construction. Otherwise, it's very simple. Instead of me giving the loan, I'll ask somebody else to give the loan, I'll give a 100% guarantee. So, you are direct, indirect, you are only circumventing that. Then, what is a body corporate? We saw that it talks about controlling interest in a body corporate. So, body corporate is wider than just companies. It will include LLPs. It will also include foreign companies. But it will not include a society. It will not include a society, right? And another important thing again to be overall for 185, 186 itself is mutual funds. Now, many companies park their surplus funds in mutual funds. Now, whether this also should be considered for the 60%, 100% limit or for any of these regulatory requirements, etc., is one of the key things. No? Mutual funds are generally trusts and also not part of a body corporate. So, you don't have to consider them as a body corporate. So, mutual funds are basically that it is essentially a trust and not a body corporate. And mutual funds units are also not securities. So, it's not investment in security. So, what I'm coming to is the whole 185, 186. In fact, many companies take a view that mutual fund is not covered under the requirements because these two sections broadly talk about loans, guarantees, security and investment in securities. So, in that, this will not get covered is a larger view which people are taking. Of course, some companies very, very cautiously put, because it's only approvals. No? You take approval for investing in mutual fund also. Now, we were seeing the third part, right? Any entity where the board of directors or the managing director is accustomed to act. Of course, like I said, it's a difficult thing to this thing. So there are some basic stuff which has been drawn up from earlier case laws. Holding company's approval was required for disposal of its asset. This was the requirement here, right? So, inadequate to show that subsidiary company's directors were acting as per instructions from holding company. So, the point here was, they were trying to say because there was a requirement to get holding company's approval to sell your assets, right? The directors are actually acting as per instructions from the directors of the holding company. Was the larger view which was being taken, but the court took a different view on that. So it said holding company derived its powers by being the majority shareholder, right? And not as a controller of the subsidiaries board. That is, it is not because I am telling he is listening. They are listening because my company owns that company, right? Because I am the major shareholder. So I have the right. If they don't listen to me, I can remove those directors. I have the right to remove the directors and appoint my directors. So I, as the majority shareholder, has the right. That was the thing. That is different from a benami kind of a relationship, which is what is looked at in the accustomed to act part of the section. So if it could be shown that the directors of the company had exercised their own judgment and independent discretion and had sought the approval of the holding company only because of its status, the directors cannot be considered as covered by this. This was the decision in this case law, which was not connected with 185 or its 12 section, but just to give an idea of what is being looked at here. Then subsection 3 talks about cases where both 1 and 2 will be excluded from. So they have said certain types of loans can be excluded from 1 and 2, both. Loans to a managing director or a full-time director. So it has to be only for a working director, not all directors are covered here. Managing director or a full-time director, provided it is given as part of the terms of employment and as applicable to all other employees. It's part of a standard terms of employment which is applicable to others as well as to them, fine, you can give it. Or in the alternative, it should be a specific scheme which is approved by the members in a special resolution. So theoretically speaking, I can draw up a specific scheme and give my MD a loan, right? Without having 185 1 or 2 being made applicable, provided I draft a scheme, take it to the members, get their special resolution and then implement it. So again here the idea was that, okay, if you are doing something for the working directors, so this is only applicable for a working director, non-working directors are not covered here. So for a working director, if you are going to the members and taking some approval and doing, fine, that can be exempted from 185. Then the second is a company which is in finance business. So if the business of the company itself is to lend, then you put restrictions to it, it becomes difficult. So they gave exemptions for that, right? Provided it is in the ordinary course of business and a minimum rate of interest is at least charged. So these are the requirements there. If it is a finance company, then they can do it. The third one was holding company giving to a wholly owned subsidiary. Wholly owned subsidiary. First we are talking about a wholly owned subsidiary. In the case of wholly owned subsidiary, loan, guarantee or security, anything provided for them is exempt from the requirements, provided again it is used for the principal business purposes. It's not used for some other purpose, right? So then it can get exemption. The last is a non-wholly owned subsidiary. Now there is a key difference between the wholly owned subsidiary and non-wholly owned subsidiary. In the case of non-wholly owned subsidiary, it is only in respect of guarantee or security, right? Guarantee or security and not loan. I cannot lend to my subsidiary under this. I don't know why they have gone to so much of fine tooth comb differences. Yeah, but that is there currently, right? Again, there also, the security or guarantee should be for the purposes of its principal business activity. Which means, essentially, the loan they are taking based on my guarantee or my security should be used towards the principal business activity. The 185.4, which is the final part of 185, deals with the penalties. Now, for the company, the minimum penalty is 5 lakhs. That's why I said in the other case, though they have been lenient, they charge 5 lakhs. Now that is the minimum lenience. So imagine small companies getting affected somewhere, then there could be a huge fine on them. So 5 lakhs to 25 lakhs. And for every officer in default, there could be a imprisonment up to 6 months and a fine of 5 to 25 lakhs. There also, if they charge an officer in default, then it's a minimum of 5 lakhs going up to 25 lakhs. It doesn't stop with that. It also penalizes the recipient of the loan. Now the recipient of the loan has no direct connect in the process, but in the section he is also covered. The recipient of the loan can also have an imprisonment and or fine. In the case of officer in default, it is only or, either jail term or money, right? They can't do both. Of course, I don't know what will happen if something like this comes up. But the recipient of loan, it could be imprisonment as well as a fine. So 185, as he was saying, is more about a lot of restrictions on lending to directors and director interested parties. So that is the overall this thing under 185. And then in that, what exemption, what exclusions, what exceptions, all that has made it into a khichdi. So that's what they have done with 185. 186 is the larger section about powers of the board to either invest in securities or lend or give guarantees or provide security to others. So all that together, what are the powers of the board and how they can exercise and what limitations will be there on the companies, that is what is brought under 186. 186 basically, first section is a standalone thing, 186.1. The 186.2 onwards talks about other things. 186.1 only talks about the layers of investment, which is basically how many subsidiaries you can have one below the other. So it basically says that you cannot have more than 2 layers of investment companies. So multiple layers of investment company, which are just only investment company investing into one company another. One of the things they found from the past problems before the 2013 Act came, or even before the 2011 bill, etc. was made, was that many of these frauds had a huge number of entities being formed. So one of the things they came up with is to reduce the complexity. They said you cannot have more than 2 layers of investment companies. So that is the first thing. And then there are, of course, exemptions to that, because internationally you can't even implement this. Internationally they then said, okay, if you are doing outside India, you are acquiring some company, there whatever is the regulation, if it permits, you can keep. But what is here, you can't. And they gave something. Then subsidiary company having any investment subsidiary for the purpose of meeting any regulatory requirement. This is also something which they came up with as a provision. So only 2 exceptions which are given. The first exception is if you are doing some acquisition outside India where you are regulatorily permitted, it is not mandatory, regulatorily permitted to have multiple layers. You can structure the way you want. You can structure with multiple layers also, no problem. In India, subsidiary company having any investment subsidiary for the purpose of regulatory requirement. So where you have to mandatorily, because you want to comply with some regulatory requirement, you are creating an investment subsidiary in between. Yes, you can have a entity additionally, one layer additionally, if that is required. So before going into other things, I thought I'll take up 186.11, which talks about exception from 186, except subsection 1. So this says subsection 1 will apply, all others only will get exemption from, right? Not subsection 1. So what are those? LSG, that is the loans or any security we provide or guarantee we give, right? In case it's a banking company. So banking company is exempt from 186 other sections requirement. An insurance company is exempt from other section requirements. Housing finance company, right, is also exempted. But in the case of housing finance company, they added a rider. If it is in the ordinary course of the business. For a banking or insurance company, it is not, because they are under some other regulator. They are covered by some other regulator. Housing finance company, they added this. The housing companies are partly regulated by RBI. There are some regulations which they have, right? There are some regulations which comes under the Companies Act, and they didn't want something to fall in between. They said it should be the ordinary course of their business. So essentially what they are trying to say is, you are doing insurance business or finance business, fine, we recognize that. You may have to be exempted from that. Then the fourth one was, company engaged in the business of financing of companies or providing infrastructural facilities. Now this part had undergone various wordings and changes and etc. Essentially, you are talking about other NBFCs being exempted, and if you are providing funding to infrastructure facilities. Now why the last one is very critical? It is typical business model itself that infra companies create separate SPVs for different infrastructure projects. So there will be, their business model itself requires a lot of such loans etc. to be done, and it's a business model, you need to provide for that. So they have come out with that exception there. So this is for only loan, security and guarantees. For investment, they said it is exempt not for a banking company. It is exempt for an investment company. If you are registered as an investment company, then it is exempt. Or if you are acquiring it under a rights issue. Now, let's suppose I am already a shareholder, and on a rights issue there is some shares being allotted, and if I subscribe to that I will exceed my 60% limit, then to say I can't do it is not appropriate, because it's a right being given to me because I am an existing shareholder. So such cases have also been excluded, and NBFCs with principal business as acquisition of securities. So if its principal business is acquisition of securities, those NBFCs are also exempt from investment. So these are the only three criteria under which investments are exempt from 186 requirements. So this is the exception which has been built into the section there. Again, for all this also, layers of companies applies. Now if you see, the important thing is, it says company engaged in business of financing of companies or providing infrastructural facilities. Now there are a lot of NBFCs which lend to individuals, scooter loan, car loan, right? They are not financing of companies. So where do they go? There was a lot of confusion, right? So this exemption applies when NBFCs are registered under Chapter 3B of the RBI Act, are engaged in the business of providing loans or investments. Although the clause refers to investments made, it covers NBFCs lending to individuals. So if you really go back, what has happened is I don't know, see, this is something, 2013 Act was supposed to simplify things, right? So much of complication and unnecessary complications have been built into it. It was really not a ground up fresh thought into the Act, which was what was supposed to be originally. Now when they talked about this, right, investment by an investment company, actually if you go under that, the wordings read as are engaged in the business of providing loans or investments. So here they are under investment, they are saying engaged in the business of providing loans or investments. So view which has been largely taken is that this gives an exemption which is there. Largely the intent was that, okay boss, NBFCs are regulated by RBI, they will take care, so I don't have to bother under Companies Act, was the idea. But that's not been very well articulated in the sections as it stands even today. It could have been surely better drafted is this thing. In fact, the whole Companies Act could have been probably better looked at. There are so many complications. If I say private company, there are 100 things which will apply to certain private companies, 100 things which will not apply to certain private companies, and each of these have different criteria. So here we saw one criteria which says there should be no corporate companies which are owning shares in that private company. In some other section it will talk only about turnover and net worth. So absolute chaos. Nobody can easily understand. If you are of course we are all here CAs, if you are a businessman and non-finance guy, you necessarily need somebody. If you form it as a company, you necessarily need somebody else to advise you, which was not originally the intent, I suppose at least. Or maybe that was the intent, to keep us all busy. So coming to some of the definitions, investment company. Investment company definition is principal business is the acquisition of shares, debentures or other securities. So again, it is deemed to be principally the business if such investment assets constitute more than 50% of the total assets, or income from such investments are more than 50% of the gross income. So the same 50-50 rule applied only to investment assets and investment this thing instead of all financial assets and financial income. So that is what would make it an investment company. And infrastructural facilities is already defined under Schedule 6. So all that which is under Schedule 6 will get covered under infrastructural facilities. Now, then we talk about, we saw that the exceptions provided under subsection 11 are only for all sections other than section 1, subsection 1. Now, there is a complete exception which is provided separately. The first one is for government companies under defense production. Any government company engaged in defense production is completely exempt from 186 requirement, including layer of subsidiaries. Anything they want, they can do, right? In respect of unlisted companies, if the transaction is approved by the ministry or department, same rule as we saw earlier, that it should have the government layer of approval, right? And this is applicable for non-defense production companies only if they are unlisted. A listed company would still, even if it is a PSU, will still get governed by 186(2), 3, etc. requirements, right? Because they said as a listed company, you have a larger set of stakeholders to whom you have to be answerable. Members go and get their approval. What basically 186 is saying that if you are exceeding the limit, go and get your approval from the members. Now, in the case of a PSU also, unless you are in defense production, which is exclusive category for national interest, they have come out with that. Even if you are a PSU and you are listed and you have public members, go and get their approval if you want to do it. If you are unlisted, fine, you take your governmental approval and go ahead, you can do it. So this is the key thing which is there. So as you can see, the difference between 185 and 186, in 185 large number of exceptions were provided for different things because that was more of a prohibitory in nature, more as it started, right, at least. Whereas 186 was more a restriction on the board's powers and where you have to approach members to take approval. So they made it limited exceptions. So then the next part we are going to see is 186, 2 and 3 together, because these have related aspects, right? So we are going to see that together. This basically talks about the limit on what you can invest and how you can take approval if you want to cross that limit. So it basically covers loans, guarantee, security and investments, right? What it does not cover is any loans or guarantee or security for employees. If it is given for the employees, the normal course, that is not covered there. But all other loans, guarantees, securities are covered. And the limit which is within the board's power is 60% of paid up share capital, free reserves and securities premium, or 100% of free reserves and securities premium, whichever is higher, you can use that as the limit within which the board can take decisions. Beyond that, it will have to go to the members. Now, when will have to go to the members? It is a prior approval. So you need to take approval before you spend. Before you invest, you need to have a prior approval by way of a special resolution in general meeting, right? And in this whole thing, again, they have said, if there is a loan, guarantee or security given to a wholly owned subsidiary, that is exempt. Now, interestingly, they said wholly owned subsidiary or joint venture, associate is not covered. I don't know why, but that is how it is. That's how it is worded. It says wholly owned subsidiary or joint venture, but not an associate. Then acquisition of securities in a wholly owned subsidiary. Maybe because in a wholly owned subsidiary anyway 100% it is internal, right? So that is the second thing which is exempted. And in acquisition of securities, it's only for WOS, it is not for regular subsidiary, it's not for joint venture or for an associate. Those are not covered. Then the next is that all this is permitted, even these exclusions are permitted only if they are properly disclosed in the financial statements. Now, if the company fails to properly disclose in the financial statements, then these limits will apply to them. I don't know how disclosure is going to make this thing, because anyway these disclosures are required under so many places. So it is already there. So I just tabulated this. What is exempt, what is not exempt? Now, if you look at it, a loan, a guarantee or a security. Now, in securities, I took it as three separate things. If I buy debenture, if I invest in preference share, if I invest in equity shares, that could be differences. So, in all these cases, in the case of wholly owned subsidiary, it's exempt, completely exempt. In the case of a non-wholly owned subsidiary, where it's a partially owned subsidiary, none of these are exempt. And for an associate also, you can see none of these are exempt. In the case of a joint venture, the first three are exempt. Loan, guarantee, security is exempt. So I can give him a loan, but I can't get his debenture. I don't know why, but that is how it is, right? Because the wordings today stand like that. If I invest into that debenture, then that is coming under securities or investments, so it is not covered by the exception which is given. If I give it as a loan to the joint venture, yes, it is permitted. But I think sometimes I wonder whether this was a mistake that they missed out the word associate there. I can't think of any other rationale for that. So, we talked about disclosure in financial statement. 186.4 specifically says what needs to be disclosed also in the financial statement. So one of the things we should ensure is that whether these disclosures are actually happening. Full particulars of loans given, investments made, guarantees given, security provided, and most important is this also, purpose for which the loan, guarantee, security is proposed to be utilized by the recipient. Okay, you have given to the wholly owned subsidiary or a joint venture, etc. But what are they using it towards? That also needs to come out here. when you have to go for approval, right? So there are two levels which can happen. What is within the limit, what is exceeding the limit. Now when it is within the limit, the board can do it. That is, it is within 60% of paid up share capital plus free reserves plus securities premium, or 100% of free reserves plus securities premium. Then the board can do it, but it has to be a resolution passed in the meeting of the board. Can't be by a circular resolution, right? Second, it has to be with the consent of all the directors present in the board meeting. So one director does not approve it, you can't do it. It has to be all directors present. You can only request him, don't be present if you don't want to vote. That's all is possible. But they are present, they have to vote for it. Otherwise, it will not be. Then, wherever there is borrowing from a public financial institution, where term loan is subsisting and the limit under subsection 2 is exceeded, or if there is a default in either principal payment or interest payment, you need to get their prior approval also. This is also part of the requirement. So this is something which needs to be considered. So the PFI approval is required only if you are going to exceed the limits, right? If it is within the limits, it is within the board's powers, no need. But that part will come in when the this thing is limit is exceeded. Again, for IFSC companies, they made some exceptions. That one number of layers of investment company will not apply, right? Then limits and member approval shall not apply, right? That is, they can go with their own approvals, board approvals itself. So you don't have to go to the members for approval. Only for IFSC companies, right? Then the board resolution can be by circular resolution also. This is to make it easy for the IFSC companies to operate. Most of the IFSC companies operate on virtual mode and circular resolution, so they made it convenient for that. Then there is a section 186.6. This again is this thing, we are talking about giving loans etc. in 186, giving loan, making investment, giving security for somebody else. So where we are getting obligated. Here it talks about somebody who is receiving it, right? So what are the SEBI regulated entities here they are talking about? They are not talking about all listed companies. That is not the SEBI regulated entity they are talking about. They are talking about all the financial sector intermediaries, that is merchant bankers, brokers, underwriters, RTAs, whole list, everybody who is like that regulator, financial sector intermediaries, if they are receiving any loan etc., right, they have limits. So essentially the purpose for this is that these financial sector intermediaries can play in the market. So to protect that or to prevent them from doing that or having funds for doing that or being your funds being used for playing in your own script etc., they have put certain restrictions there. So they have said that you cannot take it. The companies will have to disclose all loans or deposit in their financial statements, right? That is the basic requirement. They have said that whatever money they receive as loans. So for example, if one of the loan which we are giving under 186 is to a merchant banker, the merchant banker will have to disclose in his financial statements also as to what loan he has taken, from whom and all that purpose, right? The idea is to bring in transparency of what they are doing with the money taken from the corporates, because they are supposed to be financial sector intermediaries who can play a role. 186.7 is a very critical thing. Again, lot of times what happens is we feel that because some exemption is given, this also is exempted, we don't have to apply. Many a times 186.2 and 3 only are exempt. We saw 186.11 which talks about exemption from other than subsection 1, that is a limited set of things, right? Not for everything. No loan to be given under this section at a rate of interest lower than 1 year, 2 year, or 1 year, 3 year, 5 year, 10 year yield of the government security, whichever is the closest to the tenor. Right? The exception which is provided here is where government holds more than 26% and for funding industrial research and development projects. So there they have given an exemption saying that in such case you can give the loans because government has set up certain entities to do this, so they didn't want that to get into a hassle there, so they have excluded that. Otherwise, interest on loans is something which applies. In fact, very interestingly, I should tell you, this is one of the things which many a times is missed out and not reported upon also. We know CARO requires specific clauses there to say that whether the company's this thing is in compliance with 185 and 186. There's a specific clause. We all have to report on it. And I have at least seen 2 balance sheets from listed companies, 2 balance sheets where auditors have given a clean sheet, 185, 186 compliance is there. Secretarial auditor in the same report, in the same annual report, has said they have violated 186. They have big risk, which shows that forget about our application of mind, we have not even seen the secretarial auditor's report before we completed our report. So, whether 186.7 applies to all loans, one interpretation is yes. Another interpretation possible is 187 says 186.7 starts with no land shall be given under this section. Exemption provided to WOS from 186.3 proviso says this subsection will not apply, right? Thus, if a loan is not covered under 186.3, right? If a loan is not covered under 186.3, then such loan, for example, to a WOS, etc., right? One view could be you can construe that loan is not a loan under 186 at all. Thus, you can then take a view that 186.7 does not apply to it. But this is a very narrow interpretation. My own this thing is the more cogent interpretation is there are people taking both these interpretations today. Let's be honest, we'll have to wait and see how. Like I said, there are not many case laws which have developed under 185, 186 till now. Maybe once we have some more, we will have some clarity coming on that. But my personal view is that 186.3 exemption is only for that subsection. All loans are covered under 186 is my view. So that is something which you can appropriately consider. But there are 2 different views being taken. Next thing which is always talked about is, okay, you have said government security rate should be the minimum. So what do I do when I lend to my foreign company? I am lending in US dollars, I am lending in GBP, I am lending in euro. I cannot get this kind of a return. So how do I do it? What do I do? Again, there is no clarity which is brought into the section, but very pragmatic approach would be, what can I do? I could give them a rupee loan at these rates, which would mean the risk of the currency is on me, right? Or I could give it as a forex loan, right? Then I get the foreign currency. Obviously, it will have to be at a lower rate. Then you can have an independent review done to look at what are the benchmark rates, how you can adjust for international benchmarking, and then what additional factors you need to consider for the forex hedge, etc., to justify the rate before you execute the contract. So this is something which can be looked at as a possibility. And some people have done like this. However, again, it is yet to be tested anywhere specifically. But this is a view which is very pragmatic. Obviously, I cannot give loans only in Indian rupees. I may have to handle this thing and giving foreign currency loans. So in which case, obviously, it cannot be at the high rate which we charge within India from a different perspective from, let's suppose, a global transfer pricing perspective. The other country will also object to the under transfer pricing. So we need to have a balanced outlook, and this is the approach which can be looked at. Then subsection 8 talks about restriction on certain companies. Now, this talks about when you cannot lend or invest or etc. So, if you are in default of repayment of deposits, so if you have taken deposits, if you are permitted to take deposits, you have taken deposits and you are in default of repayment of either the principal or interest, right? Whether such deposits were taken prior to this act or not, as long as the default is subsisting, you cannot lend or give guarantee, provide security, invest, etc. So you will have to necessarily clean up your deposit position before you can do any of these. So essentially this whole subsection talks about companies which are in default on deposit. 9 and 10 talks about record keeping. There is a register of all loans, guarantees, securities or investments made by the company to be maintained. It should be available at the registered office. It should be open for inspection, and members could come and inspect anytime. Members could take extracts or even ask for copies from the company. Then here also 13 talks about the penalties. Now here you will see 5 lakhs is not the starting point, thankfully. 185 is high primarily because it's more prohibitive in this thing. This is more procedural or control to ensure that what is the board power and when they should exercise that. So here they are talking about a minimum of 25,000 to 5 lakhs. Sorry, the last one should read as 25,000 to 1 lakh, not 25 lakh. But at the same time, if there is a problem, imprisonment can go up to 2 years, not 6 months. Under 185 it's 6 months for an individual officer. Here it could go up to 2 years. And it could have, that last line I will correct it, it's 25k to 1 lakh. Now, arising from this, there are some more grey areas or some more specific points which I wanted to discuss. So the first one is whether deposits can be treated as loans. So I give a deposit. Now would it become a loan? When it is a deposit, when it is a loan? There are 3 words which always is a problem. We always try to find ways. Deposit, loan, advance. So there is a problem. We look at it. So a deposit and a loan will have to be differentiated. They need not be the same. So there are case laws, and the most important one is the Freddie Ardeshir Mehta case, which was not under these provisions, but it deals with the loan and deposit definition. A loan, the key things are it's a money lent with a commitment to repay. Somebody says, give me the money and I will repay, and generally carries interest. It is often borrower initiated. I come and ask for a loan. Right? I come and ask for a loan is what is a loan, and there is a commitment to repay. So this is the general thing, and generally it carries interest. A deposit is some money placed by a person, right? Subject to return. I am giving you the money, I am not giving it to you once and for all, it is subject to return. So it is normally initiated by the depositor initiated. Right? So this is the deposit. Largely what happens is you give security deposit or you give deposit for business transaction which you call as security deposit, whether that's a loan or a deposit, there's always a grey area. So this is the key thing to look at it from that perspective. So the court clarified loan involves borrower solicitation. The borrower is seeking money. Deposits often involve lender initiative, right, and may not always bear interest. Of course, interest can be there in deposits also. Interest by itself does not make it into a thing. So, there are some border areas where you can look at whether it's a deposit or a loan. One other question, we will also talk about advance and loans, maybe it's coming later. One other question is whether LLPs are covered. Now, companies have so much of hassle. 185, 186. If I am an LLP, none of these apply because LLPs only come under LLP Act. Companies Act does not apply. So, they can give loan to their partners. Private companies cannot give loans to directors, but LLPs can give loan to their partners. No problem. At least not from Companies Act. The second one, as I was telling you, is the difference between advance and loan. Always is an issue. In fact, in this, there is something else also we will see. So I have tried to put it into a table to look at the comparative position of what these two are. From a definition perspective, a loan is a money borrowed with an obligation to repay with or without interest. Again, interest can be there, need not be there. Advance is a payment made beforehand. So what is an advance? I have to pay you some other time. I have to pay you probably after you finish the service. I have to pay you after you deliver the goods. I have to pay you sometime. I am paying you beforehand. That is an advance, right? So this is the key thing, right? And it may or may not imply repayment. For example, when it could mean repayment could be there, I give you an advance, you are unable to supply, you return the money, it's a repayment of advance. That could be repayment, but that doesn't by itself make it into a loan. So, for instance, but for me to give an advance, there should be some business transaction. I can give an advance to my vendor, I cannot give an advance to my customer. Right? Does it make logical sense? To a vendor, I can give an advance saying that there is material to be received. So it's a possibility. Then, from a repayment obligation, loan always has a clear obligation to repay. Advance does not necessarily imply repayment, it depends on the agreement. Most of the time, advance would mean that it has to be settled by some other means, either by goods, services, etc. Of course, for some reason that doesn't happen, he pays you back in money, that might also be there in the agreement. Nature of transaction requires a positive act of lending. In the case of advance, it is generally a payment before something is due and may not imply lending. So, for example, in FEMA also you will always find this. ECB, you can borrow from your this thing, or you can take advance for services to be rendered, right? If you take it as advance for services to be rendered, so long as you settle it within 1 year, it's okay, you can take the advance and it is not an ECB. So this is the key difference. Advance is settled by way of services and not as a loan repaid with interest. There are specific case laws which have also dealt with these. These are some important case laws. Shriram Mills case. All are in a different context, but it gives you the underlying effect of what is a loan and what is an advance. In the context of section 185, advance versus loan is very, very important for us to understand because it does not use the word advance or loan and advance. It does not use that word. It says advance any loan. It is only talking about the process of giving a loan. It does not talk about advance at all. So advance is not covered under 185 at all. So long as it is an advance, it is not covered under 185. Though the word comes there. The word comes as a verb, not as a noun. So that is something we need to very clearly and categorically have this thing. There is a Penvault India versus ROC case which has also dwelt into this. So the purpose of section 185 was designed to prevent directors from benefiting personally from company funds by restricting loans. Right? There is a focus on curbing misuse of fiduciary powers which they have. So they don't divert the money to their personal this thing. Clearly, loan and advance have different meanings and different purposes. So long as it is identifiable that it is not a loan and it's an advance, then 185 does not even apply. Why I am saying this is sometimes there could be commercial reasons also, commercial transactions also. There could be advance or purchases which is being made, right? So long as you can justify it in the normal course, that is 195 is not covered by that. The next thing which is used in the section is also about book debt, loans represented by book debt. That is also something we need to keep in mind. Now, normally if I make a sale, there is a debt which is realizable, and I have to realize. Sometimes that could get delayed, right? Now, just because it is delayed, will it become a loan? Not always. You need to look at it on a case-to-case basis. What was the underlying intent? What was the purpose? What was the basic background to this whole thing? Sometimes the sale itself may have been done to cover it and give it as a loan. So instead of selling to somebody A, I will sell it to my related party, who will then sell it to A, realize the money, use that money, he will not pay me. Now you have to look at the intent and the full extent. So some of these things, of course, in a different context. Morning I was talking to him about SA 600, where also, these are things which will not come out because there are different parties. So anyway, that's separate subject we will come. But essentially, this is what we need to look at. When does a book debt become a loan? We have to be clear. A legal definition of a book debt is a sum of money owed to a business in the ordinary course, whether recorded in the books or not. That's a separate issue. Ordinary course. It reflects debts typically entered in the financial accounts. In the case of section 185, it clearly says book debt as a loan arises when a company sells goods to a director on credit and the amount remains unpaid beyond the normal credit period. So you need to go into this thing. So there could theoretically be also, okay, it was normally within the normal credit period, but something unexpected happened. There was some catastrophe, right? Because of which the related party now is not in a position to pay. So suddenly now it has become a long-standing book debt. So by itself, would it become a loan? Would it automatically violate 185? My personal view, no. You should be able to bring out those facts and this thing on a case-to-case. So the key point we need to look at is what was the intent and how it was done, and what would have happened in the normal course. As long as it is the ordinary course, there is no issue there. Hire purchase and leasing. Again, hire purchase and leasing is not covered. Hire purchase and leasing is a business transaction. Of course, like I said, everything will have to be tested on one thing, whether it is in the normal course or it is out of the ordinary. Out of the ordinary could be a structured transaction, which is a different issue. But essentially, if it is in the normal hire purchase lease arrangement, that need not be covered under 185. Salary advance to a director. So if you are giving advance to other employees, you are also giving advance to working director. No problem, right? Again, you need to go into the nuances of it. What is the quantum? What is the purpose for which it was given? Whether it is being given in the guise of giving him some. So we have to go into the root of why 185 is there and whether it would become a loan under that. This is based on an old case, right, of MR electronic components. So there has been a similar matter dealt with under the old sections. Now we saw in the section it talks about loan being given to wholly owned subsidiary. Now can a loan be given to the holding company by the subsidiary? Of course 222 you leave it, that's under income tax. We'll deal with that. But can a company give loan to a holding company? Theoretically, yes, it's possible to do it. Where there are common directors, it could be done by complying with the 185(2) requirements of getting special resolution. In this case, special resolution is what my holding company only will have to approve. He is the shareholder, right? But the loan should be used for the principal business of the holding company. It cannot be for other purposes. So this is something we need to look at. And if there are no common directors or members, right, in a private company, then even the 185(2) restrictions will not apply. You can give. Of course, subject to 222E, that's a separate matter by itself. So that is a private company and public company also. Similarly, you can work it out and give to a holding company. Like I said, simplification has not been the purpose, I think, right? Now, we saw it is paid up share capital plus free reserves plus securities premium. Now, free reserve definition states as per the latest audited balance sheet, right? So, when I calculate, I will have to take free reserves as per the latest balance sheet. But today, when I am calculating for share capital, paid up share capital and securities premium, should I take today or last balance sheet? It's not clear there, right? What if I had had an issue in between? Or can I make an issue in between and then do it to keep it within the limit? Not clear there. Then there is a bigger confusion as to what is free reserves itself. I have not even brought into it. Because free reserves also says those reserves which are available for distribution as dividend. Now, how much of your reserve is available for a dividend? Let's say if it is in general reserve, how much of it is available for distribution as dividend is itself a question mark, because under certain circumstances only 10% can be drawn. So now whether your free reserves is only 10% or the full general reserve is a grey area. We have been taking the full general reserve, but clarity is lacking. So loans and investments, if provisions have been made, right? You have loans and investments in the book already. Provisions you have made. So which value I should take? Prior to provision value or post provision value? Grey area, right? If it has been fair valued, now in the Indians we do fair valuation every now and then. So which one to be taken, right? The second is, instead of a provision, if I have written off, will it change the position? So these are again areas where there is lack of clarity on what is coming into the computation. Similarly, the third part is where there is lack of clarity, is where I am giving guarantee or security. There is an underlying loan for which only the guarantee or security is being given. So should I take the guarantee value, security value, or the underlying loans value? And if the underlying loan value has been partly repaid, fully repaid, should I change it? What should be the value taken? Not very clear, right? So I think with that, I am coming to my end of my presentation. If there is any specific questions you would like to ask, I am happy to take it. And whatever I can't answer, surely there are 3 more speakers. One of them I will request to answer, get the answer of you. Very complex, the way. I think personally I feel that the Companies Act has been made into bigger confusion than simplification. So the objective was that. Yeah, please.
The subsidiary also can give guarantee, but don't take it by another.
One fellow subsidiary for another fellow subsidiary, subject to these approvals, you can. Yeah, board approval, or if it goes beyond the limits, taking specific approvals. Assuming there are no common directors and a private limited company and all that. Subject to these, whatever limits which are there here, yes. Yeah. There are now other requirements also about disclosures, including in the CARO, where you have to mention and all that. But other than that, yes, it's possible. In fact, these are all standard being done. In fact, see what you are raising, many of these things are driving what is the big discussion happening today. I am not getting into any discussion on that. SA 600 is a big thing which is being discussed today. Yes, there are a lot of gaps, in my personal view, in what is being addressed today.
lending to a foreign company.
Sorry, lending to a foreign company. Yeah, you can with the same restrictions.
So you said about lowering of interest based on the scenarios over there. But are these basic principles of these provisions being brought in is that the income of the company should not be diverted, where you deploy your excess funds to another company and you are reducing your profits. But this is not the same way happening here because the interest rates here are much higher. Now you are diverting your fund from here to a foreign company which is also related to you, and you are diverting your income over there. Wouldn't that be affected in such?
No, that's why I was telling you, you can't just blindly reduce it because it's a foreign company. You have to have a measured things. For example, if I were to invest it into some deposit, bank deposit, nobody has prohibitions, right? For a moment, let's assume FEMA was not there. I can even deposit it into USD deposits where I will get only 2% interest probably as against 6% I get here. Why am I doing that? Because I will also get appreciation. After 5 years, maybe I will get 100 rupees instead of 85 today, right? So there is a foreign exchange gain or loss and an interest rate. So what is fair to consider in those, you can adjust and do it. If you were to take a forex hedge to do that, what will be the implication? You can consider that and do it. This is the point I'm trying. What they have basically said is, they have given the government security as a benchmark for Indian requirement, so rupee requirement. So the moment rupee becomes dollar, that rupee to dollar exchange gain or loss adjustment or forex adjustment, you can make hedge adjustment.
But the specific provision of rupee and dollar is not mentioned in the Act.
Nowhere it is mentioned.
So whatever in the transfer pricing regulations here in India, you say abroad they might question if the rate is higher. But if the rate is lower, the transfer pricing regulatory authorities question here. So how do you think you can address this?
So let's look at it in 3 parts. Tax authorities abroad, right? You have to satisfy them. Tax authorities in India. These two will be satisfied if you are able to come up with an income tax base that is US dollar denominated, say so far denominated rates you arrive at and you use it. They are both going to be satisfied. Now the only thing is whether the ROC will send you a notice, we don't know. We'll have to wait and see. My view is you should be able to win if the ROC sends this thing under 185, 186. However, it is not yet tested. But there are many companies which have given loans to foreign companies on this basis, adjusted for forex hedge differences, because that is a pragmatic requirement. You can't lend at the Indian rates on US dollar.
Can you tell the procedures to convert a loan to equity? Holding company is a listed company, subsidiary 100% wholly owned subsidiary.
You want to
loan to equity.
Holding company has given loan to the subsidiary.
Wholly owned subsidiary. They are unable to pay, so can it convert as equity?
Normally, especially in our WOS, it should be very simple to do it. If at all, there will be procedural requirements of approvals. That's all. And you are saying it's a wholly owned subsidiary. It should be absolutely possible. Yeah, please. One second. I think he's getting there.
196.1, you said there can't be more than 2 layers of investment structures. So what happens if a group acquires another group? Should the buyer restructure its investment?
As of today, yes, that is a requirement which is there. It only talks about investment companies. So long as I have even 7 layers of operating companies, no problem. So it's only about investment companies. So that is the key thing. Yes, from that perspective, you need to restructure it. Yes.
Differentiate the investment and operating companies.
Investment company is defined under this thing itself to say that more than 50% of its income comes from investments in securities and more than 50% of the assets are from investments in securities. So that is how it is defined in the Act itself. See, we have to see this holistically. You cross certain things, you become an NBFC. So obviously you have to have then registration under RBI requirements. So you don't want to cross that also, because getting registration is not easy. So with all those constraints, you can't easily become an investment company also, unless you are a CIC, core investment company, which is exempt from registrations. In such cases, you have to ensure that this is something which is looked at, that you are not an investment company. If you are an operating company, you can. For example, there are many who, what they will do is, they will also have, you see, a large number of groups have multiple layers of subsidiaries. It's only that they are subsidiaries below another operating companies. So that is clearly permitted, there is no hassle there. So only as investment company, then they have issues. They brought this for a holistic approach. RBI has given exemption from registration and regulations for CACs, smaller CACs, below 100 crores or 1000 crores, something like that is there, 100 crores if I'm right. If you don't know, registration is required. And CACs are not governed like a financing entity under a Companies Act. So to protect misuse of this CACs, they have brought this 2 layers. And essentially it all comes from a series of frauds which were noticed in the earlier time. So every time they find a fraud, they will add one section in their thought process. That's the way it has been going. If you ask me personally, the first thing, if they had said we are doing a fresh Companies Act, ground zero, that's what they originally talked about when they started in 2009 onwards. They said we are going to come with a complete thing. They should have first said, okay, how many different types of companies I want to have? Private companies which are purely family run, private companies which are largely run, private companies which are having equity investors, right? So I would have then said, instead of just saying private company, public company, 2 types, and then a deemed public company, there are many private companies, because if they cross something, there are also many other clauses apply to them, which also we don't lot of times look at. So I would have said 5 different types of companies, and then I would have said for each of these, this would be the criteria which will apply. Now, if I want to know what is applicable to IFSC private company, I will have to go bonkers, or somebody will have to write a separate book from this, or a checklist. So this is what is happening, unfortunately. And for private companies, it's the worst, because private companies is one single loose term with different criteria for different sections of being applied, or becoming applicable or not applicable. It's crazy. You wanted to do it, you should have divided 5 or 10 types of companies, and each one will have this kind of thing. Thank you. If there is nothing further, I can take a close. Thank you.
We have just witnessed a very exhaustive and interesting session. See, 185 and 186 is not an easy section to be dealt with in practice. And as he rightly said, the Companies Act of 2013 is, the idea is to simplify it, but probably it has gone into its own shell and trying to complicate things. I, for one, feel that 56 was much better, and I don't know why they tampered with it. And I read only 56 for my CA, but I had to learn 13 after passing CA. That's the situation. The only thought which was probably flowing in my mind was, if I had been doing during my CA days, how I wish Mr. Balasubramanian would have been my teacher. My life would have been much better. I would have understood 185 and 186 much better. So that is the way he dealt with it. And my hearty congratulations to him for doing a very exhaustive session on very abstract. It's really abstract, I would call it, and with Tommy intertwining and everything coming into force, and you have to read front and back and forth to understand the implications and ramifications of all this. So I thank Sri Balasubramanian very much, and I really indebted to him. And I think for our friends, the tea is ready. We adjourn for tea, 15 minutes time, and we again reassemble after 15 minutes. Thank you. On related party transactions, and the session will be elaborated and given in length by Sri Balaji, and much spoken about and much discussed about RPT transactions. Sri Balaji has 11 years of experience in transfer pricing planning, risk mitigation, documentation advisory, audit and appellate remedies, advanced pricing agreements, mutual agreement procedures, global documentation related support, guidance on complying with country by country reporting requirements. Of course, these are all Greek and Latin to me, but I'm sure Mr. Balaji will be very convincing with this. Balaji works with multinational clients involved in industries such as automobile, digital payment processing, healthcare technology, hardware and software products, alternative energy, power infrastructure development, industry equipment, etc. Balaji has advised companies on optimum management fee payouts along with recommendations on defense documentation from an audit and mitigation perspective. Balaji's recent focus is on analyzing transfer pricing implications around OECD Pillar 1 and Pillar 2 initiatives, inter-territory dispute resolution with regard to permanent establishment, related profit attribution disputes, etc. Balaji happens to be a graduate in commerce from the University of Madras and a member of the Institute of ICAI. He holds an advanced diploma in international taxation and transfer pricing from Chartered Institute of Taxation, London. Oh, that's very nice. Balaji is a regular speaker in external forums and contributes articles on various transfer pricing topics. Before Sri Balaji starts his whatever I call it, we have a pleasant task of giving a shawl and a memento. Sri Shivashankar CA will be doing this job. Pleasant job. Sri Balaji, the floor is all yours.
So, thank you so much, sir. In fact, am I audible enough? Thank you. So, in fact, it's a very proud privilege for me to again stand at this place, and I was just recollecting the fond memories of me wandering around this entire various rooms of the SIRC when I was reading. So from there till now, what brings to all of us possibly as fellow practitioners is the sense of duty and responsibility, along with the sense of confidence which also develops in each of us as we start serving our clients. So with that thought, I will possibly start the session. So idea is to keep this session much more interactive, because as much I possibly have gathered experience, each of you also be here to share your own experience and ideas to do mutual learning with each other. Now, very different ways of doing this session. What we thought of putting as a plan is we spend some time on the conceptual background on how the session has evolved over a period of time and what it means from letter to spirit. Because right from the exception getting introduced, quite a few water has fallen in. Right? There have been so many regulators who have come with specific audit observations on the so-called malpractices of companies as far as related party transactions are concerned. As client-facing practitioners, what are the key risky areas we should be aware of to protect ourselves and also the client? Is broadly the intention or objective we would want to go ahead with this session. So with that, so I'll possibly start with the real need on why we need to focus on this topic as of now. So you would have seen, one is about the section of 188 itself. Two is the larger implication from a corporate governance perspective. You see that not just the companies are pulled in, the directors, especially the auditors, have been specifically targeted on situations where companies have either failed to report transactions, two, have not been able to demonstrate these transactions have been at arm's length before audit committee and etc. So, and we happen to be the target audience when it comes to these contraventions, and hence it is important for us to maybe do some bit of more deeper understanding of the section itself. Gone are the days where there used to be one single reporting of transactions in a certain format which goes to the committee for approval. Moving on, the committee also places significant reliance on third-party reports which review these transactions and give a clear certification that transactions are fine. So hence the responsibility keeps passing on. Now, are we asking the right questions to the companies for us to get enough background of each of the transactions? Are we helping the company documenting it is becoming an issue, especially in listed companies, because listed companies have the practice of reporting these transactions once in 6 months. It is available in public domain. Each and every single line item of the transactions, in certain situations it goes to 100 line items, right? For each of the transactions, we need to explain what is the purpose of the transaction, what is the intention of the transaction, what is the effect of the transaction, and have the thresholds been met essentially from an approval standpoint. Have there been material modification to these transactions, and are those modifications also approved by the audit committee? Or very minute transaction level information which is available in public domain, and SEBI
to interrupt, they make it they upload a PDF that is you cannot read at all.
Exactly. So in fact we also are given to understand that the MCA and SEBI are working together on how they can integrate this with the income tax and the CBEC portals also, so that there is effective exchange of information across all relevant stakeholders. Now the point here is, one is about appropriateness of the reporting structure itself. Who is a related party? Whose responsibility is to identify a related party? It is company's responsibility. It is not the auditor's responsibility. Point one. Point two. A related party transaction, right? Whose responsibility is it to identify that this is a related party transaction? Again, company's responsibility, not others. We are here to help them identify it, put a process in place. So the process is supposed to govern the entire structure itself. Now, many times what essentially happens is there is always this passing of buck between companies and auditors, where this thin line of difference is not really felt. So we also see that apart from the penal consequences, there is significant credibility issue in public domain, right, which comes up, and I will take you through 8 specific case studies which are essentially outcome of SEBI's in-depth investigation on some of the related party transactions, and it has hit the biggest of the biggest companies essentially. So we can try and relate to it as to what is going on. But most importantly, what we are speaking is where we are currently. There is also a larger implication on how it could hit us on other angles also. I'll discuss about it also in some detail on how it can impact income tax, how it can impact GST, etc. etc. It's essentially one virus which can hit us from multiple directions. So idea is to broadly have this as an objective for our session so that we can move on. Two key essentially watchwords for this compliance is, one is transparency. Like our earlier speaker was also clarifying, high courts also look at situations where companies upfront go and disclose information and seek compounding, rather than this getting identified in an investigation and then going on, because that's going to be much more versatile. So is there, every company has a process of transparency to start with, one. Two, do they have a rounded 360-degree view on the implications of reporting from a compliance, from a governance standpoint? So transparency and corporate governance happen to be the two key watchwords as far as 188 is concerned. So with this, we'll move on. Like I mentioned, we'll start with a very traditional discussion of how the section comes up, and slowly we'll get into how the section has actually evolved. Now, does it apply to all companies? Yes, the answer is yes. Of course, the private companies have been exempted. If they are subject to certain conditions, we'll deal with it. But the fact is, the section clearly also talks about a situation where the transactions have been specifically identified as RPTs alone need to be factored in 188. Now, as we go along, I'll explain, there are 3-4 key baskets for us to focus on. There is a section 177 which talks about an audit committee approval, which is actually independent of 188. 177 does not have a mention of 188 at all. And the background or the ramifications of 177 non-contravention is much more bigger than 188. 188 I would possibly say is a much more watertight section, which clearly has very 6 categories of transactions as related party transactions, and it has got certain exemptions as well. Now, in private companies also, if a holding company, subsidiary, fellow subsidiary or an associate is a public company, then transaction in private companies also will need to be subjected to 188. So that is one. And two, a private company which is a subsidiary of a company which is deemed to be a public company is also not exempt. So these two are very specific conditions when we look at it from a private company exemption perspective. Now, as you can see, this is a very typical chart. The way related parties have been articulated in section 188 is twofold. One is at a company level, the two is at a management level, right? Company level is a typical hierarchy structure. What we see, there's an ultimate holding company, immediate holding company, direct subsidiary, indirect subsidiary, associate, fellow subsidiaries. This is something which we are much familiar with, right? And possibly here, one other condition is transaction between a company and its when a holding company and its wholly owned subsidiary is essentially exempt, given the background that essentially it's left hand to right hand. So you cannot make profit from yourself, right? So they have recognized the concept of principle of mutuality, where you will not be able to benefit from yourself, hence they have exempted. And again, I am talking about only from 188 perspective. Now, at a managerial level, and this is important, we need to spend time here.
Exemption from approval.
Sorry?
Exemption from approval.
From, yes, 188. So moving on, at a management level, you could see that there are quite a few baskets here. We'll deal with it one by one. Directors are the relatives of a company or its holding company. So our client is a company A, right? Directors are relatives of company A, or directors are relatives of company A's holding company, right? So these are identified as related parties as per 2 subsection 76. That is one bucket. 2. KMP are their relatives or its holding company, which is again a director or a manager, right? Anyone who will be able to place executive strategic focus on their tactical and commercial and strategic operations of the company are identified as KMPs to that extent. This is extremely important. Any person on whose advice, direction or instruction a director or a manager of a company is accustomed to act unless given in a professional capacity. Our earlier speaker was extensively discussing about that 2 terms. One is accustomed to act, and 2 essentially the professional capacity. There are situations where companies, and for that matter even listed companies getting operated by single individuals, right? They could have any background for that matter, but they will essentially be not in roles at all, but they will essentially be dictating terms in the operational decision making as well. So those are identified as related parties, and I will I will also spend some further time on the civil ODR specific amendment which has happened also, which has been clearly targeting this area with what they call as promoter or promoter group or promoter interested companies. So SEBI has also realized that this portion of the section has been very redundant. It has not been operative at all. So they have given further guidance on how they believe there could be a mechanism where they can track these people who are essentially currently off the record. Right? And last but not the least, the body corporate MD who is accustomed to act in accordance with this is there. Now, does the company have a process to track all these entities to start with? Now, whose responsibility, right? So, more often than not, due to SEBI LODR, listed companies at least need to currently tag all their parties. There could be some 10,000 vendors and 1 lakh customers, etc. They end up tagging all these parties in their ERP itself, what is a related party, what is not a related party, and secretarial team maintains documentation and keeps tracking this, because today a related party could become a third party tomorrow. A third party can become a related party again. They need to have a very consistent policy where they will be able to track this and update their systems, because again, unlike Income Tax Act, Companies Act has very little guidance, like our previous speaker also mentioned. There has not been much, I would say, precedences on some of these practices. So it is again the duty of the company to put this on record before the audit committee, that they have a consistent process of tagging these parties and keeping this, for example, a director who may possibly resign later, right? The transactions which the company has with the director when he was a director and with the same person when he is not a director, does the company have even a practice to follow those transactions? Are nuances which come up as and when we get into details. Now, of course, firm, private company and public company in which director, manager or its relative is a member. So essentially, you can visualize in a typical income tax provision we talk about lineal ascendants and lineal descendants, right? So this is very similar to that in terms of the length and breadth of the coverage of the parties, where the whole purpose is, can a person be able to influence the transactions and accordingly indulge in profit shifting between companies. Now the larger intention, at least in 188, is you may have so many related party transactions. 188 doesn't attract all of them, but every related party transaction can be only with a related party. So focus of 188 is to ensure your related party list is updated, and as and when transactions keep happening with the list, essentially the idea is to track it. So once there is one common tracking mechanism, you can pull in the data required for 188, you can pull in data required for 177, you can pull in data for civil ODR, you can pull in data for income tax, for GST, connected person. Definition of related party is very different in every single scheme. In AS 24 we will talk about control, which has again not been defined. So 188 is a much more tighter version, like I mentioned. Civil ODR is much more vaster provision from a related party perspective. So looking at all these seemingly contradicting provisions, the intention of the company will be to ensure that they have a process in place to start with, which has the most widest coverage ever possible, considering the definitions of all these provisions, related party provisions across the 7-8 regulations, and then have the process and then start pulling data for reporting purposes. So first comes a related party definition. The party definition is of key importance. This will come only from the company. A promoter is not going to essentially tell where he is holding investment. He has to come up and give a declaration. In fact, institutes have come up with guidances on how the declaration can happen, etc. Unless until he is going to say, we will not be able to infer anything about it. So then once he is saying that I am invested in 1, 2, 3, 4 entities, then my responsibility is to ensure that whether my transaction with those entities will be tracked or not. So essentially, again, I am re-emphasizing, but the focus will be on the related party identification to start with. Once that is there, others are just a consequence. Does it apply to foreign companies? The answer is yes. The underlying intention of the Act does not seek to exempt transaction foreign companies, so in the ordinary course is getting attracted as part of the 188 complaints. Now, like I mentioned, this is the watertight section 181 which talks about which transactions identifies related party transactions. Sale, purchase or supply of any goods or materials. So here if you see, it doesn't necessarily talk about service in this provision, right? And it talks about goods or materials. So here the point is, what can be a good? Share. Share once allotted becomes goods, even as per GST and other provisions. Debenture, before allotment it is not a good, so it is not covered in 188. So that is how the government has essentially looked at this definition. A very older definition. Ideally it should be revisited, given the context that India's 24 has revamped its entire definition and SEBI has revamped its definition. Ideally this section should be reworded. If you look at the other ones, appointment of agent for purchase, sale of goods, service, property. Here the mention of service or property is there, which you would find it missing the other one. Selling, buying, disposing of property of any kind. At least here they have clarified that property of any kind could be tangible, could be intangible, etc. They have clarified that portion. Leasing of a property. So leasing of property essentially is a typical lease arrangement what we see. There are possibilities where there is a license limit arrangement where a person will be allowed to use an asset. That doesn't qualify as leasing. So that is again not classified under 188(1). But it is a related party transaction, hence covered in 177. That's a different point. In 188 it is not covered. Availing rendering of services directly or through appointment of agents. So this is the other one. Appointment of related party to office or place of profit. Appointment itself is a transaction. And the fact the remuneration need to be fixed to this person also is something which is a bigger subject matter of discussion before the audit committee itself. Underwriting a subscription of securities and etc. This is one typical one. Like I mentioned, corporate guarantee, I am just giving examples. If you see corporate guarantee, it is clearly defined in 185 and 186. The previous speaker also touched upon it. It is specifically excluded in 188 because 188 does not cover anything to do with financial transaction. But it will be covered in 177. So, audit committee as per 177 needs to look at corporate guarantee. It need not be looked at by 188. Is the literal reading of the provision. Again, there is no guidance to it. If you look at the Institute of Company Secretaries, they have come up with a 100-pager guidance on related party transactions, overview, compliances, penalty disclosures, and etc. Other than that, there is no formal guidance essentially on 188. Now, as we see all this, we spoke about identifying related parties, we spoke about tracking the transactions, but what are we doing essentially with all that? What is the purpose? Like I mentioned, the purpose is, in a typical related party transaction, there is lot of scope for siphoning of funds, right? Lot of scope for profit shifting, which can go to essentially the relatives or members of directors and etc., which is clearly against the corporate health of the organization. So idea is to track situations and have a process in place and to demonstrate that the terms of the transactions are the same as how it would have otherwise happened in a third party situation. If Madhu is my brother, so I am going to sell him goods at say 100 rupees. In ordinary course, I would have possibly sold it to Mr. Balaji at say 120. Right? Here I am essentially able to push the money of 20 rupees to him, which is an advantageous position which is against the intention of the company. So how am I able to demonstrate this to the audit committee, who has a responsibility of pre-approving the transactions? I will come back to the term pre-approved in a minute. But this is essentially the intention of 188, to track and have a governance in place. Now quite a few aspects which will also, like this is something I discussed about, so I am skipping. Now like I mentioned, 177 does not talk about 188, but there is a specific approval or a subsequent ratification of all transactions, including financial transactions, whether in the ordinary course or terms. And I am just trying to build iterations to the discussion. The fact that 177 has a larger responsibility, and the audit committee in most cases, these days all sizable companies have audit committees. Audit committees essentially have an independent director who is going to look at the transactions, audit committee chairman who is going to ask for the details and stuff and etc. So what is essentially becoming also, which used to be practiced earlier, is committee used to give some recommendation. it should be okay if the transactions align with third party situations. Company need take care of it. That used to be the earlier wording. Now the current discussion is, since the committee approval notes are available in public domain, SEBI has looked at it and come back to say there has been a specific approval. Specific approval will be after testing the terms of the transaction. There has to be a study to demonstrate why you have sold it at 100 and not 120. The answer to that question should be there in the document, and the committee need to take it on record and then approve it, and accordingly the transactions should go by. So there used to be some school of thought to say they have not clearly defined pre-approval. Approval can be post-ratification within 3 months and etc. But essentially the other school of thought, and again coupled with the SEBI LODR, that school of thought essentially has lost its relevance because LODR requires pre-approval of all transactions. So to that extent, what is essentially important is you need to first budget the transaction, and the transaction need to be subjected to the arm's length testing. The analysis need to be put in front of the audit committee. They need to ask questions, the company need to respond to it, and then comes the approval process. So if you actually need to do an investment in a company, it has to clearly take 3 months, purely from at least a governance standpoint in terms of putting the process in place. So this is a quick chart we have tried to put together on what are the essential approval processes in place. Once we do a later party transaction, like I mentioned, the audit company needs to approve. Now, when I say that it needs to approve, it has to pass through 2 tests. One is the test on whether it's an ordinary course of business. Again, previous speaker touched upon it. The term ordinary course of business again is not defined. We just draw references from the standards of auditing and from Black Law Dictionary and from various judicial precedences of NCLT and few other high courts and supreme courts from an income tax perspective also. Very simply put, Black Law Dictionary defines ordinary course to be in the normal course of an operation, and when it's a normal course of operation, it will essentially have to find place in the MOA of the company, inextricably linked to your fundamental course of action in terms of generating profits for your line of business. That's one single starting point. A few situations where it passed the first test, but it passed for further subsequent tests, NCLT has rejected the transaction, saying that it's not in the ordinary course. So hence, we have 6-7 conditions which are generally accepted with ordinary course of business. Routine transactions, for example, branding, taking premises on rent, any activity which is very repetitive, vendor payment essentially for some services which is going to flow through the year of income, right? And any other transaction which is very common to a particular industry, say for example in automotive, developing a die or mold for a capex for further manufacturing is a very typical practice, and that happens with sensitive vendors and who happen to be group companies, because you cannot divulge your IP outside the group, and hence this becomes a very typical transaction within the industry framework, and hence it is accepted with arm's length. Now there are few items also which also talk about the fact that whose responsibility is it to ensure that the transaction is ordinary course of business. It has been clearly specified in 177. It's the audit committee's responsibility to ensure that it is an ordinary course. It is not company responsibility. Company can only put across its justification as a board note to say that this is how they believe. The committee can question, and ultimate onus will lie on the company. By tomorrow penalty comes, director is responsible. He will also be thing, but the primary responsibility is with the audit committee. Now, while this is what it is, yeah. So there are transactions which are clearly identified as not in the ordinary course. There is another list which is there in the standard of auditing. We will discuss about it. This is SA 550. Complex equity transactions such as restructuring or acquisition, which is a one-off transaction which essentially happens. Transaction with offshore entities with weak corporate laws, essentially companies which lack substance, Cayman Islands, for example. Right, transaction with unusually large discounts to customers. So it gives you a flavor that possibly there is possibly a quid pro quo with a particular customer, which will possibly lead to passing on the money back to the later party. So that's the other one. transactions with circular arrangements, it do happen. I do a sale with a commitment to essentially get a discount from a rated vendor at some point in time later. It's essentially a circular process. SEBI LODR, while coming up with its related party transaction guidance back in November 21, has given very specific case studies with diagrammatic illustrations on what they believe could be circular arrangements. And it talks about financing arrangements, it talks about the discounting patterns like I mentioned, which is also a very good useful read in this context. Transactions where contracts are changed before expiry, and this eventually happens when you do internal audit. We will identify that the terms keep changing at the last day, right? Just to give a flavor of further discount, which gets passed on and then gets knocked off, teaming letting essentially. So these are clearly identified as not in the ordinary course of business, and hence the first responsibility for the audit committee is to convince themselves that it is in the ordinary course or not in the ordinary course. Now, while we come to this chart, we also discuss about the other term, which is the key term, which is arm's length. So, like I mentioned, there are two cumulative conditions. One is the ordinary course test, the other is the arm's length test. Now, the term arm's length, again, not defined in Companies Act. We place reliance in Section 92 of the Income Tax Act, which is clearly having a much more detailed articulation on the provisions of arm's length itself. So, Section 92C of the Act defines what is arm's length. Essentially, to put it in simple terms, the same example, the price at which I sell to Mr. Madhu of 100 and the price at which I sell to Mr. Balaji at 120, the reason for the difference is not the fact that I am related to Mr. Madhu, it is possibly because of some business commercial reasoning. And what is a business commercial reasoning? If I am able to make a specific economic adjustment to it, and if I make the adjustment, it happens to be 120 in both cases, then I am able to demonstrate that it is an arm's length. Now, if the company is able to have a backup plan or arm's length study based on this, I'm oversimplifying, each transaction category may have a very different testing practice, but if the company has a plan or a benchmarking study which demonstrates the transaction arm's length and also able to prove that it's in the ordinary course of business, hence the accrual is exempted. So that's essentially the long and short of the provision itself. So I thought I would put a quick complaints matrix here. It's as you see, it's a matrix. There could be combinations, and like I mentioned, accumulative satisfaction of those conditions alone will exempt the approval. Otherwise, in the other three possibilities, we will need to have an approval. So one is about the audit committee itself, but most importantly, considering the fact that some of the transactions could be extremely material enough, there is also a requirement to go before the shareholders' approval. There are again very specific thresholds laid. One is about the paid up capital of the company itself. The second aspect is about transactions exceeding specific limits. As you could see, we talked about 6 different categories of transactions for 188.1, and there is a specific material threshold for each of the 6 transaction categories. And very simply how it happens is, once you look at the nature of the terms itself, you could identify whether it's an ordinary course or not. So, say for example, appointment to any office or place of profit, right? The compensation is more than 2.5 lakhs per month. Now, essentially, if that happens, appointment essentially happens, and that person happens to be a relative of the director, right? It is clearly also clarifying that it is not in the ordinary course of business. So the approval process just gets kicked in. So one is about looking at the numbers itself, 2 is about looking at the story behind the numbers, asking the relevant questions so that we will be able to tell the company on which category of transaction the approval process will kick in. So that's about it. Now procedural stuff I'm just skipping this for the sake of want of time, but consequences of non-compliance, directors to indemnify any loss where transactions are with directors or related parties of directors. Again, we have live situations which we'll also deal with, where there have been significant loss to the company's cash reserves because of some wrong mispricing of the transactions, and the money has gone into directors' related parties essentially, and we have seen listed companies falling down for the same reason, and hence we should be conscious. fine is about 25,000 to 5 lakh, imprisonment of 1 year or both if it's a listed company. And essentially the company and its shareholders can initiate recovery of losses from directors or any employee who had entered into unauthorized transaction. Any employee is what they have defined. It's again pretty wide open. So hence the reason that the approval process before audit committee needs to be crystal clear. There used to be situations where the approval just will be a one pager, related party will be mentioned, nature of transaction, any of the 6 categories, there will be one blanket number which will be mentioned, and once the number is closing or getting closer to the budget number, it will just be approved by say 20%, 30%. That will not fly, because going forward SEBI is looking at line item wise, nature wise transaction approvals, and if a specific transaction they are looking at very closely, and omnibus also very particularly, because they believe that the omnibus provision itself, the 1 crore approval process has been significantly tampered with, where because omnibus also will require the related party to be identified, the terms of the transaction to be identified, the purpose need to be identified, and it should not exceed 1 crore. The approval processes earlier it just used to be one pager with one single line. It never had this level of information. Now SEBI is getting into all of this and asking for specific level of information. All omnibus approvals specifically are getting targeted from the approval process. So might as well have this information in place. And SEBI is also planning to get into the SAP access of companies where they are able to track real time the approval. For example, if the approval limit for say a purchase transaction with say company X is say 100, if the company essentially transacts to say 110 and just changes the budget later in the system, right, it will have an audit log. SEBI is now looking at integrating its access directly to the SAP process of at least major companies to track when the 10 rupee got amended through the audit log. Right, because earlier it used to be just a manual thing. In the subsequent audit committee meeting, there will be a rectification. It's the 100 should have been read as 110. Used to be mentioned, and then people used to go ahead with it. So there is going to be real-time monitoring, and hence the potential of non-compliance in this area is much more brighter unless until we have automated processes. So few systems as well. Existing contracts. If there are modifications to existing contract, should it be approved? Yes. Every single material modification to the existing contract need to be approved. We spoke about share issuance. At the first material instance of issuing shares, it doesn't qualify as good because it has not got allotted. As and when the share gets transferred, then it's already a good, and hence it is clarified in 188. For similar reasons, even rights issue and buyback are not captured as part of 188, but it is considered as transaction in other provisions. Yeah, this is the other one. Meaning of the terms or phrases accustomed to act with and given in professional capacity. Given in professional capacity again is a very loose term which again gets exploited the most. A person could be a director and he possibly call himself to be a chartered accountant. He may get compensation for his so-called other consultancy services, which may more or less essentially align with the strategic objective of the group itself. So it is a very thin line of difference, and hence it is advisable for a director not to provide any professional advice in other capacity, because he is again prone to significant penalties and non-compliance. And there are very typical aspects which come up, which are very grey areas. Frankly, companies should not be subjected to this hardship, but it is yes. In transfer pricing, we have a provision called deferred receivable, which is if I am a software company, I do a cost plus 10% markup. I need to collect the money within say 60 days, which is the normal market norm from a group company. I don't end up collecting it. It happens to be say 90 days. The tax officer comes up to say that, boss, no, I will recharacterize this deferred collection of 30 days as a deemed loan on which I will levy interest. Now the discussion which is ongoing in a boardroom is, while I have a very strong defensive position on why I believe the 60 days could not be met because there was a dispute between me and my group on whether it is payable or not, the audit committee is now concerned. If there is an income tax scrutiny, they believe that they have actually approved a transaction which is not in ordinary course, which is not an arm's length. So they are actually pushing the companies to voluntarily go and submit to SEBI to say, sir, this is a mistake I have done. and kindly don't levy penalty. So that is the heights at which audit committee is now thinking for even a genuine transaction, which is again very much arguable and defendable before income tax authority. There could be multiple other discussions like this. So suo motu adjustments. What we see is before we close books, transactions essentially may not necessarily sit with the same transfer pricing policy what the companies would have agreed on April 1st. So there happens to be suo motu adjustments also before the books gets closed, so that the issue is put to rest. Now, are all suo motu adjustment cases deemed to be not at arm's length during the course of the year becomes a question. Now, it can be clearly explained that there could be business reasons why the policy could not get followed, but the audit committee is becoming extremely cautious and they are not allowing suo motu adjustments, and the started debtors and companies are finding it very difficult to pass entries to correct the pricing, because the committee believes that they have actually led the company, they have not been able to monitor the company's progress, etc. These are very typical aspects which come through. So the focus currently is to keep monitoring the pricing on a monthly basis rather than a year-end basis, so that you avoid the suo motu adjustment itself. So with this, we thought we will put rest to 188 discussion to start with, maybe hear some questions and slowly get to the other practical aspects and case studies what I mentioned. Any questions till now?
This deferred receivable.
Yes.
Elaborate. Suppose earlier years we never realized that we are giving the external the credit more than what we are giving in the ordinary course. But now we realize that we can charge interest for this year.
Yes, in fact, income tax act is very clear. I cannot recognize any contingent revenue. I need to have complete certainty that I will receive the money at some point in time, etc. And more often than not, we don't actually see why you in a purchase order you will mention that I'm going to levy 24% interest, which even we do to our clients to say that I will levy interest. Who in a normal ordinary course can levy interest to a client? So the fact is, again, I'm at arm's length. Am I behaving on the basis of same terms as I would have possibly dealt with a third party? Is the test here, principal test. So if I don't charge interest to third parties, naturally I will not charge to later parties also. Some of the aspects is that I end up having both purchase and sale transactions the same party. There will be a lot of knockoff. I might have possibly received an advance for 1 year, right, without interest, towards a future supply of materials or services. Right? I may have possibly offered some smaller service for which I would have not have received money within say 60 days. I'm going to receive in 90 days. Effectively, you should look at the net credit period. Right? So net credit period would look like that I should be actually paying interest to the other guy by virtue of the advance itself. Tax authorities don't look at it that way. They are more very siloed, and they would only look at the difference between 60 and 90. A few further cranky approaches could be that fact is my transaction possibly would be at a USD, but the tax officer is very used to an SBI PLR. So a transaction which is fundamentally in a foreign currency, the officer would want me interest in INR. So which is a very significant number. That is one. Two, he for his own interest believes that the money need to be collected in 30 days. Now, even if you look at comparable companies, their credit period possibly could be 90 or 100 days. He doesn't look at it. He says, if you are operating in India, you should receive money within 30 days. That's one. Two, like I mentioned, the interest rate itself. Three, he disregards the knock-off impact between purchase and sales and advances and stuff and etc. Four, and most importantly, he believes that the transaction be recorrected as a loan, which is a larger issue from a company's perspective also, because it was never intended to be a loan in the first place. It is a normal principal transaction which is a running account essentially, which I will be able to show as a ledger, but the officer doesn't realize it. So few of these discussions keep happening, and heights of it, I again mentioned this in this closed room. There is some key dispute area on transfer pricing. This is called advertisement, marketing and sale promotion expenditure. Some of you would have heard about it. So multiple, we are the Detroit of South Asia. To that extent, we have a lot of foreign automakers operating in Chennai, and these entities essentially spend tons and tons of money on creating market visibility for their product, essentially. And easily it could be, clearly 6 or 7% of the top line. Assume the top line is 10,000, clearly they'll spend 7% because that's the only way they'll be able to differentiate. So the purpose is to actually incentivize the sale of their product, but the department believes that they, by creating advertisement and visibility for the product, are also enhancing the value of the global brand. The brand which has been existing for 200 years. Company came only yesterday. Department believes that the Indian entity is developing the value of global brand, and hence they want the Indian company to recover the advertisement cost along with the market. And there are nuances to it, multiple approaches. Delhi follows one approach, Bangalore other approach, Chennai different approach. But this is a dispute. Now, if it happens to be a listed company, and we have had this discussion, the audit committee wanted us to clarify as to why this is near arm's length, why it is in the ordinary course. You give me an explanation. Our only point is, boss, this is not a transaction to start with. The advertisement essentially happens with a third-party media house. The company is demonstrating the product features of the car which need to be put in the public domain for advertisement. It is a third-party transaction. It is not guided by the group because India is a very unique market. The advertising patterns need to be decided by the company. Ultimately, if the company makes money and generates revenue and profit, is going to pay tax in India only. The money is not going to flow outside. There is clearly no reason why there should be a profit sharing mechanism. Now, the same issue in the case of Maruti Suzuki is yet to be heard by the Supreme Court. We were told it will be heard in October 2015. Now we are in 24, not yet heard. So the fact is, few of these income tax, few of these GST issues also come up before the audit committee discussions, and they are extremely fugitive, and because rightfully so, because they are not glued into our income tax way of looking at things. And whenever there is a transfer pricing dispute which arises, their first concern is whether it's in the ordinary course, whether it is an arm's length or not. They are not able to understand that this is not even an arm's length discussion to start with. So it is not even a transaction with a related party, and hence need not be looked at all, is something which the committee finds it difficult. So hence the reason is, companies again need to have documentation to demonstrate that group does not have a role to play, and even in terms of deferred revenue expenditure, better to have emails on record to say that this invoice is under protest, it's under discussion, and hence the payment is not released. Other invoices are flowing, only this invoice is not, and hence it is a mutual negotiation which is a push and pull impact, which is how genuinely it will happen even in a third party situation. So that character is again getting demonstrated in this situation is what the companies should be able to explain and clarify. So I hope that this clarifies.
I have two issues.
Yes, sir.
One from the point of view of disclosure in the balance sheet.
Yes, sir.
Okay. The balance sheet says transaction with related party. Okay. So the question is, even transactions which are within arm's length need to be disclosed, or transactions beyond the arm's length it needs to be disclosed. That is regarding printing. The other thing is relating to control issues on internal audit. I came across, of course, when you do internal audit, you take up certain areas in a phased manner. One of the areas which has been taken was on logistics.
Okay.
Okay. It was found by the team that certain logistics portion, transportation, outsourcing of transportation vehicle has been given to somebody who is related to the director, full-time director. Of course, that we found out by way of control process by doing a verification of audit. Now, this has been going on and it has not been reported. Now, what is in this situation? What is the duty of the internal audit committees which are supposed to review RPT? I understand that they review RPT only at the time of a fresh transaction when the agreement comes into their purview. But this has been going on without it. So, what is your view? What can be taken? How do we rectify what has been happened already, and with a safeguard for the future?
Sure. I'll take the two questions in two parts, sir. The first question, whether we should report all transactions with or related parties in the financial statement, the answer is yes. Regardless of whether they are at arm's length or not, the India's provision on even otherwise IGAP will require all transactions need to be reported. That is one, including the balances, debit credit balance of all the transactions. Now, even if you look at the debit credit balances, it typically happens vendor wise or customer wise. It doesn't happen transaction wise. At least our accounting provision is also not very clear about it. Ideally, it should be transaction wise, but it doesn't happen. But at least the disclosure should happen. That is one. It is the responsibility of the company and a joint responsibility possibly of the company and also the audit committee to put it to the arm's length test. And if there is a need for correction, price correction, it need to happen before closure of books. So that is the other part. Now on this same position, there have been few related party transactions get missed out as part of an like Sir mentioned, there have been situations also. Whose responsibility is it? Of late, if you see the very recent resignations, right? A related party disclosure happens to be a reason why auditors are resigning. They are saying that companies don't have even a process to monitor the related party tracking, transaction tracking, and hence that is one key aspect. But the most disheartening what we also see is SEBI has penalized stat auditors for not looking into related party transactions. It's not even the responsibility of stat auditor primarily to start with. The company should be able to come up, but stat auditors are getting hit. Now, Sun Pharma again is a very key example. One of the parties were not identified. That entity happens to be an entity which is related to the director of the company. And the company has not identified this related party and the transaction has not been identified. SEBI has put in the director and of course the auditor has also been penalized for the same thing. So this control issue essentially should happen at a company level. The only saving grace possibly is if the company is able to upfront go till SEBI and MCA through a clarification to say that this has been an involuntary miss. In good faith we are coming and telling you that this is transaction happening. At least in SEBI there is a half-yearly reporting is possible. If you missed in the September, you can at least factor it in March to say that I have tested 12-month transaction, I have reported it also, etc. But if it's a financial closure, that's a problem. We will have to bring it to the notice of MCA and make adequate disclosures also to demonstrate that the transaction is at arm's length. So that's a good faith provision. But most importantly, do the company has a process in place? Is becoming a challenge. It can be only automated. It cannot run manually for a company who is doing transaction on a daily basis, right? It can be only be automated. And current SAP versions are essentially matured enough to handle these complaints by themselves. Quite a few the finance teams are not even aware of various modules which are there within the SAP itself. Related party transaction mapping module is an automated feature in SAP, which mostly gets deactivated. So once we get activated, and that can throw up monthly exception reports, like how we see a debtor aging analysis. A related party transaction analysis can be a very default exception report which can come up for various MAS purposes, like how we are tracking revenue, profits and expenses. RPT also need to be MAS reporting or exception tracking process, which can clearly happen, should be a responsibility of the finance team. And of course the secretarial team, because both of them are joint custodians or stakeholders for this activity. So with this, yes sir.
Am I audible?
Yes sir, loud and clear.
I just wanted to know this, like there are two entities which are not, like they are not public entities, they are limited companies. Both and one is a principal company, one is a subsidiary company.
Okay.
So does this omnibus, if they are going to have transactions between each of them, both the boards have to clear the omnibus transaction, or audit committees have to clear the omnibus approval?
So if it's a wholly owned subsidiary, it is exempt.
Yeah.
Even otherwise, yes, of course, both of them, because it's a transaction on both sides. So there is no principle of mutuality or reciprocity in 188. It has to be on both sides.
It has to be on, and that is only for listed companies or unlisted?
Even public, every company for that matter. Only private company is exempt. Every other company need to comply with it. Yeah.
And suppose you take an approval for X amount of money, but it is exceeding that during the course of the year, or at the end of the year you come to know that it has exceeded the limit, then what is the...
It's a contravention, clearly. They should have ideally anticipated that the number is going to reach to the budget. They should have got a fresh approval, essentially. If that doesn't happen, it is a contravention. But it is not necessarily a very strict penalty risk, I would say, if the company is able to voluntarily go and notify MCA to this extent. And the committee need to be abreast of it, and there has to be business logic also which need to be clarified on why, what's the reasons. Quite a few times, just the tax number itself, since GST itself is 18%, the approval actually happens including the tax impact. So there could be smarter ways of handling the budget number also. Let it be excluding tax and stuff like that. It could be wordings which can be used. But the other problem is, if you do a purchase and there's a discount, do you look at the gross number or should you look at the net number? The clarification is you should be looking at the gross number, and hence you cannot play around with that.
That is inclusive of GST or exclusive of GST?
It is company's position. That is not laid in the provision. The company need to be clear when they were to get the budget that it is excluding a tax provision, because tax essentially is a government levy. It is not part of a transaction price itself. So to that extent, they should be able to clearly caveat it out and then say the budget is excluding the tax portion. Yeah, thank you.
So one question on so there is a transaction for which I am recovering or I am charging. There could be transactions which I don't charge at all.
Regardless of whether value is put to the transaction or not.
I mean,
it's a very clear SEBI guidance on that. I will come to it.
Because yesterday I was looking at a CP even for related party. They were telling this like a control issue. The typical case is like there is a corporate office, so many promoter firms using the same corporate office. We don't know what.
I'm coming to it. To that extent, I have not seen even listed companies gearing up to this requirement. Leave alone the other companies. They have no clue of whether this is an issue or not in the first place. Practically, yes sir.
Party becomes a reliable
During the current year.
What happens to the existing liability?
Just like how it is not clearing income tax, it is not clearing Companies Act also. At least in income tax, at least in section 92, we take a view that since it is not abundantly clarified that once you become a related party, only post that transaction need to be reported or not is a position which is not clear. We have views on both sides, at least from a precedent standpoint. But at least in Income Tax Act, we are saying that during the first 6 months when he was not a related party, it was naturally a third party price. And hence it's a naturally at arm's length. There is nothing for me to test. And the same terms get carried over in the subsequent 6 months also when he becomes a related party. Again, the terms were decided when he was a third party. So the same terms are continuing, and hence it's also naturally at arm's length. This is a position we take. Orchid Pharma, Chennai Tribunal has accepted this view. There have been divergent view also. In Companies Act, I will tell you the problem. Sometimes it becomes extremely difficult for us to believe that in the subsequent 6 months the pricing would have been the same, because when the acquisition happens, the company clearly knew that it's going to happen beforehand, even in the first 6 months. So there possibly could have been some manipulation of pricing, which is something which is very fair for us to envisage, and hence it is better for us to report all the 12 months and have your English written to say that this is what it is. It's extremely difficult to defend only the latest 6 months information. So with this, we are slowly moving to practically how this later party transaction is getting filled at a larger listed company perspective. Some of it are clearly borrowable even for other companies. So we thought we would spend some time. Like I mentioned, the coverage of RPT is the most widest in SEBI LODR. We talked about Companies Act, and the start Ind AS 24 essentially is again which is known to us. Income tax is section 92. Again, it's a very interesting thought which I thought I will share with this forum. The recent addition to the income tax website, which talks about transfer pricing, yes, very proud. We have a section of transfer pricing now. It essentially clearly goes against the settled principle that section 92A 1 and 2 need not be read harmoniously. It's a settled principle that a company need to have management, control or capital, and there have been 13 deeming clauses which goes to show that there could be management or capital. It's a settled position again to say that just because a bank is lending you money which is more than 51% of your book value, HDFC Bank cannot be becoming a related party. It is a commercial organization. Otherwise, then every company to whom it is lending will become a related party. No? It's so absurd to. So hence the clarification that has come up in various high court decisions is to say that HDFC Bank will not be an AE because it is not going to get into your management, control, capital, transactional, operational, strategic decision making is left to the board and the company shareholders, etc. Hence it is not a AE, it's a settled position. Income tax website now says that HDFC Bank is an AE. Now, seemingly much more watertight provision from a related party definition perspective has now become widened because of this confusion. So I'm just giving examples, there could be much more to this. So that is about it. Ind AS 24 is a much more, I would say, more complex because it just says control. Again, the term control is not defined. Is it fiduciary control? Is it passive, active control? And how do you demonstrate control? And in fact, in civil law, there is again a very specific discussion on control itself, not defined again. So while we see seemingly civil ODR has the most wider coverage from a related party version, a related party transaction definition, we will discuss it with it in detail. But largely, if you look at all of the provisions, the purpose is to ensure that the transaction should be interest of the company and the terms and conditions should be not necessarily unfavorable compared to the transaction with third parties. That's the underlying objective of all these provisions. That is very clearly articulated in all the provisions. But having said that, each of the provision has a very different standard of reporting, different timelines for frequency of reporting, data sets are different and hence has to be only automated. So that's becoming the larger point. Companies are focusing on the existing processes and they are also now mature enough to understand their data flows to various tax departments. And all of us would have also been looking at the GST, growing insanity of GST investigations. Just because the GST revenue in the GST return didn't tie up with the revenue numbers mentioned in the financial statement, GST went ahead and did an adjustment. It was some 4,500 crores. That's the value of difference effectively. Because for such a company, there could be so many differences, right? So the company is now very concerned on what they will need to report as a related party transaction. They don't want a situation where the difference is getting attributed to related party transaction, because more often than not, a related party happens to be a residual interest area in an entire audit. So auditors, companies have one big number, they will think what to do, they will finally put in related party course. That's going to be a residual. One schedule which is always out of audit is related party schedule. Auditor will say, I rely on company. Company will say, I will rely on auditor's process. So the problem is, since that is a residual provision, all these income differences also happen to be in related party provisions. And tomorrow when it goes to transfer facing audit also, the ledgers will clearly show on big numbers of 300 crores, 400 crores. God knows what it is. So, and the GST is going to come back to say what it is. They will have to essentially say it's discount. Then discount on GST and also. So, these are evolving trends which come up from a disclosure perspective and you cannot avoid this. Like Sir mentioned, every single value needs to be reported in the annual financial statement. You cannot escape it. Once you put that number, then you will have a basis to it. And 2, 133.6. Company is actually checking the same value with the counterparty also. You are claiming purchase is 100. He is claiming his essentially sale is only 50 rupees. What about the balance of difference 50 rupees? Can it be delay in accounting? As big as 50%? No, right? So there are few instances which come up and hence the larger point. At least in listed companies, what happens is company A reports say transaction is 100, but company B, which also happens to be listed company in its own capacity, reports it as say 50. SEBI compares these two data points and comes up with a report. It will be a long report. They will look at it transaction wise. They have a free-form text testing tool also. They compare the nomenclature of the transaction between company A and its counterparty. They say that you are reporting 4 items with 100 rupees, They are reporting say 6 items with say 50 rupees, but they are independently, none of them are matching. They have come up with this query as early as 2023 itself. It got, the reporting process got into in 21. They were much more smarter and came up with the question in 23. Now, every single time a company reports, it has to align with its counterparty also. Boss, what are you reporting? That level of reconciliation, which typically needs to happen in a normal audit process, right, is becoming much more important given the veracity of this. So, if we don't give an answer, SEBI requires data on one single day, 24 hours time, else it will be taken up for the next course of action. So, that is becoming a problem, and hence this can be only automated, can never be done manually, and hence that becomes an area of interest for companies also. Now, purpose clearly, without spending more time, what SEBI believed is while the section 188 was available, it was not effectively used, and hence there was really no data for SEBI to test the veracity of the data, and hence there have been significant global practices. There is a very similar EU region related party governance module, which is prevalent in all the European nations as well. SEBI had borrowed that context, and to say that if just in case if there is any potential of the money flowing into the promoter or promoter interested companies, there has to be a specific disclosure with regard to that. That's a new addition to the related party definition in SEBI itself. So that is one, and they extended the definition also. Seemingly a transaction to third party, but if the objective, the purpose and the effect of such a transaction to third party is to benefit a related party, the transaction to third party should be deemed to be a transaction to related party. This is a new addition which has again happened. So with all this, again they have given specific monetary thresholds for audit committee approvals, for of course for shareholder approvals, the audit committee every transaction to be approved. For shareholder approvals also they have increased thresholds, etc. And hence the idea is to have a larger process in place. So here again with effect from 22, this actually started in 22 itself. Any person or entity that forms part of promoter or promoter group, irrespective of the shareholding, will be deemed as a related party. 2. A person or entity who holds 20% or more of equity shares at any time during the year will be deemed as a related party. Now, this second condition of 20% has got amended to 10% from April 23, which means, which is very natural. But just to clarify here, transaction with promoter interested, regardless, irrespective of the shareholding, will be deemed as a related party transaction. So that is clear. So, and this is clearly a very quick snapshot of who is a promoter interested in the context of our reading. So, individual promoter, every lineal ascendant, descendant, etc. Of course, in certain situations, daughter-in-law is exempt, son-in-law is exempt. Don't ask me why. That is how 271 has been worded, and that actually has not got amended. So that is open. Immediate relatives are the promoters. Again, relatives you can go back to Companies Act definition itself. So apart from the fact that 20% or more of capital is held by promoter, including relative, those entities also need to be considered as promoter interested companies. It could be an HUF, it could be a firm, and nowadays it becomes very easy that a husband and wife comes together and floats in a HUF for tax planning. So transactions could be with that HUF. That becomes a related party. So essentially it branches out to that extreme extent, and hence this becomes extremely important. Now, the most important, like Mr. Madhu also clarified, the transaction of related party transaction definition itself. So, a related party transaction means a transfer of resources, services, or obligations between a listed entity and its related party, regardless of whether a price is charged on a and that's one portion of it, regardless of whether price is charged or not, is the key word here. 2. A transaction related party shall be construed to include a single transaction or a group of transactions in a contract. So it could be a package of transactions, the impact will be felt in multiple series, but it will still be seen as one transaction. Now here it is important to look at the term called arrangement. So in section 92F of the Income Tax Act, arrangement clearly is defined as essentially a transaction, whether in oral or in writing, but essentially it is to bind two parties through an obvious agreement on the terms of the transaction to act in concert. This is the definition in N2F. So the fact is, whether it is writing or not, the intention of the transaction, if that is going to benefit a related party through circumstantious flows, ultimately if it's going to benefit the related party, then it will be seen as a related party transaction. Very simply, I am a holding company, I provide guarantee to my group company. Right, I am an India headquartered company, my subsidiary is in US or UK. So it is very obvious for me to extend the guarantee because I am more concerned about the financial strength of my group. Ultimately, I am going to get the dividend back from the company over a period of time, getting consolidated. It's my own baby, so I am giving the guarantee. I am charging guarantee fee for the guarantee itself. Now, that is becoming a very, very basic question, which is stemming from a GST investigation perspective, because none of the outbound Indian companies, we see that they are charging any corporate guarantee to their subsidiaries. That is one. Two, the subsidiaries end up selling some of these goods what are getting manufactured across the world. It could be across regions, Europe, US, Asia, etc. It goes with the embossing of the brand, which is again an intellectual property of the headquarter company which is sitting in our region. Do they charge a brand royalty? Answer is no. We often see that there are common finance and accounting, secretarial support, strategic business function heads also sit out of here, manufacturing, marketing, etc., who end up advising various group companies across the world on best practices in their respective business divisions. Do they charge the time which they spend for the benefit of the subsidiary? Answer is no. So GST has clearly picked up these aspects and they are saying that this is a transaction for which a compensation has not been provided for, and that clearly will sit in this definition to say a transaction regardless of whether the price is charged or not. So now both the Companies Act and also GST are also collaborating. Income tax is yet to pick up speed, but the fact is more often than not these discussions never used to happen in board meetings. Now this has come up. To say that are we charging brand on the road? Possibly the brand has been existing for 100 years. No one would have cared to even value the brand. It possibly would be recognized as 100 rupees or 10 rupees in the book for the sake of record. Because India, we don't have, unlike a US where they actually value the brand in their books and they ascribe a specific value when the business transfer happens. They even value data. Customer data is recognized as an intangible in US accounts. We don't value it. In fact, in India, customer relationship is a very key attribute for us to win more clients, retain work, and etc., which is a very significant value addition. But we never recognize in the books of accounts at all. More often than not in a business restructuring, we call a big number as a goodwill, which is a residual number rather than we ascribing value to it. So most of these aspects, while there is significant financial, commercial, and time investment which goes into developing some of these intangibles and providing the service, etc., they never get valued in books. SEBI wants to value it and put a number to it, and the transaction need to be recognized, audit committee need to be convinced to the valuation, and hence it has to be demonstrated with arm's length and then reported as a separate line item. It is very easy for SEBI to shoot all the companies today, why have we not done this? One single line. It is possible, and we have started seeing it not clearly from SEBI in so many words, but we can see this in no time now. Since GST is there, it's essentially going to be copy-paste.
So you say it's not easy to be an independent director now?
Extremely hard, sir. In fact, there have been lot of articles already that most of the independent directors are clearly uneducated about the risk they are getting into this. Because only an independent director can review and approve a related party transaction. Other directors cannot in an audit committee. So it is Hippo's responsibility for the director to understand the business of the company first. It will stem from it. And then try and look at it critically from these thought processes and he should push the company and possibly the company would end up pushing the auditors or consultants, which is okay, but the independent director should ask the right question. So that is there. So this is a big numerical illustration I thought I will put up. So if you look at ABC, which is the registered company, any transaction which it has with its own related parties. So related parties could be subsidiaries, associates, joint ventures, typical related parties what we see. That is any which ways looked at from a related party transaction perspective. Even Ind AS 24 will report it. That's fine. But going forward, SEBI also wants the listed company to look at the related party transaction with subsidiary companies also. So, it's subsidiary companies, if they have transactions, their respective related parties, whether those transactions are at arm's length or not, is the listed company's responsibility. So, earlier, audit committee would only look at listed company RPT list, tick. Now, they have to look at two sets. One is listed company itself. Assume the company has say 30 subsidiaries. They should look at 30 related party list of the respective companies, have a documentation to say that this is arm's length or not, and then do a pre-approval. I repeat, pre-approval. So essentially the budget of the transaction need to go up front, the analysis need to happen, which means for me to transact say 6 months later, I should have done the analysis now. Typically that's how it has to happen. So this is with effect from April 22 onwards, this regulation which the notification came in November 21, they gave us time to settle in. From April 22 onwards, all companies started implementing. Of course, there were initial glitches as usual. SEBI came up with clarifications on what they meant through certain terms and etc. Companies took very different views on reporting practices also. But one good thing is there was a lot of cross-learning which companies also did. Within the industry quarters, they discussed and agreed on what can be the practices. For GST could be a very simple example, 18% impact. For a company as big as Tata, it did play a big role because they had put a one star mark to say that GST is not counted. That saved them from the budget exceeding approval condition. So these are all very, very well thought and evolved over a period of time. Now it has settled very well, but lot of glitches way back in 22 and 23 when the initial reporting were happening. Going forward from April 23, like I mentioned, a transaction with a seemingly third party, but the purpose and I repeat the purpose and the effect is to benefit a related party will be deemed as if it's a related party transaction. Now, very simple example, listed company essentially is say purchasing a product with a third party vendor, it is purchasing at say 120 rupees. There is a quid pro quo that vendor essentially will have to sell the product to the related party at less than market price. That's the understanding. Essentially the subsidiary company didn't have cash. The listed company overpaid when it had transacted with the vendor. So, is the purpose and the effect to benefit a related party? The answer is yes. And it's a cumulative condition. SEBI, very unfortunately, surprisingly, they recognize the fact that effect sometimes could be to benefit a related party. But if the underlying intention or the purpose is not to benefit a related party, that is clear through documentation, they don't want to touch the transaction. They exempted it. If the purpose is to benefit related party, ultimately it has not given any advantage to related party. They also want to go and touch the transaction. So it has to be a very clear, in simple terms, going back to 271C, there has to be a mentally or culpable state of mind to commit crime. That is the standard which SEBI has as regards this to say that clear intention actually to benefit related party, and yes, of course, monetary terms, ultimately the benefit has flown to that person. If both of them are cumulatively satisfied, and it will be deemed to be a related party transaction, it will be reported. For few of us who possibly have looked at section 92B2 of the Income Tax Act on deemed international transaction, we will have a very, very similar provision to say transaction is a third party, but essentially if there is a prior agreement or arrangement with the related party on the terms at which I should be transacting with the third party, the transaction the third party should be considered as a related party transaction. This is a provision in the Income Tax Act. They have clearly essentially borrowed the same provision, but with this very logical addition about the cumulative condition which currently is absent in the Income Tax Act. So to that extent, that's an addition. Extremely theoretical. No company is going to come forward and say this, but yeah, it's there on the law as of now. Because all of these are handles. Tomorrow, if the company does not have a background to say, it is easy for SEBI to pick up this provision. It is like a 92F in an Income Tax Act where I can call any transaction by terms. AMP again, income tax authorities actually are struggling to fix AMP in any transaction category. So they say that, see boss, there is an action in concert, The group is interested in developing your brand, and hence I will attract 92F. This is very similar to a residual section in Income Tax Act for you to get targeted. So we spoke about audit committee approvals, and the reason why I started with 177 is that is much more wider. Even in here, while very clearly listed company transactions all need to be looked at from a subsidiary transaction perspective. Like I mentioned, audit committee is responsible both for listed company and also subsidiary. Approval required for RPTs to which listed entity is not a party and only listed entity subsidiary is a party. If that is the situation, from April 1, 2023 onwards, if the value of the transaction is 10% of the annual last audited standalone turnover of the subsidiary, then audit committee of listed company need to approve the later by transaction of the subsidiary company. 10% of a standalone turnover is nothing. These days, typically, if you look at purchase and sales cumulatively, it will definitely cross. Ultimately, because if you look at typical industry segments, which is auto component, at least in Chennai, for the matter any manufacturing company, they always act in one single ecosystem. Right? They end up purchasing and selling to each other so that they are coming together with a single finished product. So 10% is nothing. So net, all subsidiary transaction will be under the reporting threshold, and these days it becomes extremely difficult to even upload the file. It takes 4 hours. It's because there are so many line items, essentially, like Mr. Madhu mentioned. So extremely voluminous data. One is volume of the data. Two is as much as time should go into analyzing the data and looking at the ramifications from a tax governance perspective, we get the data at the last minute. Most of the time goes into massaging the data and looking at the normal ratios and correcting it and etc. etc. They will call it as a royalty. Now I would ask for, boss, where is the royalty agreement? So sorry, sir, it's a service transaction. So it is as basic mistake in the accounting process, and we never end getting time to look at qualitative aspects of the transaction. So hence, again, an automated process will help companies put this in place. Not necessarily the listed companies, even for routine companies, the transaction reporting need to be automated. This is the half-yearly disclosure. I will of course share the material with you so that you can go through in detail. But this does not have just about material transaction, it has financial transactions as well, especially on loans, because that's clearly the way in which cash flows back to later parties. There is a 7-column specific disclosure required for all the loans. Then what is the cost, what is the tenure, what is the purpose, is the end use being met within time, and if there is moratorium, what is the reason for moratorium, etc. So again, like I mentioned, quite a few potential impact areas once the data is out in public domain, right? Corporate guarantee, loans and advances, GST implications, ESOP costs, the brand royalty, what I spoke about, management support, intermediary services. This again is a very key point. We end up doing, the group ends up doing bulk negotiation with vendors for a common discounting pattern across vendors. The value of the benefit also flows to multiple group companies. So, is the group getting adequately compensated for this larger strategic cash saving function? Is again becoming a GST problem, which gets connected to Saviour. So, this is broadly about it. So, in whatever little time we have, I thought I will quickly spend time in few case studies. So, this is the famous report review by SEBI in the case of Adani. Adani failed to prove the transactions with the later parties to be at arm's length, and hence there was essentially a penalty which was levied on the key directors. So, it is not necessarily about the penalty itself, but about the ramifications and public image of the company. So that becomes extremely important. Sun Pharma is the other example. Like Sir mentioned, they ended up missing one of the transactions to be reported, and that was identified during the SEBI investigation, and they were essentially taken to task. So the details are available here. So there were situations where the loan extension happens, which is quite important. In this case, the original loan was 10 crore. The loan value was extended to say 35 crores. And there was no approval received by the audit committee. When asked, the company said the original loan was already approved, but there is an extension between 35 crores. Whereas the terms are again being the same. Ideally, the monetary position itself has changed. The interest should have actually been enhanced. and the interest on the original loan was not even paid at that point in time. There were so many issues involved, and there was no approval process which was in place, and hence clearly this was a non-compliant. SEBI had picked it up as a specific issue, and it has levied penalty also. And like I mentioned, most of the situations, the auditors happen to be the softer targets. So the company will, SEBI themselves have actually targeted the auditors to say, why you have not looked at this? You should have ideally looked at it, etc. So there have been situations where even companies fail to get shareholder approval when the monetary transaction thresholds were breached. The approvals were not in place, and SEBI have picked up those aspects as well, and they have levied penalty. So, and this is very obvious mistake anyone can do. Interested parties reporting, participating in the voting of a resolution. So, this again has got picked up. All of this is paperwork. It should have actually been avoided. So, with this, what we want to essentially convey and discuss today was again the two key touch points what we mentioned. One is transparency. The other is focus on corporate governance. When we say corporate governance, again, it's not very restricted to only arm's length transfer pricing testing practices. It's about the larger public image, essentially, and the discussions what we have been having on various case studies on SEBI, they have not left anyone, and they are looking at real-time data tracking, and they are able to do reconciliations themselves between counterparty reporting and etc. Not beyond numbers, they are getting into conceptual discussions also. So, and essentially they will end up giving ideas to GST and income tax also, and they are going to receive. Essentially, it's going to be one good teamwork over a period of time. With all this in place, I think the responsibility of advisors from our end is to ensure the company has a process in place to identify related parties, monitor transactions, and ensure the transactions at arm's length, apart from managing the genuine reporting practices. So with this, thank you so much for all the patient listening, and it was a great pleasure sharing some thoughts with you all. Thank you so much.
That was an excellent presentation by Shri Balaji, and our congratulations to him for giving an in-depth view of RPT. See, we have all been listening to it, and we know now that there is more depth to what we read superficially. One point I would like to mention here, he started off with saying whose responsibility it is to identify RPT transactions, on the RPT, whether it's the onus is on the company or on the auditors. Basically, what happens is sometimes the line of demarcation between these two is very thin. Normally, auditors, due to lack of time or whatever may be the reason, they start, collecting the data on RPT first, and the data is always available. But how good the data is, how proficient, and to what extent is reliable is a question mark. So what happens is, invariably they collect, they come to an analysis, they come to a conclusion. Probably they need to get these things validated from the corporate side of it, and that does not happen mostly. Anyway, ultimately when you sign your report, you are putting all your facts to those charged with governance, TCW. So if there is any error from your side, they have to validate or present it the true facts. Excellent presentation, Balaji. Once more, I thank you all. I think now we all disperse for lunch. I believe it's ready. It's about 1:28. We have about 45 minutes time from here. So probably around 2 to 5, we again assemble here for the third technical section. Thank you. Dear colleagues, you must have had a sumptuous lunch, and probably it should keep you awake, or it should make you go to sleep. It can act in any way. It all depends. So now we are on to the third technical section, acceptance of deposits, governed by section 73 to 76 of the Companies Act. We have with us here Shri Madhusudhanan, who's going to take us through the nuances of acceptance and what constitutes deposits and what does not constitute deposits, etc. We'll wait for his session to see how interesting it could be. It's my responsibility to introduce him to the august guardians. Madhusudhanan is a chartered accountant with a post-qualification experience of 8 years. He has a mix of both corporate and consulting experience. He has worked with leading corporates in financial reporting and corporate financial roles. Currently working with Big Four firm in their accounting advisory practice. Anyway, that's Madhusudhanan for you. And before he starts on his lecture, we would like to request Shri Madhusudhanan to occupy the dais, please. Sorry about that. We need to honor him with a shawl and momentum. The honors is going to be done by Shri S. Balaji. I request Balaji to come to the dais and honor Shri Madhusudhanan. Thanks, Balaji. Shri Madhu, the floor is all yours.
Good afternoon, everyone. It's a second half session. Keeping everyone engaged after a good lunch, it's going to be a task for me. Let me see what justice I do to the role.
So the heavyweight sessions are all about the morning.
No,
The sessions are lightweight now.
let's see. So, acceptance of deposits, that's the topic. It's covered under Companies Act, as Shah said, from section 73 to 76A. So, if you see, it's only 4 sections, and in those 4 sections, 2 sections are transition provisions, like what happened when we moved from 1956 to 2013 Act. So then it is only operatively 2 sections with 1 penalty. Then what is the depth? Let's see. If we dive, we should be able to come out of deposits. So, giving you the historical context. So, this is the flow that we will go through next 1.5 hours. We will understand what is deposit, the historical context, who can raise, procedure to raise the deposit, implications, and the practical aspect of DPT3 that everyone will face. Initially, when Companies Act 1956 was there, it didn't govern deposits. It was only in 1960 types a regulation for deposits came in. That too, it was initially with RBI. What are deposits? Deposits are something that you raise from public. You are going to give it back with interest. This was the initial context that was there in 1960s. But 1960s, like, you have to travel back in time. There was no SEBI. RBI is not what today's RBI is. Government is not what today's government, where its regulation is overarching through income tax or GST, everything. So that's the period in which regulation is creeping in every place. So there was, why regulation comes? Because companies also not do everything in good faith. There is also fraud that is happening. That is the reason for regulation to come in. So there was a Supreme Court Justice, Mr. Vivin Bose, who, due to a scam, this committee got appointed, and his committee's recommendation was to strengthen Companies Act. One such recommendation there was to govern deposits. That act had lot of provisions, but that committee had lot of recommendations. One such recommendation was to govern deposits. The act came in only at 1974 types. So what it brought in is essentially three things. One is how it regulated how much deposit you can raise. Two, it made a mandatory clause where you will have to set aside some amount in advance. Let's say my deposit is going to mature this year. At the start of the financial year itself, I set aside a minimum amount. Like banks have a CRR, cash reserves. This was sort of that equivalent, because what's happening? Companies are going to public, raising funds from public, but you are not scrutinized as what banks are. So that's why it got pulled out from RBI's purview. It came into Companies Act. These were the three mandatory these were the three overarching changes. The other one was, okay, when you are going to give advertisement, you cannot give advertisement in everything. And you will have to mandatorily tell what is the rate of interest that you are going to give, what is the security that you are going to give. Like that, it made certain mandatory disclosures in advertisement. What can you advertise? What should be there? What should not be there? Everything was brought in the 1956 Act in 1975. When it was brought in, it was called as public deposits. The word public has been dropped today in 2013 Act, but in substance what was told in 1956 Act stays. Actually 2013 Act went one step beyond what was in 1956. To say otherwise, whether 2013 gave relaxation, no, it was the other way around. It went 2 steps ahead than what was in 1956 Act. So before that, there were cases that were filed by companies like, you are infringing on my basic right to conduct business. You are asking me to set aside 10% of the deposit amount upfront. You are depriving me of my property. These were the arguments that were kept by the company, but Supreme Court told, boss, this is the legislative prerogative of the government. It has the powers, it can legislate. So it got upheld, and now with 2013 Act, over the term of the this from 1975 to 2024, this Act has got stringent. In 1956 Act, it exempted private companies from raising loan, or rather, if you get a loan from a member or a director or a director's relative, it was never considered deposit. That also gone away with 2013 Act. So if you get a loan from a member, it is still considered as deposit. Why would loan become deposit? Morning we were seeing Balu's session where he was trying to differentiate between what is loan, what is deposit. In loan, borrower solicitates. In a deposit, typically the person comes, whoever is the depositor, he goes to the person and asks, the bank or company asks, shall I put in deposit? All those are there, but the way Companies Act looks at it is slightly different. This is the definition. If you take a minute and read through that definition, it will not tell you anything. It is deposit includes by way of receipt of money, a loan, by way of deposit or loan, or in any form. So what does that mean? That means till this part, till the first part, anything could be deposit unless it is exempted by government. So you receive money, you have to pay back. That is what is loan and deposit substance. You receive, you will have to pay back. If you are doing that, you are covered under deposit, boss. Step 1 you are. Now, if it is not exempted as per the rules, you will have to follow the compliance that is given in the Act to raise a deposit. You cannot always raise a deposit. If you are a private company, you have a restriction on how much you can raise. If you are a public company, there is a different restriction. You have to follow a procedure. So, for raising even a small loan, this section comes into play. But fortunately, there have been a long list of 25 odd exemptions through which we can come out and say, it is an exempted deposit, I will not follow these sections. I am not here. I will tell it is an exempted deposit. If you are an exempted deposit, you don't have to follow the rules. But still, there is a return filing that has been mandated recently in 2019. It is undergoing change. We are also grappling with the change. Till last year, earlier it was a e-form, now it is, earlier it was a PDF form, it's a e-form. Earlier they asked to tell only closing balance, now they are asking to tell the entire movement, opening, everything. So this is also an evolving, like it has been strengthening, it is also an evolving section. So like told, what are the sources of funds for the companies? You can get a loan from director, you can get a loan from HUF, your promoter's HUF, you can raise an OCD, optionally convertible debenture, you can raise a secured debenture. Any money that comes into the company can potentially be deposited. So if you think of the liability side of the balance sheet, there can be two items on liability side of balance sheet. One, you got money you have to pay. One, you got service what you have to pay. One, you have to pay for, you have got the service and you had to pay. Fortunately, that is not there. Wherever you have got money, you have to pay back or you have to provide service, everything is deposited unless exempted. So now the emphasis is to understand what are all the exempted deposits. So it's a long list of 25 items. I have tried to put it here verbatim so that if one sees, they are not like, I don't want to reinterpret what is already given by law. Step 1 is anything that you receive from government, either as loan or grant, or you have borrowed from someone, but government has guaranteed the repayment of it. Before we step into each of these items, let's take a step back and understand why is this all here. As we were seeing, what is deposits, everything. So, in the historical context, in 1970s, 80s, there were a lot of fixed deposits that was raised by companies, NBFCs, everything. So, whatever NBFCs has to raise has now went into the RBI channel. Whatever a private company can raise or a limited company can raise is only here. So anywhere the public money is there, that they want to call it as deposit. So when government is giving money, it has to go do its due diligence and only it would have given the grant. So that's the reason why it is not called a deposit. Anywhere you get money from foreign, either it could be a loan, and the loan could be from a foreign bank or a foreign multilateral agency like World Bank, Asian Development Bank, or a body corporate or a foreign collaborator. Let's say you are importing something from foreign. There will be export credit bank, banks that develop export in that country. Those everything are exempted, including a foreign body corporate. Let's say you are in India. This is a subsidiary here. The holding company is outside India. He is going to give loan to the subsidiary in India through a ECB. That is also exempted. The intent, because, is to protect public. I don't want to protect foreigners, I want to protect public. The next two sections are more on banks. So any loan that you take from a government, a bank, SBI, cooperative bank, public financial institution, all those are not covered under deposit. So we don't have to worry about the rules.
And any instrument through which you raise, if it is regulated by RBI, commercial paper or an infrastructure bond, for example, all those are also outside the purview of deposit because there is a separate regulation taking care of it. Now is a very important part. Oh, sorry. Any amount that is received by a company from other company, like you do an intercorporate deposit, there is a subsidiary company that is giving loan to one more subsidiary downstream, you don't have to worry. Or there are entirely two unrelated companies, that also you don't have to worry. If you take one step back and when you saw the banking exemptions that was given, NBFC was not mentioned there. If you take a loan from a non-banking company also, it is only covered under this clause. So this is a very wide clause under which if you take money from another company, you don't have to worry. This part alone, have a look at it. I'll come back to it to see where all this clause can help get out of difficult situations. We will have difficult situations, only this clause will be saving grace in some time. Now, the other part is you raise money as share application. You have to make allotment within 60 days, else you will have to return. If you are not returning within the 60 plus 15 days, this will become a deemed deposit. Because here you will not just raise money from companies, you may raise from private individuals as well. The rest, the important clause where there will be lot of practical day-to-day scenarios. If you are going to get money from your director, it is also exempt for a public company. For a private company, you can get both from director as well as his relative. The only condition is it should not be out of borrowed funds. He should only use his own funds. When you are getting money from a director, make sure that we also get a declaration saying that it is my own funds, boss. It's not that he borrows and he gives me money. As I told, in 1956 Act, member also was here. That clause got removed. Now a private limited company raising money from a member, if he is not a director, becomes a deposit. That's a very significant change from 1956 to 2013 Act. Another important clause is secured debentures. So if you are issuing debentures and if it is a secured debenture, it is not a deposit, provided that the security that you provide has two conditions. One, the security value should be more than the value of the debenture. So basically you are 100% covering. There is no the partially secured debenture is a deposit. It has to be fully covered. Two, you should give only an physical asset as a security. You cannot give a security which is an intangible asset. The next condition is like when you give debentures which are compulsorily convertible, if the conversion happens within 10 years, you are out of deposits. When you issue non-convertible debentures and it is fully unsecured, meaning that you have not given the security, if it is not a deposit only when it is listed. So basically, if they have a non-convertible debentures which is unsecured and it is not listed, it is potentially a deposit. This is where I told our first clause can help, provided that if it has come from a company, you can get out saying that, again, what I am telling now is more an interpretation. It is not written in law, but there are people or there are companies which take the view that though on this clause on its own, it looks like deposit. I have got it only from a permitted person. The permitted person is a company. Hence, this will not be deposit. So, if you are giving debentures, it is entirely unsecured, not listed, to an individual, it will become deposit. And you should have followed all the rules. If the rules were not followed, then we are in suit.
One small doubt.
Yeah.
The companies which are getting themselves listed in social platforms, do the same rules apply to them?
Social platforms?
You have the other parallel platform other than the recognized stock exchange. There's a parallel platform there.
SME stock exchange.
Where even private limited companies can register themselves, list themselves. Trusts and all that.
So it should be on a recognized stock exchange. As long as the debenture is listed on a recognized stock exchange, it's fine.
SEBI has allowed the other platform to also function and
yes.
small entities to raise funds.
Yeah.
Earlier they were deprived.
So there is an SME board now. There is also other stock exchanges that are functioning. Even NSE and BSE has their own SME board. There though only equity can be listed. Debentures has to be listed in a stock exchange permitted by SEBI. If it is permitted, it is not a deposit.
If it's permitted, it's not.
It's not a deposit. So if you receive security deposit from your employee, so the employee could be handling significant cash or very high value material like jewelry, diamond, so you are getting security deposit from him. That security deposit should not exceed the annual salary from him. Then it is not if it doesn't exceed, it's not a deposit. Any money that you have received which is held in trust, so you are like a pass-through agent. So a lot of NBFCs, what they do, when they sell their loans, they will deduct some amount, say for insurance. All those costs will be held by those NBFCs as held in trust in their books. If it is not interest bearing, that is also not a deposit. The most important clause where lot of practical challenges will be there is when you get an advance from a customer, if you supply within 365 days the goods or service, it is not considered a deposit. This case will be there in many companies. Just for this one case, even though they don't have loans or anything that is that we have covered previously, they will have to file Form DPT3. Again, here there is a small interpretation. What MCA thinks is supply has to be completed within 365 days. But there are few positions that again certain firms are taking, that you don't have to complete the supply within 365 days. As long as you know for what you have to perform that service. Let's say there is a particular work order. Let's take the example that Balaji gave in the morning. Like you have got an advance to supply a die. That die ideally will close within 2 to 3 months, but you are having there is some R&D that is going on. You have not supplied it within 365 days. But when you know you are going to provide only the die and the specification, everything is clear. Even though supply doesn't happen within 365 days, there can be one interpretation saying that no boss, I have appropriated the money. I have kept it aside. I mean, kept it aside meaning we don't have to do it separate as such, but I know what I have got this money for. So all these jewelry schemes that we see, like you will have to pay within 12 months, or you pay deposit every month an installment, and in the 12th month they will give you a discount. Potentially could be deposit, because if whenever they deposit first month, second month, I don't know what I am going to buy. I may buy a coin, I may buy a jewel. So there are 2 or 3 big listed companies who are doing this deposit compliance only because they are doing this scheme, not for raising money from public. One name I can take is Titan Limited. They, out of Tata's conservatism, they are telling this is deposit. It's only a 12-month scheme, but they don't know when that day will come. He will pay 12 months, he may come 15 months later. For that 3 months I will have to say I am non-compliant. Why should I? Else I have also heard scenarios where proactively the jewelry sends messages saying that if you don't come within 12 months, we will set aside that money. Or we will return you back. You will have to come within this much day, use it. So the interpretation that I told that it has to be set aside for a specific work contract or a specific PO was held by NCLT in a case that I have given below. But it is only NCLT. We really don't know what MCA thinks. Because what MCA has taught in 2 or 3 discussion papers is they think service only has to be completed. Setting aside is not enough. So when there was a review of this particular section post implementation of Companies Act, there was certain feedback that came to MCA stating that this has to be liberated, boss. I cannot complete service within 365 days in all cases. You will have to see the industry specific scenario. This is again a change from 1956 Act. In 1956 Act, it only told that you should get the advance and it should be in the ordinary course of business. Ordinary course of business, Balaji has played football with it. So now we know what is ordinary course of business. But this 365 days came in because probably MCA thought in its wisdom that without having a date bar, this provision is being misused. Like collecting money from people, telling it is advance, not returning it. So that's why this stringent provision of 365 came in. So coming back to the discussion where the MCA got feedback, they have given exemption for some 2-3 categories. One is very normal transaction where I pay advance for a property. Builder will take 3 years to construct. So fine, they are telling that is not a deposit. Security deposit we pay for whenever we take a lease rental, lease property. Lease could be 6 years, 7 years, so that is also exempt. Any deposit that you do other than immobile property, if it is a long-term project which ends up in a capital goods only, that is exempt. And there are 2-3 other cases where you pay maintenance, upfront maintenance. There is a lift in your office, you are paying upfront maintenance charges for 2 years, 3 years. That is also exempt. Warranty, where there is a service warranty for 2 year, 3 year upfront subscription we pay, that is also exempt. So MCA has still not watered this provision down. Even after getting feedback saying that this is very stringent to adhere, they have still given it only for certain sectors, certain very, very specific cases. They have not given en masse saying that you cannot, en masse saying this will be allowed as per business practices. They don't want to give that business practice word to everywhere. They have given it only to two sectors saying that warranty and maintenance contract. That to 5 years or lesser, whichever is lower. So I cannot take a maintenance contract for 7 years is what MCA is telling now. So this also again there is a small interpretation, like we can go back to the clause where if you have got advance from a company, potentially you can come out saying that this is not a public individual or HU or for an LLP that I took, it is only from an exempted person. This exempted person term is what I am using, that's not there in the law. This is again could be potentially litigative. I am saying only what could be done. It's advisable you don't do it. push to wall, there is a escape clause that if you have got it from company.
But in FEMA, you always have the 9 months time to knock off. Receivable. So, in a way, practically, then if it's an export transaction, it has to be 9 months.
Correct.
Otherwise, it will get recharacterized.
So I have checked practically what people do. People are not now with the DPT3. You should give the aging as well. Is it less than 1 year, more than 1 year? So better to give, instead of putting it as advance itself, you can put it as received from company. With the FEMA transaction that you told, it could get covered in the second clause itself where you got from a foreign person. Companies Act per se is not worried about what you do to the foreigner. I am here to protect only Indians.
That's the word of
Let's say you've got an advance. The contract gets cancelled to whatsoever reason. You are not able to perform. You should return it within 15 days. Else, what you are doing is raising working capital from customers. This is another very practical scenario where fortunately they have given some exemption. You go get a loan from bank. Bank tells that you bring up equity, boss. There is discussion going on. He is telling, no, I cannot put it in form of shares. He tells, I am not bothered. As long as you bring in your 10% of share contribution, you want the bank to fund 80%, 70%, you bring in the 20%. You can bring it as an unsecured loan. From promoter itself, even though the promoter is not a director, promoter, whatever form he is, HUF, LLP, everything you can bring. But that loan can stay only till the bank loan is there. They have not given the process also. I honestly don't know what happens if the bank loan gets over. Should I go for new approval or what? God only knows, but it is there. Like what people have been telling from morning, it is only complicating. Like they have exempted at the start point and they have clearly told that you will have to repay this at the end of the, let's say like when you repay the bank, you will repay this as well. That should be the way out. Like any amount you receive from Nidhi company or any amount you receive from a chit fund, all those are exempted. Likewise, any amount that you receive from a SEBI regulated entity. It's a collective investment scheme that was formed. Out of that as well, if you get money, it is an exempted deposit because SEBI has its own process to govern where the entity has to put money. Like a mutual fund, they have so many regulations. Like there's a domestic venture capital, they have some regulations for it. One more exemption that they have given is for startups. This is a new trend. So, if you call yourself startup, you have registered with department and you are newly innovating. If you fit into the startup criteria and you raise a convertible bond, it is not a deposit provided you meet the conditions. The convertible bond is that you should get converted within 10 years or the holder will get, the conversion will happen depending on some targets that you would have given to the startup, or it gets paid off at the option of the holder. This is the condition and you should reach minimum 25 lakhs. Startup $200 raising in crores, 25 lakhs will be small for them. So, startup has multiple exemptions in this particular chapter. The first exemption is if you raise through a convertible bond, which, convertible note. SEBI we discussed. So this is the list of exemptions that are there. If you don't fall here, if you don't get out, I will fit in one criteria or other, you can become deposit. If you fit in here, you are good. You are saying that it's an exempted deposit, boss. I will not follow the rules that you have told. This is the most operative part of acceptance of deposit. There is rules that we will go through in full. I can take a pause here and take questions. Yeah.
Directors HUF, will it get
Only director.
So,
Director and director's relatives.
so HUF will not fall in that. So they, if any amount is taken from them, then it is.
It's a it's a deposit.
It's a deposit.
Rather ask a director's company to give more. So if you like you said HUF, same goes for LLP. LLP is body corporate, but the word used in rules is company. LLP helps structuring many places, but not here.
Mostly customer advance only get caught in this.
Huh.
They're unable to.
So, lot of places it's a very difficult situation. In larger companies, you don't even know why the amount is sitting. It is sitting, that's it. I've heard scenarios where this is a entity which a large dealership network. So the dealer has to make a upfront not even a deposit, it's like a running account. The money is laying there. When the auditor inquired the company, what is this amount? He told, sir, dealer, whenever he comes, he will take the money, sir. I am not holding it. I am not stopping him from taking back. But the auditor's point is, boss, you should have given it back. Why are you keeping it here? He is not transacted with you in 2-3 years. The next question is, what did you do in DPT3? Nothing. And one more reporting implication is, this is a CARO reporting item. You will have to tell whether there was a compliance or non-compliance for this particular 73 to 76A chapter. And like morning, like Balu sir told, this is also a secretarial audit reporting matter.
What should have been done for that? For 2-3 years, that amount sitting, what should have been done?
So that case was also very blind. It's a running account, amount is sitting. So you should find the person and pay him. There is no other choice. Else it becomes deemed a deposit. If it's a deemed deposit, we will go through what is the implication of contravention. But what can practically happen is, he can charge you saying that you have kept my deposit. Or let's say if he comes, ask the money, you give it back, I think it should end there. Except the implication of you have not correctly reported in DPT3. Other than that, if the company is in a situation where it is not able to pay back, that person has one more weapon against you. What I have seen is, like, a lot of people have given money to companies in whatever form, they are not able to get back, like share application money they have given, advance they have given. They put cases en masse in different sections. Okay, this section is there, I'll put these 2 sections. I'll put it under IPC also. Like, you are not paying me money, why don't you get liquidated? So these are all the situations where you can go. The best is, like morning we have been talking, like putting controls in place from first so that you avoid this situation. See where is money flowing in. After all, money is coming into the company. We should put in steps to see where I am getting. This number, you will have to report it in June. Every year, all these transactions. So company should have and it is not that, as we told, I am repeating myself, like you should tell opening balance, addition, repaid, closing. Everything has to be given. Honestly, a lot of companies don't have that much robust process to put all these 4 numbers. It is only juggling that they do. Unfortunately, as auditors, MCA has given clarification, boss, you don't have to attest this number. It can be unaudited numbers. He is asking to file in June. June though, what will be closed? Nothing. Only by September all those things gets closed. So if it's an exempted deposit return, he has told, no need to worry the auditors. It is only a management declaration. So to your other point, like if you have got from the company, there may be some saving grace where you can recharacterize saying that you have got it for instead of, like why would an advance be sitting? It could be either a contractual issue. One more point that I have missed out there is, if there is a legal dispute there, you can take cover saying there is a legal dispute. But again, you should have a proper adequate documentation to say that it's a legal dispute, you have given notice, he is given notice, it's there. It's not even legal dispute, it is saying it is adjudicated in a court of law. So at that level you are fine. Just a mere notice may not serve the purpose as far as the legal case is concerned. Just a mere dispute between two people, I have sent you an email, you have sent me saying that I am not agreeing, boss. No, that's not enough. So advance is a very, very important pain point. It's a position that you can take, you have taken from company. It's a very aggressive position. But beyond that, if you have got from individual, it's a gone case. Individual or any other person like HE, FLLP who are not exempted on this list. So, this is just a summarization of what we discussed. You get from bank, NBFC, bank is a specific line item, NBFC you can come saying that you have got from bank. Secured debenture we saw, there should be a first charge and a first or a pari passu charge. There was a question raised, like can I take a second charge and a third charge as secured? First charge itself realizability is queen question. Second charge, third charge, what you will realize? No. Unsecured debenture, if it's listed, if it is not listed, it will become a deposit. Optionally convertible debenture, it's not a line item that is specifically given as exempted deposits, but potentially if you give it to a company or a SEBI regulated entity or an overseas person, then you can say it is not a deposit. Now let's envisage our first slide. Deposit is basically everything that you get that you have to pay back in some form. You have not fallen through here, like the question asked. You are getting from a director's HUF. What can you do? Can you take? This is what is given in the next slides. So, this is split into two sections. One is you can raise from members. Members, both public and private company can do. And from public, only an eligible public company can do. So basically, private company cannot go to public. This is the same thread that is already there. And in public company itself, not all companies can go. It has to meet the required threshold. The threshold is 500 crores of turnover, 100 crores of net worth. If you cross either of these conditions and you are a public company, you are an eligible public company, you can raise both from public as well as private. Else you are a private limited company, you can raise only from member. Give one share to one person who wants to give loan, tell him as member, then get him. Don't take loan before the share. First give share, then take loan. This is a simple definition. Who is depositor? Now, the most operative part. How much you can raise? You have told you can raise. How much? It's very small only. If you are an eligible public company, from members you can raise 10%. From public you can raise 25% of your net worth. Net worth being paid up share capital, security premium and free reserves. If you want, I can go into free reserves definition also. So this much only you can raise. Basically, it is not a very huge sum you can raise from anyone. Basically, this is an anti-abuse or a restrictive clause. A restrictive the chapter itself is a restrictive chapter. They don't want you to go to public and raise money. Public being general public, or for that matter even from members. They tell there is lot of financial institutions available, go raise money from them. Because their risk gets diversified for the bank assets. So what happens if there is an ineligible public company? Ineligible public company is nothing but he is below the thresholds. He is a public company, he is below 500 crores turnover or 100 crore net worth. He can come to 35%, but only from members. Government company, they are not using much of this provision, but they can also raise 35% both from public and members. You don't have to test government company for these limits. Government company, like default, you go raise boss. Private company, 100% you can raise off your net worth, paid up capital plus share premium. Here also they have given certain exemptions, like these category of companies can raise without any limit, provided that you meet these conditions. One such company is startup. Whoever is investing in startup knows that it is 0 or 1000. So I don't care. Government is saying like give money boss. We want to encourage startups. Private limited company, if it meets those, oh sorry, I'm not used. I'm very sorry. Private limited company, you have to meet these 3 conditions to raise deposits without any limit. Who will give money to private company? Member only. Member will be basically promoter. So taking money from promoter without any limits. Like there is limit on what you can get from owner itself. So if the company is not an associate or a subsidiary company of another company, so basically should be held majority by individuals, or not majority, fully by individuals. Borrowings from banks, any other financial institution, body, corporate is not twice as your paid up capital. So whatever is your paid up capital, twice that number you could have took from banks. Or 50 crores, whichever is less, and you have not defaulted on deposits. So if there is no bank loan, again no problem. Like it's an entirely 100% owned company by individuals. You can take without any limit from the members. But still you should follow the entire process. This is not an exemption. This is still called a deposit. If you take money from members, like you are an entity, 100% held by 2 or 3 individuals, there is no borrowing, nothing. So you can raise any number as loan from the members. But still you should follow the process of how to collect deposit. If the members or directors, of course you come under the exempted deposit route itself. Okay, now we have seen how much you can raise, how long you can raise, like how long you can hold the money back. Again, that is not very big number. Max term that a deposit can be is only 36 months, 3 years. Minimum is, sorry, minimum is 6 months. Again, there is a condition there. You can do a 3-month deposit raise, provided that you are raising it only for a 10% paid up capital, free reserves and share premium. The question is like, we put a fixed deposit in bank. We can go like I put a 2-year fixed deposit, but I can go 3 months, 4 months till that I am taking it, boss. This is also like that only, but there is a lock-in clause of 6 months. Before 6 months, you cannot go ask the money from company. After 6 months, you can go ask the company. Company has to honor the repayment, but they will give you a reduced interest rate. Like for 2 years, if it was 8.5, for less than 1 year, they will give 7.5.
So free reserves has been defined somewhere.
Yeah, free reserves is not your earnings, whatever we have. So it's part of the net worth definition only. So free reserves is whatever we have earned, excluding certain items. Like there is a fair valuation gain that is sitting in the balance sheet that you should not consider. And that definition is still a bit archaic, like you have not written off any miscellaneous expenditure. That also you should not consider. There is some merger adjustment through which some reserve got into a bigger number that you should not consider. Free reserve is like morning sir said, is basically any distributable reserve which sits in your general reserve or retained earnings, provided that we make all these exclusions. Any fair valuation gain, let's say now we are in India's world, they tell you to do fair value, the fair value is routed through P&L, or you do a simple foreign currency adjustment. Any receivable from overseas you restate, rupee is typically depreciating, so that is an unrealized gain. So all those unrealized gain you take off. You have provided depreciation as per the act, and you don't carry any fictitious assets like miscellaneous expenditure in books not written off. That's a very old concept, but still the definition is there. If you remove all these, that is what is free reserves. Whether you can distribute it tomorrow is a question. That's what SAR told. Like from general reserve, how much dividend can we give? That's the part that he did. But by nature, it is distributable because it is a realized gain that is sitting. I think the middle color is a bit issue. I'll still tell what is it. So now we know what is deposit, what term you can raise, how much you can raise, what all steps you should follow to raise the deposit. If you are an eligible public company, you will raise obviously from public and private, so public and members. For that, you should get a resolution from members. There is a 181C limit, which is basically what amount of borrowing that a board can approve. That is again nothing but 100% of your share capital, free reserves plus security premium. That is what is the 181C limit. That is typically within board's power. So if you are borrowing less than that, board itself can approve. But deposit being a special case, what they have done is, even if it is within 181C limit of being less than the net worth, they still want the board to, the members to approve through an ordinary resolution. If you are going above that limit, they are asking you to get the approval from members as a special resolution. This is step 1. So before doing anything, get approval from members that I want to raise deposit, boss. Even for a private limited company, raising money from only members, they again want the members itself to approve that they are going to do a deposit. 2, you should issue a circular in a DPT-1 format. There is a separate slide I will take you through on what all that circular should contain. Basically, the circular tells in that advertisement, you should have the financial position of the entity. Financial position being cash flow statement, balance sheet, and if you have obtained a credit rating, you should put out that credit rating. Credit rating is must for if a public limited company is going. And director should give an unqualified statement saying that, boss, in the last 5 years, or I have from the commencement of this act, I have took deposit and have not defaulted. I have made all the repayments in full. Auditor also has to give a certification saying that there has been no default. Or if there has been a default, 5 years has lapsed. Default happened, default was made good, and 5 years has lapsed. So we'll go through that DPT1 circular in full. And this is a very new provision that is again specific for 2013 Act. If you are going to raise deposit from public and if it is a secured deposit, you should appoint a trustee. That trustee will be in charge of taking the security. He will oversee registration of charge. He will oversee how the repayment is happening. And if in case of default, the trustee will take over the asset and realize it and give it back. So, but this is again a very theoretical provision. They are given this provision so that no one takes money as secured deposit. Yes, I have searched, no one is telling they are taking secured deposit. Everyone is only an unsecured deposit. So they are basically telling security in the bank to go for all of that. The next condition is, it's not very clearly visible there, which we discussed earlier itself, like you take deposit, you should set aside 20% of the next year repayment by 30th April. Set aside meaning not mere book entry. You should take the money, walk into the scheduled bank, tell him that I am giving this as deposit, sir, keep it. I will take the money for repayment. Like, for 100 rupees, you are effectively repaying 20 rupees earlier. This is the provision which got litigated in the DCM case. They told no, this will stay. And this is staying 10, 15, 20, I don't know, another 5 years down the line, it will be 30%, 40%. We don't know. So the rest is very theoretical, like deposits you can take in joint names. I don't want to get there, that was a very, like you can take 3 names as joint, all those. You take deposit, you will also take a nomination form if in case the person is not there, whom should the deposit be settled. Another important provision is you should maintain a deposit register, and that deposit register is exhaustive, like what his name, his PAN card, what is the deposit term, what is the interest rate, everything should be captured.
Source of this
Huh?
Possibly source of this fund.
No, I mean I'm not going into detail. Yeah, possibly.
Because director, it should be from his own fund. Right?
Director though is exempted, so that is not a problem. And you should maintain this register for 8 years. You should have documented in your board resolution which person will authenticate this deposit register. So for against every entry, deposit register has to be authenticated. I don't know if it is an electronic register, how authentication will happen. I envisage the manual register, okay, sign. Electronic register, I don't know. And you should issue a deposit receipt within 21 days of accepting the deposit. So once you accept the deposit, you cannot change the terms and conditions. Charge should be, and to call it a security deposit, again the same condition as what we saw for secured debentures, it should, the value should be 100% or more of the deposit that you have took, and it has to be valued by a registered valuer. Again same, don't take headache. So there is an application form which is a specified format that you will circulate. You can circulate, if you are a public company, you can route it through brokerages also. There are people who still take deposits and for interest. It is still happening. They are still complying with all these. There is a case of company in Chennai, Mumbai, everywhere. They are still doing it. I don't know. It's out of the goodwill they do. Like deposits are typically priced better than your FD. That's the next condition. You cannot pay an interest rate more than what RBI permits an NBFC to pay. Basically, you cannot compete more than an NBFC. You can be only at par with NBFC. This is again a restrictive provision. They don't want you to advertise you will give 20% return, 15% return, even for a public company. So let's say you have not made the payment, the person can go to the tribunal, say that enforce the payment. Typically what happens is, tribunal gives a timeline. So if it's a secure deposit, most of the work should be ideally taken care by the deposit trustee itself. It's an unsecured debenture, the next recourse is go to tribunal. Tribunal sometimes gives a repayment plan. If you adhere, good. If you don't adhere, then the next step in prosecution steps. Disclosure in financial statements. So you get a loan from director, you will have to disclose it as deposit in financial statements irrespective of the fact it's an exempted deposit. Honestly, I'm not able to think why it is, but it is there. You take a loan from director, it is perfectly exempted, you don't have to follow the deposit rules, all these complex conditions you don't have to follow, but still you have to call it out in the financials saying that it's a loan from director, it is, and whatever language that it's an exempted deposit under this rule, all those you have to put until that it is there. Like loan from director, again covered in related parties, it is there, it is disclosed in multiple places, you still have to disclose it. You are not repaying deposit on time, 18% interest you will have to pay for the delay. So the circular that we were talking about, credit rating must be obtained if you are going to raise money from public financial position. You should tell whether it's a secured or unsecured, you should call it out. If you are giving security, you should give the details. What is the number of depositors you have? What is the value of deposit for last 2-3 years that you should give? And the most important is you should send it to the shareholders. And one more point is, in a public company, all the directors have to sign. If you have 6 directors will sign. Tomorrow, no one can escape saying that I don't know this boss. I was only party to the resolution. They will come get signature from you. You can put it on a website. You should, if you are a public company, and a public company should give advertisement and specify all this DPT1, the entire thing in a English website, English newspaper and the vernacular language of the registered office. And they have told private companies may do. I don't even understand private companies, why will they do? They are collecting only from members, but still they have told may do. So the question is, okay, so this circular you have to issue as step 1 to get it. So before issuing this circular, there are 2 steps. Like the first one I missed out. Like before you issue circular, you should have filed it with the registrar. You issue. So how long this circular is valid? If that question is there, it is valid till the adoption of your next financial statement. If you are not adopting, what is the date on which it was supposed to be adopted? So 30th September, you are adopting the financials on 1st September. So this circular, if you issue in 24-25, it is valid till 30th September of 2025 or 1st September if you hold your AGM on 1st September. What happens after that? They will issue a revised circular with the revised number of 24-25 financials. If I issue circular this year, obviously it will have only 23-24 numbers. Next year they will issue a new circular as advertisement. So basically for 1 year this circular, with this advertisement they can keep claiming, raising money from public for 1 year. So who can be trustee is again, this is again very theoretical, because it applies only if you do a secured deposit. If you don't do a secured deposit, there is no question of a trustee. What the trustee will do, there is no job for him. So theoretically, if you raise a secured deposit, his job is to register the charge, ensure that the payments of the deposit are happening properly. If the company is not paying, enforce the charge, realize and pay. So when can the meeting of a trustee held, depositors held? A meeting of depositors can be held if more than 10% in value of depositor calls for a meeting, or in the event of default. So if there is a trustee will do all this work. If it's an unsecured deposit, theoretically company has to do. I mean, after defaulting, why would company do? I don't know, it is still there. So favorite exemptions. You are a private company, you are exempt from 2-3 things. If you are correct, private company of course can raise money from members only. So you are exempt from issuing a DPT-1, filing with registrar, everything is exempt, provided that you meet these 3 conditions that is given there. You don't have to maintain deposit reserve. The 20% putting aside money is not applicable for you. Uncertifying that no default has happened is also not necessary for the private companies, but provided only meets those conditions. That is, these conditions we have been seeing for some time. One additional condition is the deposit that you are raising does not exceed your paid up capital free reserves plus share premium. If it is less than that, you don't have to follow only these 3 conditions. So rest of the conditions like maintaining the deposit register are still there. All those procedural aspects are there. Only these 3 is exempt, because these are the material cumbersome procedures that they have brought, that alone they have took out. If you are a private company, and if you are a startup, and if you are a private company with all those conditions. So this is the significant portion of how you can raise deposit, if anyone wishes to do. Next important is, boss, what happens if I don't comply with provisions? So there are 2 contraventions of these provisions. One is in the raising part, 2 is on the repayment part. This is what is told as contravention. Basically, raising and repayment, everything. Company penalty starts from 1 crore or twice the amount, whichever is less, but max it can go to 10 crores. For an officer who was party to all this, 7 years imprisonment can happen, and the fine of 25 lakhs, max 2 crores. The minute "and" comes, you cannot compound the offence. If I would have kept the first slide, this was first slide, you would have even thought, should I do all this?
It's a juicy spot.
So, don't take money from public, is that? Next is on DPT-3, we have discussed. You should file it before 30th June, irrespective of the fact you have deposits or exempted deposits. If you don't have those, if you don't even fall in those initial 25 conditions, like you have not accepted money from a company, you have not took loan, you have not took bank borrowing is not there. If you tick off all those conditions, then fine. But as at the year end, you took deposits after following all these hassle procedures, or even if there is an exempted deposit, like you have took a loan from director, simple, still you will have to file a DPT3. And you will have to file before 30th June. As I told, if you are filing only for the exempted deposits, those numbers need not be audited. Auditor need not certify that. If you are filing for return of deposit, auditor has to acknowledge whatever you have given there. So it's two certifications. One is for there is no default and one for the DPT3 as well. And important, aging has to be given. So with DPT3 related, if there is some questions, that also we can see. Of course, customer advance path is there. Yeah. This is what the deposits is all about. So the moot point is, don't fall under those provisions. Use those 25 exemptions, come out, don't, or take it from director, simple. That is also one exemption. That's it, I'm done.
Basically, no, all these provisions are looked very strictly for listed companies and public companies.
No, for listed companies and
very strictly for private limited. They go scoot free, I think so.
Sorry, sir?
They are left free. The Damocles sword is not hanging on the private limited companies, but more so, what is the public listed company, how they contravene people, I mean.
So there are two things. One, so I'll answer it in two ways. One, they have left only public companies to raise public money. There itself it is there. From private companies, what they are trying to do is, they have given a lot of scope exemptions, wherein you can raise how much soever you want if you are within these limits. So they are scot-free to that extent. But again, whom they can raise from? They can raise only from members. Members know about the status of the company. Provided if they do all these colorful transactions, just give one share, then it is an issue. So that's why they have brought in all these very rigorous conditions for you to make it difficult to follow. If you follow, still you can take private money. I mean, private company take money from member.
Most of these foreign companies which are bringing funds into India, they register themselves as a private limited company, not as a public limited company or a listed company.
Correct.
So huge monies are flowing in, but unfortunately the status is that of a small private limited company.
But the intent is also not to regulate them. The intent of this particular section is public should not be at risk. It has been from the starting, the thought is like initially, like to give you a data number, in when this regulation came in 1970s, the entire NBFCs were having 1,000 crores deposits, while the banks had only 7,000 crores. So literally they had 12-13% of deposit bunch. And this entire regulation is don't raise deposits from public. Again, members always they have other recourse to go.
Yeah, what if there are any irregularities in the bringing of funds by the foreign institutionals into their local companies?
So those will be covered by different sections entirely. So like FEMA is there, and there is.
They are the overruling.
Correct. FEMA, RBI is there one, and there is here also under what color you raise. Is it an equity share? Is it a debenture? Everything. Other regulations are there within the Companies Act itself, and there is always, of course, RBI is there for to regulate how the money is coming for.
Not much has been said in Companies Act relating to this, right?
Yeah, it is mostly FEMA.
RBI, FEMA, and
correct. RBI and FEMA, Forex. Any questions, sir? Okay, thank you. Thanks for the patient hearing. Thank you. Hope it was useful.
session, a thought-provoking session. Lot has been dealt with regarding the acceptance of deposits, and Mr. Madhu took us over section 73 to 76, and also these sections are to be read in conjunction with Rule 2CC of Companies Acceptance of Deposits, Rules 2014. So he beautifully merged regarding the practicability of the sections in relation to Companies Act. Thank you, Madhu. Thanks. That was a wonderful session. Technical session for the day. That's on impact analysis of private limited companies. On what, I don't know. Mr. Jayanth Viswanathan is the right person to say. I invite him to occupy the chair. I have a very long resume of Jayanth. Probably so I'll just read the salient features, probably, if you permit me.
As short as possible.
Yeah, as short as possible. Yeah, I think. Okay. So Jayanth Viswanathan is a fellow member of the Institute of Company Secretaries and Master in Labour Law and Labour Welfare from University of Pune. As 15 plus years of experience in handling secretarial compliance, ranging from public listed companies to compliance works for companies across the globe, ranging from US, UK, Mauritius, Singapore, Philippines, amongst others. He is a partner in RV, JV and Associates and Director of Akshayam Corporate Advisors Private Limited. Area of focus includes handling corporate litigations and appearing before educating authorities like NCLT, Regional Director, ROC, RERA, FEMA. It's appeared in more than 350 plus cases, including representing home buyers, banks, creditors, corporate debtors, resolution applicants, resolution professionals and liquidators under IBC. In branches across India, including Chennai branch, Hyderabad bench, Mumbai bench, Principal bench, New Delhi and NCLT. Apart from litigations, he also handles complete corporate law advisory services, including secretarial services, secretarial audits, compliance management, due diligence, mergers and acquisitions. He was the convener of Chennai South Study Circle of SIRC of ICAI for the years 2015 to 18. Has an ardent passion for teaching and flair to simplify complex matters. He was the youngest faculty member taking classes since the age of 23 at ICSI, SIRC in various subjects relating to Companies Act, security law, general and business law for executive and professional students pursuing CS. So he is an all-rounder in all aspects. He has also addressed more than 5,000 plus college students and has given lectures across various colleges in Chennai on various topics including Companies Act, corporate SEBI, insolvency and bankruptcy code. He is a trustee of Home Charitable Trust, a trust that's been running all India Vedic composition. Oh, that's news. For 10,000 plus Vedic students across India for the last 15 years in order to encourage and empower the Vedic society, Sanatana Dharma. So a big clap for he has been a total all-rounder. He's been doing, he's giving back to the society probably what is earned during his lifetime. And that at a young age, normally we give it at a much more elderly age. He started very young. So kudos to him. Okay. Now the session we have to honor our faculty speaker with a shawl and a memento. I request Sri Gopal to do the honors.
is yours, Jay.
Thank you so much, sir, for the introduction. And I think I first of all thank Balu sir and ICAI for giving me this opportunity to be present for this August gathering and present a very short, brief presentation on impact analysis of private companies in terms of the compliances. My job is made easy by all the earlier speakers, right from day before yesterday and the 4 speakers today. I just have to make it a consolidation of all their topics together is what I plan to cover today with a little bit of... Sorry for that. A consolidation of all that has been spoken in the last 1, 2, 3 plus 5 sessions that has been taken by very senior faculty members who I'm sure has captured your minds in full. So private limited companies, one thing that we always think is just the compliance is illa. It's fairly easier because there's no public money that is involved. So there'll be very little compliances in terms of private limited companies. There's a general mindset, but I thought somewhere in terms of the numbers and showcase out of the 26 lakh companies that are registered in India, around 16 lakh 91,000 are active. Of this, 16 lakh 19,000 companies are private limited companies. So, which effectively means you have exceedingly large majority of companies being private limited companies, where almost all the professionals have a very major role to play. Given now that most of the private limited companies, there are a lot of investors who are coming in, and there's a lot of money that's being pumped into each of these companies, compliances becomes very, very, very important. And therefore, we are trying to touch on the topic of compliances and its impact in terms of the private limited companies. Majority of the companies, business service companies, 28% currently. So, manufacturing maybe 20%, construction 8%. If you see on an average, every month, 13,000 plus companies are being registered in India, newly incorporated companies. On an average, 12 to 13,000 companies are being registered. For the last 6 months, around 81,000 companies have been registered in India so far for this year. So you can imagine the amount of private limited companies that are being incorporated and the importance in terms of the compliances. Just to touch upon, because quite a few of us would be having a feel of how 1956 Act has been and vis-a-vis the 2013 Act, there have been quite a few new things that have come up. It's been 10 years since all these have come, and we thought we could just briefly touch upon to see the comparison between how the compliances were then to now. I'll just quickly run through the concepts of 1% company has come up newly in the 2013 Act, where the registered office, there are certain timelines that they have made mandatory. Appointment of auditors, again, specific timelines and tenures. Earlier it used to be every year, now they made it mandatory as 5 years. Directors, again, they fixed maximum number of directors, minimum number of directors, how many companies they can be directors. This was also there earlier, but there are more compliances in terms of the directors under the new Act. They've introduced a very painful concept of director DAR3 KYC, where most of us suffer in terms of the OTPs, etc., the practical difficulties that we face on a daily basis with MCA V3. Board meetings, of course, MCA has increased a lot of compliances by including secretarial standards, which has become mandatory for any company, irrespective of its size and nature. Annual general meeting, again, although they have reduced the number of months, the compliances in terms of the annual general meetings have increased significantly in comparison to the earlier Act. The format has been completely changed. The financials format, annual returns, they've introduced separate formats for small companies, for other than small companies, and they've introduced a new concept of small companies where if your paid capital is up to 4 crores, then you, and your turnover is up to 40 crores, you consider as a small company, and most of your compliances are far reduced in terms of the Companies Act. Board's report, again, a concept of abridged board's report has been brought in under the 2013 Act, which is a good thing. And DPD3, again a compliance, which is a bit painful as an auditor, because although the law gives you time till September for you to finalize your accounts, you still, they mandate the DPD3 to be given much earlier, so they keep a check there and they ensure that you finish your number, finalize your numbers there, and then they mandate the DPD3. So that's a bit of a pain point for most of the companies. Sectoral audit, again for certain companies of certain size, they mandated sectoral audit, which is a good thing. Corporate social responsibility, of course, most of you are well aware of the fact and well accustomed with how CSR has played a major role in terms of most of the companies, and slowly initially they introduced it as comply or report, then they made it as comply and keep it separately. Now they said comply, otherwise we will penalize you. So slowly they've introduced a lot of penalties in terms of CSR and corporate social responsibility related compliances. 2015 and 17 circulars made a huge difference in terms of most of the private limited companies compliances. 1956 Act 2013 Act, which was introduced on 1/4/2014, there was a huge difference. There was a huge uproar saying that they've looked all the compliances, all the companies with the same eye of a public limited company, and there being a fraud that is going to happen, etc., which became very painful for most of the private limited companies in terms of basic funding, in terms of capital, in terms of loan, etc. So they brought in a lot of changes and amendments in 2015 and 17 by the circular, which actually helped most of the private limited companies take care of their basic compliances without spending too much or without having too much of restriction or putting them into a particular cage. Deposits, loans to directors, related party transactions, interested director voting, all these, they amended it and made it with ease of doing business concept. Audit committee, CSR committee, only with a certain range of expenses, CSR committee is mandatory, etc. Removal of manager remuneration restriction. They said private limited company la manager remuneration evlo vaanganungra restriction initially kondu vandanga. They said it's my money as a director. Is it not fair that I decide how much of money I should be paid into the company? அப்படிங்கிறது பயங்கர அப்ரோரா இருந்ததுனால they decided that they will remove the restriction and you need not go to the RD, you need not go to the central government for approvals. In a fairly large manner, they've reduced a lot of compliances for most of the private companies by 2015 and 17 circular. Let's look at today as we stand, what are the basic compliances that are there for a private limited company. So, இப்போ ஒரு private limited company இன்னி தேதியில இருக்கோம் அப்படின்னா இதுதான் அவங்களோட கேலண்டரா இருக்கும் in terms of the compliances under Companies Act 2013. First, it starts with your annual disclosures, which is your MVP1 and your 164 declaration. 164(2) declaration, again, although not mandatory under law, what they have done is most of the auditors, to derive comfort from the directors that they are not disqualified, they get a 164(2) DAR 8 declaration from the directors. MVP1 is where they are interested in other companies. All those declarations are given to them, given by the directors to them. Beneficial ownership. The significant beneficial ownership has become a significant problem for most of us in terms of the compliances because அதில் வந்து சில definitions are very straightforward, easy to interpret. Sila definitions, they have gone in depth, especially with the LinkedIn and the Samsung orders, adjudication orders given by the Ministry of Corporate Affairs. They have completely remodeled or revamped the entire purpose of for which SBO is being looked at. Significant beneficial ownership, the concept is who is that ultimate person behind an entity? The corporate will who is that individual who is holding the ultimate control over that company and ultimate benefits, who derives the benefit in that company அப்படிங்கிறது தான். அதில் போய் ஒரு managing director of a parent entity who's come to India or managing director of parent entity க்கும் இந்த entity-க்கும் நடுவில் இருக்கிற ஒரு entity who's come to India and he has gone and spoken to the employees, அதனால he is considered as a significant beneficial owner அப்படிங்கிற மாதிரி ஒரு definition-லாம் கொடுத்து the entire clause has become very, very onerous on part of the companies to comply with, and also on part of most of the professionals who are certifying those forms, because இப்போ 5% shareholding வச்சிருக்காங்க 10% shareholding வச்சிருக்காங்கன்னா it is easier. It's easy to identify, easy to mark. indirectly they are holding benefits. How do you identify unless the person says a question mark, but still that is one significant complaint that most of the companies where there are 10% and more corporate shareholding that is being held directly or indirectly. Website compliances, whether you are a private company or not, most of the companies don't realize the importance of the website compliances. Even if you are a private company, if you have a website, you have to comply with the website compliances that are mandated under Companies Act, like your MGT 7 has to be updated, your MGT 9 has to be uploaded, MGT 7 has to be uploaded, your financials have to be uploaded in terms of annual returns. All that is mandatory, you have to give it whether you like it or not. But unfortunately, most of the companies, private companies, website annual letterhead website போட்டு வச்சிருப்பாங்க. So these are smaller things, but unfortunately now income tax la eppadi right left and center notice விட்டுட்டாங்களோ அந்த மாதிரி MCA லயும் இப்போ right left and center notice விட ஆரம்பிச்சிட்டாங்க. Especially now September 16th சொன்னாங்க. They have not made it practically, they have not implemented it practically. But the reality is September 16th, 2024, there is E-adjudication from Ministry of Corporate Affairs that has happened. Have they implemented it? Not yet. There are a lot of glitches as expected as usual from Ministry of Corporate Affairs. But this E-adjudication is going to be a huge boon for professionals like us, I could say, rather than looking at it from a flip side. Because what we understand is, when there is a delay in form filing, you will immediately get a notice. You will have to go and appear online, and you will have to pay the penalty, because they are very clear that there is no arguments or there is no submissions that you can make unless there is any blatant violation or blatant mistake that the ROC has pointed out in the notice. Is how they are completely taking it. A farm filing with a delay, except for annual returns, where there is a specific provision in the Companies Act that allows that annual returns and delay file பண்ணா போறோம் அப்படிங்கிற மாதிரி இருக்கா மாதிரி மற்ற ப்ரொவிஷன்ஸ்லாம் இல்லை. ஃபார் எக்ஸாம்பிள், இஃப் யூ ஃபைலிங் அலாட்மெண்ட் 15 daysல பண்ண வேண்டியது டிலேடா பண்ணோம் அப்படின்னா you will immediately get a notice. Charge form delayed பண்ணோம்னா you will immediately get a notice. Is that how it is? That is how they are envisaging. Are they going to implement that immediately? We don't know. We'll have to wait and see how they are practically implementing it. But it is going to be September 2024 matro 330 orders have been issued across multiple ROCs in India. So, you take 2 years before this or a few years before this, ஒரு வருஷத்துக்கே 20-25 order தான் adjudication orders இருக்கும். That was how it was. Now, gone are those days where adjudication the Companies Act 2013-454 very clearly gives the powers to the ROC to initiate. Gone are those days. Now what is happening is, you have investors who are wanting to come into the company, who are doing a due diligence, identifying all the violations, and they are saying, you go suo moto make an adjudication application. Actually, Companies Act suo moto adjudication application is a concept. That is compounding. Compounding is for fine. When there is penalty, you can't go. Companies Act does not envisage the concept of suo moto adjudication application at all. But out of the 300 applications, if you see, at least 150 to 200 applications that are made are suo moto applications, where the company has voluntarily gone and said, I have made a violation under these sections. I am willing to pay a penalty. Can you please penalize me? நாளைக்கு அந்த இன்வெஸ்டர் போர்டில் உட்காந்தானா he needs to be protected ங்கிறதுனால he is insisting that the company has to go through. So இன்னி தேதியில ஒரு மாசத்துக்கு முன்னூறு from October or November, once the E-adjudication is implemented, this could exponentially move to 3,000 also, we don't know. But definitely compliances, smaller compliances like these website compliances become important at that point in time, because website la நம்ம டீடைல்ஸ் போடல அப்படின்னு 1 lakh பெனல்ட்டிலாம் கட்டின adjudication orders எல்லாமும் இருக்கு. So just to give you a high importance of such a small compliance, but yet it is becoming a cost for the company. Statutory register maintenance. If there is any unspent CSR account, any circular resolution to open a unspent CSR account that needs to be opened. See, all this we have segregated into quarter wise for you to have an ease of understanding. April, May, June, first quarter, என்னெல்லா compliances ஒரு companyக்கு தேவைப்படும், or what are the basic compliances that they will be taking care of. KYC for directors, we always suggest that you start from April, So that at least by September 30th அந்த OTP வந்து முடிஞ்சிருக்கும் அப்படிங்கிறதுக்காக இதில் வந்து ஐஃபோனில் ஃபாரினில் ஐஃபோன் வச்சுருந்தாங்க அப்படின்னா OTP சுத்தமாக வராது. அதுக்கு என்ன ஆப்ஷன் எங்களை கேட்காதீங்க. Frankly speaking, MCA has given a Zoom link where 24/7 they are available அப்படின்னு சொல்கிறாங்க. இந்த Zoom linkல போய் அவள்கிட்ட சொன்னானா they will immediately identify what is the violation, what is the issue and they will sort it out. ஆனால் அந்த Zoom linkல யாரும் அலோவ் பண்ணுறதுக்கு அந்த பக்கம் யாரும் இல்லை. அதுதான் ரியாலிட்டியாக இருக்குது. Zoom link மாத்திரம் இருக்குது. கிளிக் பண்ணானா somebody will allow you அப்படின்னு ஒரு 3 மணி நேரமாக சுற்றிட்டே இருக்கே தவிர nobody is there on that side to actually allow us or to hear us. ஆனால் on record நாங்கள் இவ்வளோ சார்ட் அவுட் பண்ணோம் அப்படின்னு அவங்க சொல்லிக்கிறாங்க. பட் so we always suggest that from April first quarterலேயே அந்த DER3 KYC முடிச்சு take it out of your head. Now from this year you will have PA6 filing, which is dematerialization of shares, which needs to be mandatorily given first quarter. And whenever there is any change in directorship holding, first board meeting notice, all these are basic compliances that we will be taking care of. First board meeting hold pandrathe circulation of the sectorial standards, whether you are a private company, small company, large company, there is no differentiation. Unfortunately, from sectorial standards perspective, every company has to comply with the requirements of sectorial standards. So within 30 days, husband and wife company are 30 days kulla notice 7 days munadi anuchirukkom, 15 days kulla draft minutes anuchirukkom, 7 days kulla avanga comments edha eludana kudukkom, 30 days kulla print pannanom, entered on date podnom, அடுத்த board meeting la sign pannanom. All that compliances is mandatory. So proof of dispatch has to be kept, because now I'm again repeating, adjudication ROC pandrathe they are asking for all these things. அப்போ போய் பண்றது கஷ்டமா இருக்கும். முதல்ல அந்த proof of dispatch ஒரு single pageல வாங்கி வச்சிட்டீங்க கையெழுத்து at the time of getting the minutes signed அப்படின்னா it becomes a lot easier for a smaller private company. Of course, you have your CSR meetings, which are again mandatory. If you have a CSR committee where your spend is more than 50 lakhs and above, so adoda compliances, same circulation of draft minutes, circulation of signed minutes, all that that is mandatory for board meeting, you will still have it there. MSME form, this again, as I explained, MSME form வந்து similar to your DPT3 தான். MSME la more than 45 days, if there is any due, then you will have to intimate that there is a payment that is due to MSME companies or MSME vendors for more than 45 days. Now there is a big question mark in this. I come to that. I have a separate slide for MSME where we will discuss about it. DPT3 again I have a separate slide. We will discuss a little bit of DPT3 as we go. If there is a foreign shareholder and money that is coming, you will have to file your FLA returns, provisional initially and subsequently audited. If by first quarter you have your audited financials, well and good, you can go ahead and file it in the first quarter itself. Second, third and fourth quarter compliances. Second quarter compliances becomes very important. We are right now just completed the second quarter compliances. Again, circulation of board meeting minutes, accounts approval, board's report approval, all that basic compliances for annual general meeting will be covered in this particular quarter, where you will have to have your AGM notices dispatched to shareholders. Most of the companies, what they miss is actually dispatching it to the statutory auditors. It should be mandatorily dispatched, even if you are a private company, to your statutory auditors. Of course, last minute la poi company la inspection vandanga auditor get received in the date put kayet vaayikalam. But in case they come for inspection and don't allow you to insert a document at a later point in time, there are companies who paid penalties because they do not have a proof that they have circulated the notice to the statutory auditors of the company or the directors of the company. You hold your annual general meeting and you get your annual general meeting minutes signed within 30 days. Then in the second quarter, you will also file your your FLA. If there is any revision, munnadi provisional file pannirkom, inga revision file pandrom appadina, you can do that during this quarter. Any unspent CSR amount to be transferred to fund specified in Schedule 7, other than if there is an ongoing project, you need not. But otherwise, 30th September, you have to mandatorily move your unspent account to those funds which are specified in Schedule 7. ADT 1 for director auditor's appointment during the AGM, 15 days mandatory, so you will have to do that. AOC 4, which is your accounts, 30 days, you will have to ensure that the accounts are intimated to the registrar of companies. There are a lot of companies where the company will intimate to the income tax authorities and they will miss intimating to the Ministry of Corporate Affairs. அதில் என்ன அந்த கம்பெனிஸ் 3 வருஷம் 4 வருஷம் பண்ணல அப்படின்னா ROC ஸ்ட்ரைக் ஆஃப் பண்ணிடுறாங்க. 2018 there was a big batch of companies where they stuck off, and then they also made their DIN disqualification. Subsequently, High Court said you cannot disqualify the DIN. You can strike off the companies, that is well within your powers under 248 of the Now, they're still continuing to do that if the companies have not filed their returns for 3 consecutive years. So, please ensure that you inform the companies to also file the Ministry of Corporate Affairs returns and not just the income tax returns. Of course, wherever there is any change in the directors, it will be DA at 12 intimating them of the change. Then you move to the third quarter where MGT 7 will be filed along with MGT 8 if you fall within the compliance requirements of MSME form. This is the second MSME form that you will be filing. Now, the problem will be, as far as MSME is concerned, what do you do when you have initially intimated a specific number and subsequently you identified that MSME dues irukku. For example, there are live cases where we have seen MSME dues MSME form applicable first quarter in financials there is a specific line item in the notes that they've given on MSME dues. Now, in such a scenario, that becomes a non-compliant, so you'll have to be very careful and ensure that you take care of those compliances. If there's any unpaid dividend that you'll have to move, you can move it, and all the IEPF compliances for the 7 years, etc., has to be complied with. Now, IEPF are tedious. It used to be a simple one-time compliance. Now, they've introduced very many forms, ease of compliance, and so they've actually brought in more compliances and more trouble to the corporates in terms of moving the monies, moving the shares, and more importantly, and the share move, if there is somebody who's identified that their shares are moved into IEPF and they want to take it out, it is equally, if not much more painful to take out the shares from IEPF because IEPF is not responding. IEPF respond pannathanala raise pandrathu becomes a complaint. For example, in one of the cases that we are handling, there is a merger that we are doing. Merger ROC report is mandatory during the second motion. ROC report they have identified that they are not able to approve the form, the earlier merger form, because there is an IEPF complaint that is pending. We were wondering, complaint complaint a shareholder whose shares have been moved into IEPF after 7 years. It was an earlier listed company, then it became delisted. So 7 years move identify panni the shares we have submitted all the requirements from our end as a company. We have fulfilled all the board resolutions. We have submitted all the documents to confirm that they are the shareholders and the shares have to be moved back. Unfortunately, IEPF is not responding. Sumar ஒரு 4 வருஷமா தான் ரெஸ்பாண்ட் பண்ணாம இருக்காங்க. So 4 வருஷமா ரெஸ்பாண்ட் பண்ணாதனால the company where we had merged 4 years back is still shown as active because the INC 28 form is not approved. Because that is shown as active, this company we are not able to merge currently because that company is still shown as active. So, ஒரு IEPF form, which is a very simple, otherwise, ஒரு shareholder 7 வருஷமா respond பண்ணலன்னு கொடுத்த இதுக்கு, the company's entire merger is getting delayed by at least 6 months because of this issue. And IEPF இங்க சென்னையிலும் கிடையாது, டெல்லியில தான் போய் பார்க்கணும் அப்படிங்கிறதுனால, டெல்லியில போய் we are engaging a professional and identifying and trying to sort out a otherwise simple issue. So, you can imagine how much of a complication an IEPF complaints would trigger for a company. And you have your annual performance report APRs if it is applicable to you. And MGT 7 and MGT 8. MGT 8 is as good as the secretarial audit. Munadla form 66 obtained in 1956 with 33 points. Very similar to that, MGT 8 is mandated for certain companies with certain limits. And then you have your 4th board meeting where you have your regular compliances to ensure that you are well within the timelines as required under 173. Moving on to the MSME form. The MSME form, I was explaining to you all the issues that are there. One of the issues that most of the companies don't understand is 45 days தாண்டி pay பண்ணாங்க அப்படின்னா ஒண்ணு income tax they are saying that it will not be considered as an expense. So most of the companies don't even realize it. Unfortunately, there is a flip side to this. Larger companies, larger listed companies say, if you are Udayam registered professional or service provider or anybody, I don't even want you. ஏன்பா அப்படின்னு கேட்டானா இல்லை எங்களோட terms 60 or 90 days நான் payment உங்களுக்கு நான் 45 days குள்ள பண்ணணும், it is not within our terms, so I'll not even take your services அப்படிங்கிறாங்க. So I personally know of companies where they have come back and said, sir, எங்களோட உதயம் certification கேன்சல் பண்ணிடலாமா? ஏன் கேன்சல் பண்றீங்க அப்படின்னா, இல்ல we want to provide services to a large listed entity, 40,000 50,000 crore turnover company, but அந்த மாதிரி ஒரு கம்பெனில எங்களை வந்து அக்செப்ட் பண்ணிக்க மாட்டேங்கிறாங்க because we have a உதயம் registration certificate in our hand and they have to pay us within 45 days as per law அப்படிங்கிறாங்க. அதனால கேன்சல் பண்ண முடியுமா அப்படின்னு கேட்குற அளவுக்கு கூட the flip side of having the certificate in your hand. But nevertheless, private limited companies பத்தி பேசுறதுனால most of the private limited companies don't even realize that when they have MSME dues and it has to be paid within 45 days, otherwise it will be considered as an exemption in your income tax. And more importantly, when there is a delay, 3 times of the RBI bank rates they have to pay, that is law. So MSMED la poi, if you go and make an application, they don't even give too much of an opportunity for the company to represent. They just pass an order and it is considered as good as a degree, because I personally know of companies which have moved into IBC because the due is only 60 lakhs, but on the interest, because it is 3 times the RBI rate, the interest is another 50 lakhs. அதனால 1 crore threshold தாண்டறதுனால ஐபிசில போய் I have got an order, the order is as good as a degree, although it is not considered as a degree, but it is as good as a degree, and therefore the company is moving into IBC அப்படிங்கிற அளவுக்கு there have been situations where the companies have been pushed into. So MSME and MSME payments becomes quite important for most of the companies. Practically இப்போ V3 form, V2 version 2 of MCA இருந்த வரைக்கும் there was no practical difficulties as such in MSME interpretation. But today as it stands, even if there is one delay out of your, let's say 50 vendors who are MSME vendors, அதில் during the previous year ஒருத்தருக்கு 45 days தாண்டி இருந்தாலும் இந்த மொத்த 45 பேர்கிட்ட கூட பண்ண டிரான்சாக்ஷனை you have to upload in the Excel in V3. So if there is no delay, then there is no requirement for you to file MSME form at all. But if there is even one delay, then you have to give the entire transactions of all MSMEs, is how most of the companies are interpreting it. But there is another interpretation also where they say, என்ன delay இருக்கோ beyond 45 days, அதோட details கொடுத்தா மட்டும் போதும், because the law is not clear in terms of that. But the form, V3 la there is an Excel that they are asking us to attach. And the attachment la, it is not saying those that have exceeded 45 days alone. It is saying all the transactions that are there with MSME, you will have to upload abdin irukke. So there is a lack of clarity in this, and as professionals we may have to take a call and do it. Our suggestion, comply always, especially with MCA being so actively becoming a Ministry of Finance mari aayindu varanga, Ministry of Corporate Affairs thavara maybe ore minister ndirthanaala andha mari map pandrangala theriyala. But the amount of adjudications and the penalties that are being issued, எதுக்கு வந்து நம்ம பேசாம ஃபைலே பண்ணிட்டு போயிடலாம் அப்படிங்கிற ஒரு கால் எடுத்துக்கிறது is a better way of handling it. Disclosure of unpaid MSME dues beyond 45 days in director's report. Again, this there are multiple interpretations to this. One, CARO does not capture MSME 45 days tandi, but notes on accounts captures it. Because the notes on accounts captures it and it is a violation, should you also mention it in the director's report? There are two ways of looking at it. There are companies where they have disclosed that in certain cases they have exceeded beyond 45 days and therefore it's a non-compliance. Since no, they have accepted and they have intimated in the director's report. Again, auditor's responsibility, you have to report in CARO if there is a default beyond 45 days and disclose amounts and interest outstanding in the notes to accounts. Auditor's report qualification, your SA 705 says, qualified opinion if payment exceeds 45 days, non-compliance with MSMED Act. There are again two views to this. If there is any view where any of you feel that MSME should not be forming part of the CARO reports or should not be forming part of your qualifications, you may take your stand. But there are companies where we have seen practically that they have disclosed and they have qualified it fairly in their MSME reports. Any doubts or can we move on? DPT 3, another area where, yes sir. சரியா கேட்கல சார்.
Yeah, the interest on the delayed payments to the MSME. Do we need to make a provision based on what you just mentioned now?
Mandate.
Of the
MSMED Act is mandatory. It says very clearly, it says MSMED Act padi, if there is a delay, you have to make a provision.
So the moment you make a provision, you are accepting your liability.
Yes.
So in that case also, do you need to qualify?
So the qualification is beyond 45 days. Qualification is where beyond 45 days there is any dues, you have to show it as a qualification. Where you have created a provision, again, in fact we were just discussing it on our way that there are companies where within 45 days, let's assume for a moment 31st March we are closing our books. 15th March there is an invoice. So the due will be spilling over to the next year. So 15 days there are companies where the auditors have created a provision for that amount and they have shown it as nil so that MSME form need not be filed. So this is a stand that some companies have taken when it is not due. When it is due and you have not paid it, you have to file your MSME. Provision created or not.
Just in case there is a dispute, owing to which you have not made the payment.
So dispute irundalum, you should have to take it to the MSMED and ensure that the dispute is addressed appropriately. Not making a payment, maybe you should have taken a legal action and you should report that I have taken legal action, or you should you should get the company to put it in the notes to accounts such that it is captured properly that there is a dispute and therefore there is a delay. But at the most, reporting is mandatory beyond 40 days.
So if it is like 31st March as you mentioned, the closure of the books, as on that day I don't have any
dues
or delay in payment.
I'll two views to this. One view as of closing balance nil MSME form panna thevilla அப்படினு சில பேர் எடுக்கறாங்க. Closing balance irukku, but that closing balance is not beyond 45 days. Therefore I need not do MSME form no review irukku. So it is whichever view the company is comfortable, we can suggest to them and take it. Our view is if it is not beyond 45 days, there is no requirement for us to intimate MSME form because the MSME form itself gets triggered when 45 days due tandi payment panalana, not otherwise.
But my question is during the course of the year, if you had instances that you have exceeded the 45,
yes,
but you have settled during the year,
you still have to intimate.
You still have to intimate.
Absolutely.
It's
not that as of 31st March balance irundana abdina. If there is a 45-day delay, beyond 45 days delay, you still have to intimate. Moving on, DPT3 form. When is DPT3 form required? Annual returns of deposits or when there is loans or money is not considered as deposit under Companies Act the company has taken, then you will have to intimate to the Ministry of Corporate Affairs. Here, the Chartered Accountant certificate has to be attached, and now more importantly DPT3 form CA the auditor of the company only has to sign abdingra mari they made it mandatory where the company has accepted deposits. In such a scenario other professionals cannot sign, the form itself has to be signed by the Chartered Accountant of the company. What are the key pain points that are there as far as DPT3 is concerned? One, the classification. What is deposit, what is non-deposit? In terms of borrowings, in terms of, especially when it is loan from shareholders, most of the companies don't show it as deposits. So that becomes a very difficult scenario in terms of DPT3. Loan from shareholders is a deposit. It is just that there are certain compliances that are exempted. But it is considered as a deposit, you still have to file your DPT3s. Idhulana most of the companies they make a mistake in terms of their financials where they don't disclose it properly and ultimately financials loan from shareholders DPT3 file பண்ணலையே சொல்லிட்டு delay filing பண்ணிட்டு இருப்பாங்க. So this is one area that as auditors if we can identify and intimate to the companies, it becomes the company becomes more compliant. Verifying outstanding deposits and matching with the balance sheet. See the June quarter we will have to file our first DPT3 the bigger problem is when the actual financials are being finalized, there is a difference. In June you would have already intimated a particular amount. Then when you are finalizing there will be a different amount. There are some CA forms where they say Now, even if it is delayed, I'm okay, but I will not give you a certificate until I sign the financials and until I am sure that the audited numbers are right. So be it, you file the DPT3 delayed or standard chartered accountant forms. So chartered accountant, they say, as far as this number is concerned, I'll freeze it now. As far as the entire balance sheet is concerned, I may do it later updating the standard chartered accountants. Again, it depends on the auditor and the company, the wavelength with which they look at the whole thing, and what is it that the company wants to comply with, and how the auditor is also supporting them in terms of the compliances. The exemptions and the exemptions compliances careful helps a lot, right from 100% of the paid capital free reserve, startup company now 5 years since incorporation, and it should not be a subsidiary. All these exemptions that are there, you should be very careful, because most of the companies in the interpretation of whether it is a deposit or not a deposit, they always, there are companies where they made a mistake in terms of interpretations and they paid unwanted adjudications and penalties where the ROC has identified, or somebody at a subsequent point during the due diligence have identified. Consequences, because it falls within the category of deposits, the consequences are quite high. 1 crore or twice the deposit amount extending 10 crores. See, DPT3 form, otherwise it looks straightforward, but if you violate, it could be quite a costly violation, is what we wanted to highlight here. And 5,000 rupees per continuing default on this is not an additional fee. It is the adjudication fee that you will have to pay if the ROC initiates adjudication, or you go and initiate an adjudication against on the violation that you have made. Another key area is PAS3 and SS7, where there is any allotment that is made by the company in terms of any rights issue or any private placements that are being made by the company. One of the fundamentals during the financial balance sheet prepare pandrathe, master data la irukra number ku financials la irukra number ku there will be a mismatch. Master data is what MCA record has in its, shows in its the capital, etc., the authorized capital, the paid up capital. Adukku financials la irukra number ku there will be a mismatch. Adha mari mismatch irukrathe, it is but right that before the financials are finalized, if you could have a look at the master data, because most of the companies, they don't even intimate that we have done an allotment, they will not even intimate that there is a PS3 that is there, or they wouldn't have properly entered, or no further issue and equity and preference share classification la authorized capital la and the equity preference classification kaamchirukka matanga, or when they had done the classification, adliye class A, class B shares la the entries wouldn't have been properly captured. But your PS3 form would have all the details, your board resolution would have all the details. So master data liyu, company la irukra ERP liyu, actual la irukra financials liyu, there could be variances. So at the time of allotment or at the time of finalization of accounts, it is prudent that you get the PS3 form and the SS7 form that they have filed with the Ministry of Corporate Affairs. Go through it to understand what they are saying to what is actually there in the MCA records is the same or not. If not, either change the SS7 PS3 or ensure that the financials captures it properly, because again there are multiple companies where they paid quite a bit of penalty, especially in private placement scenarios. The penalty is 2 times the amount or 2 crores, whichever is higher on the Marila Irkatnala. There becomes quite a bit of tedious, quite a bit of costly affair in terms of these smaller issues. So verify that PS3 is filed within prescribed time, 15 days அப்படினா 15 days குள்ள அவங்க PS3 file பண்ணிருக்காங்களா அப்படிங்கறத பாத்துடுங்க, because there are companies where on 20th March they would have had an allotment, but the PS3 would be filed after 31st of March, but நம்ம financials பண்ணிருக்கிறது அது capture ஆயிருக்காது. There could be quite a bit of issues in terms of that. So private placement compliances again, PS4, PS5 should be in place. Why are these important? Because in CARO you are commenting that all the private placement compliances and rights issue compliances have been duly complied with. As an auditor, you are also confirming that it becomes important for you to verify whether the company has complied with all these requirements also. So ensure that all the, especially on the PS3 la attachment la V3 la there is a specific Excel. That Excel says that you will have to capture the PAN number of all the allottees. While actually if you see the act and the rules la Now they modified and said that PAN number should be captured, but earlier it was not there. So if PAN number capture all and all, they are in violation of 42 read with the rules, and therefore it is not a compliance. So such a small situation of PAN not being captured is being considered, and especially in the September 14 cases across India where they have said that you have not captured the PAN number of the allottees, and therefore you are in violation of Companies Act 43. And fortunately, in rules or violation smaller penalty around 1 lakh, 1.5 lakh, 2 lakhs. So the smaller penalty becomes applicable because that is there in the rules. Whereas assuming it was a violation under the Act, then 42 the entire money has to be refunded. 2 times of the whatever money that you have taken has to be paid, plus interest has to be paid. That is the penalty, and unfortunately ROC does not have the powers to reduce the penalty as per law. So whatever is the minimum penalty, they will have to levy. And now, whether we like it or not, 454(7) regional director do not have the powers to modify the orders of Munadla. For example, just 6 months back, there was a case we were handling where the company did not move their CSR funds, CSR unpaid account within 30 days open from the end of the year. 30 days open. They had opened it on 5th or 6th of May, so it exceeded by 5 days. Therefore, the company wanted to go for adjudication because they have investors within the company. So they went for adjudication. ROC levied a penalty of 36 lakhs, while RD, when we went for an appeal, 5 naal delay ku 36 lakhs penalty katta sonnaanga. We went on an appeal. RD reduced the penalty to 1.2 lakhs for the company and the directors. They were okay to pay 1.2 lakhs. The 5 naal delay. But now, what the RD is saying is, the very same matter, if the company has delayed it by 4 days, if the ROC levies a penalty of 36 lakhs, even if you come on an appeal, unless there is something wrong in the order, they will not have the powers to modify the amount. Is what the Ministry of Corporate Affairs has given an internal note to all the regional directors, and therefore they will not. Sir, 5 naal delay ku 36 lakhs kattanona, you can imagine. Idukke apdiye 42 ku eduthu paathona, MGT 14, which is a very intimation to the Ministry of Corporate Affairs, ROC, that there is a private placement that is happening, and there is a special resolution that has been passed, or there is an ordinary resolution that has been passed, as the case may be. If you delay that by 2 days and you have taken a money of 2 crores, you will have to repay the 2 crores, you will have to pay a penalty of 4 crores plus interest. This is Anjanal MGT 14 delay. And you do not have a power to appeal. They orders, there have been multiple orders. If you look at ROC a few months back, there are multiple 42 section violation orders, and they have gone on an appeal, and RD has reduced the penalty from 4 crores to say 1 lakh, 50,000, 75,000, 2 lakhs, as the case may be. Now the same RD is saying, I am unable to reduce because I don't have a power. So what most of the companies have requested the RD to do is mention it in the order that they do not have the powers, so that we can go on a writ petition against the Ministry of Corporate Affairs and get an order that when it says modify, RD should have the powers to also modify the amount, and not just whether it is in violation of the facts or violation of the law. Is there any writ that is pending? Yes, there are many writs that are pending. Notices have gone to Ministry of Corporate Affairs, but there is no order that has been received from any High Court saying that such an order, such an power is available or not available. There is clarity illa. So, in fact, ingloda 2-3 adjudication RD ku naangle solli, sir neenga podadinga adala 10 lakhs, 26 lakhs penalty, 26 lakhs or 2 lakhs ஆகுங்க சார்னு சொல்லி அப்பீல் போயிருக்கோம். அந்த மாதிரி கேஸ்லாம் if they assuming RD says nothing doing, I don't have the powers னு எழுதி கொடுத்துட்டாங்கன்னா it becomes a problem. So what we have told is odam sir adjourn it by a month or so அப்படின்னு சொல்லி we have moved it. I hope this is within 4 walls. We moved the dates such that when we get a writ order, RD will get back his powers and we can get the appeal cleared by him. அப்படிங்கிற ஒரு clarity is how we are thinking. But today, as it stands, adjudication orders and appeals is a very, very, very big issue for most of the companies once E-adjudication starts kicking in. So, smaller compliances like these should also be ensured.
Sir, You said that in the case of delayed filing, the penalty or the interest rates are pretty high, no?
Wow. 42.
Okay, let's take a small case of filing AOC 4 and MGT 7. Let us say you delay it within 1 month from the AGM date you have to file. Let us say you take it 5 days. Or you just pay a late fee and why there's such disparity in?
Sir, AOC 4 MGT 7 may not be a very ideal example because the Companies Act itself captures that if you have delayed 446B, I'll tell you the exact section number, where it says if AOC 4 MGT 7 is filed, even with a delay, there is no necessary or ROC and RD cannot take a prosecution against the company for such scenarios. AOC 4 and MGT 7 பொறுத்த வரைக்கும் நீ ஃபைல் பண்ணா போதும், அது டிலேடா ஃபைல் பண்ணானா அடிஷனல் ஃபீயோட போயிடுமே தவிர there is no requirement for you to go and get yourself pay a penalty separately or they will initiate prosecution கிடையாது. But any other form they have a right. PAS 3, MGT 14, JNL, INC 28, you name it, they have a power. Unfortunately, ROC says Act does not provide that leeway. Therefore, I am forced to send. Sir, especially with CRC coming in, ROC இன்னைக்கு இருக்கிற 25-30 பேரோட entire day job is to identify violations and send notices because form approvals are not there. Most of the forms are STP forms, straight through process forms and பண்ணியாச்சு. ரெண்டாவது, most of the forms wherever there is approval it goes to CRC New Delhi. So centralized regional central it is going and sitting there and it is getting cleared. So ROC is rolling in. Their role entirely becomes identifying all the violators, start issuing penalties. Or hold these E-adjudications and start levying penalties and fines. So this is what the role is envisaged, and frankly they are also very clearly being instructed that penalties have to be levied and their companies have to pay it. This is where it stands as on date. PAS 3 Demat 30 September Talala idi vunda mari most of the private companies or most of the companies where you have not dematted, you cannot transfer, you cannot allot further shares. We were all hoping for an extension of Demat, not because the companies have not gone, more so because these NSDL and CDSL chaps have kept the application pending for quite some time. Applications pending, 16 lakh companies are there, sir. So it is almost impossible for them to have complied with all the requests that are made to them within the timeline. We were all hoping for an extension. The Ministry of Corporate Affairs said nothing doing, comply with it. So there is again two interpretations to this. Circular Vandanilende, until you demat, you cannot do the share transfers or allotments no review. Or 30th September you cannot do the allotments or transfer no review. Let's take the easier route out also. Today, if there is any allotment, such allotments are not allowed. There is any share transfers, share transfers are not allowed until you get the ISIN number. That is where it stands today. And as auditors, you will have to be extremely careful on both sides. What are those sides? Now, applicability of Demat for unlisted public companies, private companies, it is applicable other than what is mentioned below. And government companies, it is not required. Small companies, it is not required. Small company definition I had already explained to you. 4 crore paid up capital, 40 crore turnover companies, up to companies need not comply with this requirement of Demat. But otherwise, small private limited company which is a subsidiary of another private company is still considered as a private company and therefore it is applicable. Private company which is a subsidiary of a public company is deemed a public company and therefore you will have to comply with the requirements. Section 8 private limited company which meets the threshold for small companies classification, then a Section 8 company cannot be classified as a small company irrespective of whether it is a paid up capital, whether it's paid up capital and turnover. Therefore, it will be treated as a normal private limited company and therefore you will have to comply with the requirements of Demat. So, Section 8 companies, Demat panno. Private limited companies, Demat panno. Small companies matram Demat panna. This is what, in simple terms, for us to understand. So, companies which are dematted can transfer shares or allot shares. Companies which are not dematted should not. Strictly from 30th September, in the interpretation you should not be doing it, is the very clear stand that the Ministry of Corporate Affairs is giving to us. Apart from this, PA6 compliances twice a year has to be complied with. Private companies and unlisted public companies must file PA6 with the Registrar of Companies within 60 days of conclusion of each half year. So 31st March 60 days unne, 30th September 60 days unne. You will have to comply twice as far as PA6 is concerned, which is more of a reconciliation and intimation. There is again a view that promoters, directors and key managerial personnel shares have to be dematted, but law is very clear that every company, every shareholder who is having shares has to be dematted and the company has to have an ISIN number. Demat before transfer or subscription, securities must be dematerialized before any transfer or subscription by any shareholders. Here what we are taking a stand is private company demat panniyachuna, it is freely transferable. Munnadala private company transfer the share certificate will come to the company will hold a board meeting. The date on which the board meeting approves is the date on which the transfer is there. This is what we are all well accustomed to. Now in a demat, assuming I have 100 shares of a private company, I can just transfer that to say Balu sir, and Balu sir would also receive the shares because it is dematerialized. There is no requirement for the company to have to go to the company for a board resolution. Scenario, there are two methods to it. One, you can go and intimate the NSDL and CDSL to freeze the Demat account. Freeze pandradhukku. So every transfer you have first freeze 15,000. Every transfer you have to unfreeze 15,000 and you have to again freeze 15,000. So every transfer 30,000 rupees pay pannona, not practically feasible. So what we have suggested for the companies is have an amendment in your articles of association. The amendment will say that the title of the shares will not be valid until the board approves it. So for example, I have transferred shares of a private company to Mr. Balu. Then Balu sir does not hold valid shares until the board approves it. The articles will govern this is a stand that we at Aksham are personally taking this as a stand. Any views on this stand? Of course, either there is no sanctity. We will have to see how much of validity this would hold only over a period of time. 30th September, so we will have to see how much of sanctity. But we have already suggested all the companies going for AGM to include this as a clause in their articles of association, so that amendment in the AGM as part of the notice, so that there is at least some sort of a restriction in the share transfers. Yes, sir.
Unlisted shares.
So unlisted companies could demat, sir. That's the law.
Will they issue? I have not seen.
Puriyala, sir.
I have never seen any unlisted.
Sir, private company demat pannonu soltale, sir. Why unlisted? Even private companies, which is not a small company, has to demat. So you can imagine private company, husband and wife company, two shareholders but we have crossed the threshold of a small company. Say for example, my turnover is 100 crore turnover. I will have to also, with the two shareholders, still get an ISIN number, have to demat accounts and have all my shares dematerialized. Problem arises, for example, because I handle a lot of disputes and litigations in NCLT, there are a lot of problems that will arise the moment there is demat of shares. There is no requirement for board resolution. There is no requirement for me to go to the board, SH4, form, sign, you can just transfer the shares to another person and he can claim that he is a shareholder and he can just move on, provided the articles has a clause. But of course, we can take a stand that the Companies Act itself protects that private company shares are not freely transferable of DNA. But for that, somewhere they will have to also enable that I don't transfer my shares otherwise in Demat also. Although the law says that it is not freely transferable, but in practically it is freely transferable because I can just give the shares to another Demat shareholder without any requirement or without going to the company. So how is this being viewed? I'm absolutely confident that there will be quite a bit of cases that will come up because of this issue. How do we handle, how do we tackle? For us, for now, what we are able to visualize is have a clause in your articles so that at least the articles very clearly says that the title is invalid if there is no board resolution of dinner. More importantly, chartered accountants, auditors, start auditors in the financials disclose more than 5% shareholders இருக்கிறது எல்லாமே. அந்த மாதிரி more than 5% shares இருக்கிறத disclose பண்றதுக்கு company will give you the details. அந்த details நம்ப முடியாது. ஏன்னா there could have been a share transfer that has happened which even the company is unaware of. That could be a reality. So அப்படி இருக்கிறது இப்போ listed companyல we don't rely on the company. We rely on the RTA or the depository who gives us a certificate saying these are the top shareholders holding more than 5% of Demat. So அதே மாதிரி for every private limited company or a unlisted public limited company where they have Demat of shares, we suggest and recommend that you get the certificate from an RTA and or the depositories as the case may be, that these are the shareholders as on the date on which you are closing the accounts or as on the date on which you are auditing, that these are the shareholders of the company who are falling within the top 5% or 5% and above. அப்படிங்கிற மாதிரி எடுத்து போனானா at least as an auditor you have something to back up. And next step is annual returns la as company secretaries when we certify we will also rely on that certificate and we will also do it, or otherwise we will have to get a separate certificate from the RTA and rely on it because it becomes too much of an onerous. இன்னி தேதியில statutory records la statutory register la irundhu eduthu paathiralam, whatever is there in the register is what is final nu the law is very clear about it. Going forward there is not going to be any statutory register, physical register, everything is Demat. So we will have to rely on RTA to get the certificate as our humble view. For those who have not dematted, they should not have gone for transfer or issue of shares. If they have, it has to be qualified. It is a violation, and whether the title is there or not, again depends on whether you have a clause in the articles. What does the law say? How is the MCA looking at it? How is the courts looking at it? We will have to wait. Any doubts, or can we move on?
I think we may have to amend all the articles, no, for existing private limited companies.
So that is one.
The new ones you can always include the clause.
Yes, new ones the problem illa, but again, see stricter interpretation. Some people are saying, "Any amendment no, every private limited company law articles, law overrides the articles. Article says, law says that my shares are not freely transferable. So when the law says be not freely transferable, there is a requirement to have a separate clause in the articles that would again reconfirm it. Abdingar review ketana we don't have an answer.
But I thought the law only says that you can have a provision that it is not freely transferable.
Law says private limited company definition la shares are not freely transferable. Definition la private limited company definition la it says not freely transferable. It does not say subject to articles.
Okay.
Does it say definition of private limited company? I don't think it says subject to the articles in the definition.
Not freely transferable.
No, I thought the words were, if I'm right, that they can have a provision for restricting the transfer. I am not sure about the provision. Maybe you're right. It is saying explicitly.
But whichever be the case, having a separate clause, given that it is Demat, would be more prudent.
But having brought this, is it not appropriate that they bring in the mechanism in CDSL and NSDL?
Cost-effective mechanisms.
Yeah, to ensure that the transfer, off-market transfer cannot be made without board approval.
You ask them, they say it is there. Unfortunately, they are saying it is cost 15,000.
Freeze and freeze.
So they are saying you freeze it. So we said, okay, go on and freeze it. They said 15,000.
It is not appropriate. No?
Seri, we thought one time 15,000 na pay pannom appdinu seri okay proceed pannalam pannom. Then just as a conversation, they didn't even highlight it to us. As a conversation, we were asking, assuming share transfer pannona, automatically sir, you have to pay another 15,000. Apra thirupi please, apra maybe 15,000 sir. Ayyo, every transfer ke 30,000 rupees spend pannona makes no sense for smaller private companies to spend that much of a cost.
On these lines, like, what will happen for the number of shareholders?
Adume.
Who will have control?
See, ellame ultimately the company and the board is only responsible. The problem is the control.
But they don't have control.
Exactly. Bring it to the articles. Such இப்போ என்கிட்ட 200 ஷேர் இருக்கு. நான் 200 பேருக்கு ஒரு ஷேரா கொடுக்குறேன். ஆல்ரெடி 10 பேர் இருப்பாங்க. சோ 210 ஆயிடும். அப்ப கம்பெனி வயலேஷன், பிரைவேட் கம்பெனியே கிடையாது. டீம்டு பப்ளிக் கம்பெனி அப்படின்னு எடுத்து போனா ரொம்ப ஈஸியா இருக்கு. Litigation related matters la dispute
this goes to high court or something for litigation, it will get thrown out on unless government makes some changes through NSDL and series.
It's a dichotomous situation, sir.
True.
You lose, the private company loses sanctity of restricting the right of shares.
Absolutely, but today, as it stands, we are in a situation where there is no
Then you
clarity.
should find a new name for it. It's not a private limited company. Something between private and a public limited.
Correct. Deemed private limited company அப்படின்னு சொல்லிக்கலாம். Deemed public limited company தான் இருக்கு. Deemed private limited company வேணா நம்ம பேர் வச்சுக்கலாம். Can we move on? Quickly, some of the common errors that are there in the financial statement of a private limited company. These are errors that are not just pointed out by us, but these are the errors where unfortunately a lot of companies have paid huge penalties through adjudication to multiple statutory authorities, multiple ROCs across India. SIN number not being mentioned in the financials. இது வந்து ஒரு சிம்பிள் ஒரு SIN number எடுத்து காப்பி பேஸ்ட் பண்ணிருக்கலாம். ஒரு கம்பெனி 2.5 லட்சம் ரூபாய் பே பண்ணாங்க. SIN number financialsல மென்ஷன் கையால எழுதியிருந்தா கூட பரவாயில்ல. SIN number mention பண்ணலன்னு they had to pay 2.5 lakhs. So you can imagine such a small simple compliance, but ROC is taking it very, very seriously. Director DIN number not mentioned in many financials. Very, very painful. Director name இருக்கும், directorன்னு இருக்கும், date இருக்கும், place இருக்கும், DIN number இருக்காது. DIN number இல்ல அப்படின்னா it is considered as a violation and they are again ending up paying 50,000, 75,000, 1 lakh penalty as the case may be. Balance sheet, P&L and auditors report dates are different. Now, again, there are cases where dates could be different. For example, directors are sitting in US, private limited company, VC-la they can conduct a meeting. Auditor is sitting in India, in Chennai. So, directors will sign it on a particular date and say place as US, let's say New York, and inga it will come to the auditors, the date will be different, and auditors will have a different date and place. But you will have to justify. Good case, the entire meeting was in VC, place was different, in a foreign location, and direct auditor was in Chennai. Unfortunately, the date was the same. So there, ROC had penalized, saying, how could you have potentially signed the financials there, and at the same time the directors or auditors signing the financials here on the same date. Therefore, I am penalizing not just a company, the auditors were also penalized in such a scenario of 50,000 rupees. So you can imagine, upon the very scenario, the easier thing to do is digitally sign it. Now, digital signature date, நீங்க என்னைக்கு அதை ட்ராக் பண்றீங்களோ அந்த டேட்டை தான் கேப்சர் பண்ணும். அதுக்கும் ஒரு சஜஷன் இருக்கு. லேப்டாப்போட டேட்டை மாற்றி வச்சுட்டு பண்ணோம் அப்படின்னா லேப்டாப்போட டேட்டை தான் அது கேப்சர் பண்றது. இன்னும் இட் இஸ் நாட் மேப் டு அன் இன்டர்நெட் வேர் இட் இஸ் மேப்பிங் இன் த டேட் ஆஸ் இட். பட் அன்பார்ச்சுனேட்லி வாட் இஸ் ஹேப்பனிங் இஸ் 30th September சைன் போட்டுருப்பாங்க. 30th September அன்னைக்கு ஆக்சுவலி சைன் பண்ணிருக்க மாட்டாங்க. 5th October அன்னைக்கு சைன் பண்ணிருக்காங்க அப்படின்னா 5th October டேட் 30th September அந்த பாக்ஸ்ல டிஜிட்டல் சிக்னேச்சர் டிராக் பண்ண இதுல ஜூம் பண்ணி பாத்தீங்கன்னா ஒரு டேட் கேப்சர் ஆயிருக்கும். அது 5th October இருக்கும். இதை வச்சு ROCs have also identified that you have subsequently signed and therefore I am penalizing you. So you will have to be very careful in ensuring that the dates, the place are properly captured and justified. It can be different, but there is a justification to it. It should not be the same if the places are different. கடலூர் சென்னை அப்படின்னா சமாளிச்சுக்கலாம், ஏதாவது சொல்லிக்கலாம். கடலூர்லேருந்து சென்னை வரதுக்கு 3 மணி நேரம் தான் ஆகும், அவன் ட்ரைவ் பண்ணி வந்து கையில் போட்டு கொடுத்துறாங்க அப்படின்னு அட்லீஸ்ட் தேர் இஸ் சம் ஜஸ்டிஃபிகேஷன். யூ ஆர் பேர் இங்கே வரணும்னா யூ cannot justify it at all unless you were able to do some transmission from there to here. Anyways, so balance sheet P&L auditors dates difference is becoming a problem. Auditors report mentioned CARO 2016 instead of CARO 2020. Very common copy mistake errors that are happening, so we'll have to be very careful. IFSC not applicable, however mentioned as applicable. Again, the internal financial control is one major area where there are some CA firms where they have a very strict interpretation saying that if you have not complied with filing of your returns, then it's a violation, and therefore if you have violated, IFSC will be applicable to you. அப்படியே ஒரு ஸ்டாண்ட் எடுக்கிறாங்க. Actually, அந்த ஸ்டாண்ட் எடுக்கிறது even the ROC is not accepting that view, but unfortunately some CA firms have taken a very strict view and they have decided and they have included IFSC, although it is not applicable on a straight basis. So, and the many situations, how does the company handle? It is becoming quite tricky for the companies to handle because it is actually not applicable. But stricter interpretation of the law, it is becoming applicable. So, we will have to manage it at such point in time. Mismatch in financial notes and numbers. So, balance sheet long-term borrowings 22 short-term borrowings. That mismatch is becoming quite common because of the mapping error. Comparison of the last year current financials, last year current financials. So, current year previous financials numbers mismatch. This apart from the regrouping and reclassification. In fact, regrouping and reclassification is a very, very interesting adjudication order where I had appeared for one of the chartered accountants before the ROC, one of the stat auditors of a company. Of course, and strict interpretation only when there is a inspection and there is a fraud that has been detected and the company is penalized. And the situation strict interpretation. But regrouping is less than 0.01% of the total turnover. And the regrouping, of course, amount wise 5 crore. But percentage wise not even 1%. So ideally, it will not even fall within the materiality definition of the auditor. But unfortunately, in that case, the ROC did not accept our stand and he said, you may look at materiality from the basis of the turnover or the capital, but we look at materiality in terms of the actual numbers of the standard. 5 crores is as a number big. 5 crores as a number is big if your turnover is small. When your turnover is say 1000 crores, 5 crores is not a big number. They did not accept it and they went ahead and they penalized. Of course, they penalized only 10,000 rupees. That's a separate thing altogether. But they said it is, as an auditor, you should have qualified. In fact, notes and accounts regrouping specifically. You have not qualified the regrouping and therefore it is a violation. So they have penalized and it, of course, it is there in the MCA website for anybody to see. But today as it stands, ROC in certain cases are taking very strict interpretation whether we like it or not. So comparison between last year becomes very important. EPS and diluted EPS calculations have been wrong in a few instances. RPT transaction in notes to accounts, mismatch between notes to accounts and financials. Financials low number kamchirukanga, notes to accounts la breakup pandrathe total potana where number varudhu. So that is becoming a problem. MSME company would have filed nil returns. I think we have already discussed this. Company would have filed nil returns. Financials will show dues. Notes to accounts may not be signed by auditors and directors. See again, there are two views to this. Auditors say notes to accounts is that of a company's. As an auditor, I need not certify it. It is only for the company to sign it. I have signed the financials, the balance sheet, the P&L account and the cash flow, and I have given the auditor's report. Where is the need for me to sign the notes to accounts of the? But there have been certain ROCs where they have not accepted this stand, and they said notes to accounts should also be signed by the auditors of the. Whether they have gone on an appeal, we don't know. But as it stands, in that particular case, we saw that they had levied a penalty. No company to maintain audit trail in respect of all entries, especially from 23-24, audit trail becomes mandatory and it has to be qualified if it is not there for all the entries. I'll just come to the fag end of our presentation. Now I'll be discussing certain specific adjudication orders that we have captured as part of our monthly. We release a newsletter called as Pragya, where we capture all the adjudication orders across India by all the ROCs, capsulated into each headings under each sections. So I'm just taking a few for ease of reference here. Of course, we are talking about private limited companies, but Sun Pharmaceuticals or INC accounting standards 24 became a very, very big issue from an auditor's perspective, where the auditor was also penalized 50,000 rupees. In fact, personally, our view is it is impossible that until the company gives you a confirmation that it is related party transaction for an auditor to have gone that deep. If you read Sun Pharma order, literally one company investigation journalism mari poi yaroda chithuppa yaroda perippa appadinu kandupidichu kondu varanum appadina ஒரு கம்பெனி மாத்திரமே தான் ஆடிட் பண்ணிட்டு இருக்கணும் என்டையர் லைஃப் டைம்க்குங்கிற மாதிரியா இருந்து. பட் அன்பார்ச்சுனேட்லி that is how it is being looked at. Although we are discussing private limited companies, I thought that is a relevant order of a public limited company, public listed company that is relevant. Non-quantification of related party transaction, a violation. Notes to accounts quantifies related parties. However, company has not maintained minutes registers as required under Companies Act. Therefore, the company was penalized around 1 lakh penalty. Company has not filed its returns from 2017 to 22. Upon notice sent, the company had given a very interesting response. I thought this was funny for us to actually look at edukku returns file pannala appadina due to implication of chartered accountant under false and frivolous grounds and further him getting arrested by Mr. Abhimanyu Singh in a family rift. Kuduvukulla sandala auditor arrest பண்ணிட்டாங்க. அதனால no professional agreed to conduct audit for 5 years and the directors have also been disqualified. And therefore, the company is unable to file its returns or give its, not being able to file its returns or auditors report, etc. Abdingarthu was one of the reasons. But of course, ROC did not accept it. They said, all this is ridiculous. You should have found out a professional and you should have gone ahead and they levied penalty. But it was very interesting for us to read. Inspection was carried out in a company in Kolkata where after amalgamation, they went for an inspection. Merge aayachu, the company got dissolved, and then they identified and non-disclosure of KMP, non-disclosure of RPTs in the financial statements, non-disclosure of investments, non-disclosure of short-term investments, shareholding not properly disclosed, non-disclosure of sundry creditors, of multiple grounds. They penalized the transferee entity because that is the surviving entity. They penalized the transferee entity. So although the company stands dissolved in an amalgamation, they have still gone ahead and inspected the books and they verified and they levied penalty. Also against the statutory auditors of the company, they levied a penalty of 90,000 rupees. Again, a very interesting order. Typographical error. Actually, the company was in loss. This is the copy paste error. But the company was actually having a loss. The company's auditor's report read company has losses. While the auditor's report read as it did not have losses. It did have losses, not a tapa pottanga. So, in fact, they went and explained that it's only a typo error. If you look at the other areas, they've captured, in fact, the numbers have also been captured, they've signed it, therefore it's only a typo error, it should be pardoned. They did not accept it. They said, nothing doing. As an auditor, you are bound and duty to verify each of the line, and therefore they've levied a penalty of 10,000 rupees for 2 years, if I recall. அதே மாதிரி employee benefitsல where the auditor accepted that AS 15 line of disclosures was not given as per the requirements and therefore 10,000 rupees for 4 years of penalty was levied. Long-term loans and advances were reduced from X amount to Y amount, which means loans and advances were paid back to the company. This is an exact order captured by the adjudicating authority. Long-term loans and advances, if repaid by the borrower company and received by subject company, should have shown under cash flow from investment activities as per AS accounting standards 3. Auditor is not qualified, but the cash flow did not capture it, and therefore 10,000 of penalty was levied against the auditor. So, when the company is making a mistake, it is not just the company that is being levied penalty. Interestingly, in the cases law, company has not paid a penalty. I don't know, surprisingly why. Should it not be first the company which is at fault and the auditor not qualifying? In fact, when I was going through, I was searching whether, okay, if they penalize the auditor for not qualifying, naturally they should penalize the company for having not complied with the accounting standards. Unfortunately, they have not actually captured the company's violation, nor have they levied any penalty against the company. Then, auditor multiple cases. In fact, sila cases they have, for example, in Sun Pharma, company levied a larger penalty and auditors were levied 50,000 rupees. But sila cases only the auditors are levied, companies are not levied. Sila cases companies are levied. Actually, auditors should have also pointed out the violation. We went and saw their auditor's report. We did a VPD to see their auditor's report. Auditor's report did not qualify it. So, auditor penalized panirukkume. So, there is no clear standards that are set internally as far as different ROCs are concerned. Some ROCs are taking a view, some ROCs are not taking a stand, as the case may be. Specific adjudication orders between March to September. Actually, there are 22 orders that have come அது வந்து 8 கம்பெனியோடது 22 ஆர்டர்ஸாக பிரிச்சிருக்காங்க. இன்ஃபேக்ட் செப்டம்பரில் மட்டுமே எனக்கு தெரிஞ்சு 16 ஆர்டர்ஸ் have come against the auditors of the company for multiple grounds: non-disclosure of RPT, aggregate amount of loan not given in Schedule 3, MSME dues not mentioned in the report, certificate debtors not qualified as secured, unsecured, doubtful, failed to mention investment, whether the investment is in subsidiary or associate companies, clarity illa abdingaradhula 10,000 to 2,40,000 varaikkum they have levied penalty. Why am I pointing so many adjudication orders is because in the last 1 month 16 orders have come against auditors. As I said, over the next period, once E-adjudication comes in, it starts kicking in. We are expecting much more orders. So as auditors of the company, it is our bounden duty to inform right from as small as website complaints, SIN, DIN number, related party transaction capture ஆகிறது வரைக்கும், Schedule 3 format capture ஆகிறது வரைக்கும், end to end the company has to comply. Otherwise, there is a high possibility that they will end up paying penalty. So that is the conclusion of my presentation and the impact of compliances in terms of private companies. Any queries? Yes, sir.
You were talking about DPT. One of the things was about borrowing from a shareholder. So if there is a borrowing from a shareholder, it becomes a deposit. Borrowing from a director is an exempted deposit. So if he is a director and a shareholder, you have the option of taking it as a director deposit. So then it can.
Easier to take director because there is no limit.
Yeah, so you can do that.
You can.
Director and shareholder.
You can.
On the MSME also, wanted to just check.
You wanted to go to the slide?
I know. On the MSME, basically, there is a return to be filed twice a year, right? Twice a year. That comes earlier than the accounts finalization. So that becomes a key thing to ensure that you are in line.
Yes. See, what they are trying to do is, most of the companies, in fact, first year, and then subsequently when the financials are actually coming, they realize that the numbers that they've given to the numbers that are there captured in the financials are different. So they once again file the DPT.
So and in the MSME form, if there is no delay during the whole 6-month period which it covers, there is no delay beyond the
40 days.
Then you don't have
to
a
file.
If there is a delay during the period, then you have to file.
இப்போ V2 வரைக்கும் what with the stand that we were taking is அந்த எது டிலேவோ அத மாத்திரம் இப்போ V3ல they've given an Excel. That Excel says all the details have to be captured, delay not delayed அப்படின்னு ஒரு option கொடுக்குறான். So which means they are asking us to capture all the transactions during the 6 months period and then intimate whichever is delayed alone. அதுல
if there is a delay.
If there is.
Thank you.
Yes.
For income tax, there is a limit, sir. Actually, they will not reopen something like that. For 4 years, 5 years. In ROC,
So, prosecution law, strictly speaking, limitation period of 3 years applies. But ROC நாங்கள் ஒரு தடவை ஒரு மேட்டரில் போய் கேட்டோம், இதெல்லாம் ரொம்ப பழசு, இப்போ போய் நீங்கள் இதை ரீஓப்பன் பண்ணுறீங்களே அப்படின்னு. They said we will go and condone the delay in certain criminal aspects. We will go and condone the delay. They have accepted it அப்படின்னு சொல்றாங்க. But generally speaking, ROCs will not touch anything before 2014. That's an internal unsaid rule that 2014 க்கு முன்னாடி any violation they will not touch it or they will not take it. 2014 க்கு அப்புறம் இருக்கிற violationsல stricter interpretation. If there is a company which is willing to fight it, take it till the Supreme Court, according to us, my personal opinion, 3-year period will mandatorily apply. They will have to stick to the 3-year period and they cannot go beyond the 3-year look back period is my view, because limitation still applies to companies like this. Nothing that says that limitation does not apply at the end. But ROCs, when we go and say, அதெல்லாம் கண்ட்ரோல் பண்ணிட்டு வாங்க சார், ஒன்றும் ப்ராப்ளம் இல்லை சார், ஒரு வாரத்தில் முடிச்சிடறாங்க. கம்பெனிஸ் ஆர் ஸ்கேர்ட், அதுக்கு பெனால்ட்டி கட்டிட்டு போயிடலாமே, எதுக்கு நம்ம பே பண்ணிடுவாங்க. The bigger problem is இப்போ deposit violationsல some people say நம்ம sumoto adjudication மாதிரி நம்ம வந்து ஸ்பெஷல் கோர்ட்ல போய் பெனால்ட்டி கட்டிட்டு வந்துடலாமா அப்படின்னு, ஃபைன் கட்டிட்டு வந்துடலாமான்னு. What they don't realize is 1,000 rupees and more ஃபைன் கட்டிட்டான் அப்படின்னா then you are disqualified to be director, managing director at all under Schedule 5. So you will have to be very, very careful. Chuma adjudication first suo moto kadiyadu 454 la. That stand most of them don't accept. They say no, we will go ahead because ROCs are accepting it. Adala special court imprisonment irundhalum na suo moto poi naane voluntary ah ponena goodwill factor la enakku payment idu penalty levy kammi panna matangala appadina those are all absolutely not advisable. That's anything else? 550.
Thank you, sir, for your excellent presentation, and it was totally practical. So that's what we need. When a theory is not backed up by practical experience, we do not know how to cross the road when it comes. You have been very, very, your suggestions have been extremely useful to us, and I hope that we will make a note of it, and all of us will forms, DPT forms, basically, and PAS 3, PAS 6, regarding dematting. A lot of questions were debated under the concept of PAS Form 6, and you had answered them well, and that's about it. I think all the 4 technical sections we entered into were highly illuminating, absolutely thought-provoking, and I'm sure the people who have gathered here, our colleagues, have really enjoyed it, and there are a lot of take-homes when you go home for the day. I think with that the session stands closed. Thank you all for attending this meeting. Thanks, one and all.